Open this hearing of the Senate Select Committee on Productivity in Australia. I begin by acknowledging the traditional custodians. The committee will be conducting today's hearing in person via video conference. I'm Senator Bragg, Chair. I'm joined by Senator Darmanin and Senator Ananda Raja. These are public proceedings which are being streamed live via the Parliamentary website, and there'll be a Hansard transcript. All witnesses should be aware that in giving evidence to this committee, they are protected by a parliamentary privilege. It's unlawful for anyone to threaten or disadvantage witness on account of evidence given to a committee, and such action may be treated by the Senate as contempt. It is also a contempt to give false or misleading evidence. Witnesses have a right to be heard in camera should they request. I remind senators of their obligations under the Behaviour Code for parliamentarians to treat witnesses with dignity, courtesy, fairness and respect. I remind committee members and witnesses who are not currently speaking to please mute your microphones. And now welcome representatives from the ANZ Banking Group live via video conference. I understand the information on privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, please state your name and capacity in which you appear.
Thank you, Chair. Richard Yetsenga, Group Chief Economist of ANZ.
Thank you very much. Do you have a brief opening statement?
I do. I do also have a colleague, Mr. Andrew Brown, who seems to have disappeared into the technology ether for a minute, unfortunately. But perhaps if I start my opening statement and he can join when he comes. Thank you, of course, for the opportunity for us to appear before the committee. ANZ recognises that for many Australians, buying a home can be challenging. This is true for first home buyers trying to get a start, urban families looking for a place to grow, and people making the regions their home. The availability of housing impacts renters, some of whom are struggling to find affordable accommodation. We welcome the efforts of Parliament and Government to assist Australians to find a home. Before discussing the housing market, I'd like to offer some observations on the economy, given its relevance to interest rates and broader confidence. Australia has strong fundamentals which stand us in good stead during a time of economic uncertainty and geopolitical volatility. These include a highly educated population, a wealth of natural resources and proximity to the fastest growth region of the world in Asia. Nonetheless, we expect Australia will end 2026 with 1.1% GDP growth and that 2027 will see a modest level of 1.6%. This relative softness is due to the combined influence of higher interest rates, elevated energy prices and the uncertainty from the Middle East conflict. This slowing economy is expected to support a return to the Reserve Bank of Australia's 2 to 3% inflation target band. We believe the current interest rate cycle has peaked and that the next move will be downwards in late 2027. Of course, given persistent uncertainty in the macroeconomic environment, a further rate rise cannot be fully discounted. Turning to the housing market, it is our view that after reduced national house prices in 26 and 2027, we will see modest increases in 2028, and prices are influenced by a range of factors. These include interest rates, affordability constraints, the supply of homes, and broader economic confidence. At a more structural level, there is no single factor that is the root cause of a market which lacks enough homes at affordable prices to meet the diverse needs of Australians. There are a range of views among stakeholders who variously cite planning complexity and delays, elevated construction costs, the price of land, labour shortages, infrastructure constraints and tax settings. All of these factors likely play some part in what is a complex system. While housing is a source of stability and shelter, its availability also has knock-on productivity impacts. When homes are slow and too expensive to build, workers cannot move easily to where jobs are available and major projects being delivered. ANZ supports housing in two main ways. Firstly, the bank offers mortgages for people who wish to buy a home. It seeks to do this responsibly and efficiently, working with customers to meet their needs. ANZ operates in a highly competitive mortgage market where customers have a wide range of options. Secondly, ANZ finances the development of housing. We support projects delivered by private developers, government, community housing providers, affordable housing operators and other industry participants. We are committed to working constructively with governments at all levels to support a material uplift in supply. While some individual developers may face challenges obtaining finance, our assessment is there is a ready supply of capital for housing projects. Competition is strong from both bank and private credit providers. Rather than being rather than finance being the principal constraint, we hear from our clients that the biggest obstacle to projects is whether the economics stacks up. In other words, too often the issue is how developers can build homes that the market can afford at a sustainable rate of return. To conclude, ANZ stands ready to work with Parliament, industry and the broader community to help more Australians into their own home. Please accept our apologies that our Managing Director Home Loans could not appear today as originally indicated. This is due to illness. If you have any questions which relate to the bank's mortgage business, I would be very happy to take those on notice. Thank you, and we welcome the committee's questions.
Thanks, Mr. Yetsenga. We just have a few questions for you, so I'll kick off and then we'll see if colleagues have some. So it sounds like you think that one of the major issues in the housing system is that it's hard to make money out of it.
I think that's a fair summary. The commercial realities do seem to be a constraint, and you know, perhaps if you stand back and think more broadly, if the price of existing dwellings has risen over a long period of time relative to income, and the rate of construction has increased particularly quickly since 2021, some construction costs are up a third or a half over that, you know, relatively short period. Then it's not, I think, not just about urban infill or reducing planning restrictions or other things. It's the nuts and bolts of getting structures in place at a price which then allows a commercial return on the sale of the asset.
And then the question is, what's the role of regulation there? I mean, there's a lot of regulation. It seems very costly, like things like the National Construction Code. How much do these things, do you think, add to the overall economics of home building?
Yeah, I think there is something in that question. I mean, certainly I or the team haven't done any work in detail on that. I mean, there are other research providers that I know have looked more closely at that issue, but certainly around the housing issue, the National Construction Code is terminology which seems to come up quite often, and there seems to be a broad range of agreement that you know, we could do better. And in fact, if we think provision of houses is part of Australia's, you know, broader productivity challenge, and then of course higher productivity is always more desirable, all other things being equal at least. That kind of regulatory overlay and the burden of paperwork and the detail of regulation, I think, is something that certainly I think there's broad agreement about.
Well, I mean, as you know, productivity in the building construction sector has been negative over the past few years, and the Productivity Commission has done a lot of work on this. So, I mean, why has it been so much worse than other parts of the economy?
That's a good question. I'm not sure I can be definitive in my answer, unfortunately, except to say that perhaps what's happened to productivity in aggregate has greater similarities to the construction sector, even if the construction sector is a little bit worse. I think the broader challenge is, if you look at the business surveys, for instance, that again around that just after the beginning of the pandemic, around that 2021, 2022 period, you know, lots of things seem to change. Labour as a constraint on output or availability of skilled labour used to be a quarter, a third, maybe 40% of businesses claiming that as their biggest issue. Over the last 4 or 5 years, that's consistently been at 75 to 80% of businesses saying the availability of labour, and particularly skilled labour, is their biggest issue. In fact, in the latest quarterly business survey, the single biggest impact on business confidence was cited to be labour costs. So, while productivity in construction I think looks a little bit worse, it seems to me we have a broader challenge about skilled labour and productivity in general.
Okay, so there's the issue of, can you get access to skilled labour through the migration program, through access to domestic labour arrangements? Then there's the cost of labour, which has obviously been inflated by the CFMEU and other things like that, isn't there? So there's a number of components.
I'd agree with that. There's a number of components, and even when we talk, I guess, at at a macro level about aggregates, but also things like where can we raise participation in the labour force, kind of more micro things. If we do have a migration program that targets particular skills, are those skills being fully utilised? There's, I think, a lot of research that highlights quite clearly that migrants can appear in Australia and their skills are not accepted by either local regulation or local practice or the local labour force. We know also that the data is quite clear about Asian Australians being less prevalent in some sectors than their skills might suggest. So I think, as well as the macro kind of quantity stuff, if you like, there's some micro regulatory cultural, social issues which are also under the surface, which potentially are levers that could be looked at.
Okay. What do you think about the issue of mortgage innovation? I mean, we seem to have 4 large banks all offering very similar mortgages. What are the prospects for mortgage innovation in Australia, do you think?
That's also another good question. Thank you, Chair. Perhaps I can take the particular technicals of that question on notice and get someone with more expertise to come back on that. But maybe in a broader sense, I might just offer one macro perspective, if you like. I know there is a lot of discussion from time to time about competition in the sector and different things. If I stand back and look at Australia, household debt is a bit above 100% of GDP and has been there for about 15 years. I think the latest numbers are about 114%. That is high by international standard. I mean, I say high not to say it's something I'm particularly worried about. The sector seems very strongly based to me, but it's not clear that there's a problem with the provision of credit when I look at the aggregate stock of credit. If there's, perhaps you have concerns about the distribution or other things, that maybe is a market structure issue, and we could come back to you separately on that if that would be okay.
Okay, and what about the APRA macroprudential policies? Do you have a view on how they've been deployed and whether those are fit for purpose?
Look, I don't have a detailed view of that. I'm maybe, again, as an economist looking at the sector, you might expect if there had been a substantial shift in some sort of regulatory policy or macroprudential in some way, you might expect there to be a fall off in the provision of credit into the economy relative to the current interest rate. So the interest rate kind of would no longer telling you about what the system would supply. It's not clear we have a challenge there at the moment. There's been no particular, I guess, odd behaviour in the macro aggregates relative to interest rates. Certainly after the global financial crisis, when there was a kind of a global shift in some of these areas, you could see in some economies that kind of gap open up where a given level of rates no longer seem to be enough to get the system to provide credit like it historically did, but I don't see that at the moment.
Okay. So I guess then coming back to construction finance, what do you think we could do to get more money out the door to the building and construction sector?
Oh, that's a good question as well. I think we could do well to just think about the economics of the sector. And in some of your earlier questions, you've referred to the National Construction Code. I know that's an area that's already subject to substantial focus. Of course, always for any sector, as you know, a roundtable of industry participants will inevitably bring up the level of taxes and charges and stamp duties at various points in time. It does seem like there's an area there to be looked at in the construction sector. I think that international experience as well, we have a few things to learn, and some of them are kind of broad-based. I mean, Auckland is held out, for instance, as a bit of a good example of what some serious town planning reforms can do to free up urban infill, but also, you know, there are slightly more esoteric examples. Singapore, for instance, I understand will offer you some concessional tax treatment if you're buying a dwelling for your ageing parents close to your close to your primary dwelling, with the understanding you take pressure off the social security system, if you like. And Mr. Brown, I'm not sure whether Andrew has managed to join again. He might have some views on this question. I can't see him, unfortunately.
Mr. Brown, are you there?
I can see him, but I can't hear him.
Might be on mute. Okay, so is that him?
Yes. Can you hear me?
Mr. Brown,
Yes,
yeah.
thank you.
Yes.
If you could just state your name and capacity, that'd be useful.
Sure. Thank you, Chair. Andrew Brown. I'm the Head of Research and Analysis for ANZ's Institutional Property Group.
Okay, so the question is, what could be done to help facilitate more lending to the building and construction sector so that we can get more houses built?
So I can't speak on behalf of the broader bank, Senator. What I can say, though, is in my area of expertise in commercial real estate, and more specifically to the question residential development, I believe the settings are very clear, they're well understood, they're long-standing, and we're comfortable with the settings that APRA currently imposes. It's a very competitive landscape, and we believe we have the capacity to review our appetite in context with the competitive environment, and we're able to compete on our terms within the framework provided.
Okay, so you don't have any views about how we could help get more construction finance moving?
I don't have any views, Senator. I look at the opportunities through a credit lens, very specifically on the fundamentals of the project and the feasibility of the project.
Okay, I think you might need to take that on notice then, because that's quite germane to our inquiry here. So I'm a bit surprised you can't say anything. Okay, so what about competition in banking? What are any views on what could be done to help facilitate more competition in banking?
Thank you, Chair, for your question. Perhaps I could also take that question on notice as it goes to the, if you like, the regulatory architecture and the structure of the financial system, and we'd be happy to come back if that would be okay, please.
Okay. I might just rotate the call now. I think Senator Nanda Raja has a couple of questions for you.
Hi. Look, just on the topic of construction finance, do you get many small and medium-sized builders approaching the bank for loans to invest in technology or equipment?
Mr. Brown?
Can you?
Thanks for the question, Senator. That's not lending that we look at through our team in Institutional Property Group. We look at property investment and property development lending, not the funding of working capital for business requirements. Unfortunately,
would you be able to perhaps,
comment.
Mr. Brown, on notice, would you be able to provide the committee with some information, maybe a trend analysis over the last 5 to 10 years of what that pattern has looked like? Because I think, we well recognise that capital investment is not something a lot of small and medium-sized builders actually participate in, and I do wonder what the role of the bank is in that space.
Yes, would be pleased to, Senator.
Okay, wonderful. Yeah, go on, Richard. Yep.
Sorry, I was just going to add, I know of one piece of research the Committee for the Economic Development of Australia did, which looked at the structure of firm size across industries in Australia, and they found actually the construction sector had a predominance of very small firms. Now, they reached some conclusions about tax settings encouraging that small firm behaviour, and posited that perhaps that small firm size was part of the productivity challenge that Senator Bragg referred to in one of his earlier questions. I'd perhaps point you to that research, and if you have any difficulty finding it, I'd be happy to provide that.
Okay, thank you. My next question relates to the consumer data right, which actually hasn't received that much attention, but is quite an innovative piece of work. And I understand the banks were brought in 2020, or at least it was introduced in 2020, energy companies 2022. And as of July this year, we're bringing in non-market lenders as well. Could you give us a bit of an overview as to how this is going internally in your bank, and perhaps how many people are participating and what kind of feedback you've received?
Thank you also for that question. Perhaps I could also take that on notice so I ensure you get the right fulsome response from the relevant area.
Mr. Brown, is that something that you're familiar with?
It's not an area that I'm able to respond on, Senator. So
okay.
We will take that on notice.
Okay. All right. No, that's fine. That's fine. Okay. Thank you, Chair.
Okay. Thanks a lot. I think we'll move on and go to our next witnesses. We might have to get someone back who can answer some of our questions. Thank you very much for your time. And we'll now move to our next witnesses. Just checking whether we have them. So now welcome representatives from the Commonwealth Bank of Australia. Please, I understand the information on parliamentary privilege and witnesses giving evidence to Senate committees has been provided to you. Can you please state your names and capacity in which you appear?
Robert Parker, Chief Risk Officer for the Retail Bank of Commonwealth Bank.
Good morning. I'm Kylie Rickson. I am the Executive General Manager of Financial Crime Compliance at the Commonwealth Bank.
Thanks for being there. Do you have a brief opening statement?
Very brief, Chair.
Go ahead.
Good morning. We welcome the committee's focus on productivity. I would like to offer some very brief opening remarks. Housing is Australia's one of significant challenges. While banks play an important role in financing homes and supporting buyers, the central issue remains housing supply. At CBA, we are supporting construction of new homes and continuing to support home buyers, including young Australians looking to buy their first home. We see significant opportunities from artificial intelligence. Used responsibly, AI can help improve customer experiences. At CBA, our focus is on using technology to support customers and our people, underpinned by strong governance and human oversight. Finally, economic crime is a major productivity challenge. CBA is investing over $1 billion this year to help protect customers from scams, fraud, cyber threats and financial crime. This investment, including AI solutions, helps protect the broader Australian community by disrupting criminal activity, strengthening the integrity of the financial system and reducing harm well beyond our own customer base. We believe continued collaboration between government, regulators, industry and law enforcement is critical to staying ahead of increasingly sophisticated threats and building Australia's resilience. Thank you, Chair. We welcome the committee's questions.
Look, thanks very much for being there. I guess my first question goes to the issue of productivity in the building and construction sector. What do you think the government could do to help drive productivity in that sector?
Well, I think there's a number of state and federal government responses already underway in relation to rezoning and planning. One of the things CBA's been doing in recent times as well is looking at our own credit and policy settings. We have lent around $2 billion to the residential construction sector in the last year, and we've also done things like decrease the ratio of pre-sale apartments that have been required to fund residential constructions in the past. I think there's a number of factors that we need that make up the economics of the residential construction sector, including cost of land, construction costs, as we know, interest rates. So I guess, Senator, every little bit helps.
Yep. So just to add to that, I think also the modern methods of construction plays maybe an emerging role, and that's something that CBA has adapted our lending policies to allow the use of prefabrication for construction loans. Obviously early days, but we'd see that as an element that can help the construction costs.
So with the pre-sales and the financing of new housing, is there anything else you think that the federal government could do to help there? I mean, it's good that you've taken your own innovative approach, but are there broader things that the government or APRA could do?
I think APRA's policy settings, have been stable and clear. The appetite for construction really sits with the banks within those parameters. And, I think that all banks have been taking a close look at those. There's nothing specific that comes to mind in terms of APRA settings. I think they're strong and reflective of the sort of capital environment and strong financial system environment that we want to see and support. In terms of other matters, I think it's a matter for government as to both state and federal as to what other additional zoning and planning. But I understand this, and we see there's quite a lot of that already going on, both at the local level, state and federal.
So what do you think? So what's the level that you will finance a building based on the number of pre-sales? Is it 20 or 30%, or what is the number usually?
I have some of those figures in front of me. Sorry, I'm just accessing them now. Maybe I'll come back to you on that if you want to ask the next question.
Okay. Has this SMSF ban come up at all in terms of the pre-sales issue?
I wouldn't say that SMFF has come up in terms of pre-sales. I mean, we obviously loan to a number of borrower types. SMFF's no longer being an option, but we would say that's somewhat immaterial to the volume.
Okay, so it hasn't come up?
No.
Okay. Have you got the answer now, or?
Yes, I believe I do. Sorry, no, I'll come back to you.
So then, okay, so effectively you think that
we can take that on notice, Senator.
Sorry, you can take it on notice, yeah. So then in terms of the macro-prudential arrangements and APRA's mandate generally, I mean, I understand that you, of course, always want to say good things about the regulator and these parliamentary committees, but generally speaking, you think that those settings are promoting construction of new housing?
Yeah, thank you, Chair. I would say that the settings remain appropriate. If we look at a long-running history of both availability of credit and also financial resilience, that is a balancing act, and we would say that we see credit flowing to the right borrowers with the right level of credit worthiness, and we wouldn't say that the macro-prudential framework is inhibiting that.
It's an interesting point you make, because if you look at the housing completions, we're going backwards in Australia. I mean, despite the government spending more money on housing, we're actually going backwards. So we're only going to get 170,000 dwellings this year. We used to get more than 200,000. So, I mean, I hear you say that, but clearly we're not going in the right direction. So what do you think is going wrong? If your answer is that you're getting the money out the door to the builders and the developers and you're helping finance construction of housing, then why aren't we getting more houses or enough houses to house the population at a reasonable price?
Yeah, I mean, thank you, Chair. I would say that there are obviously a number of factors that play into that. I mean, interest rates, the construction costs, general sentiment, all plays into the housing market. We would say that, we would support any measures that can broadly increase supply because we see that as the most important aspect of long-term affordability.
I mean, everyone agrees with that. It's like saying, do you like to have Christmas? Of course, everyone likes that. My question is, what are the things that might be able to be done to help finance wholesale style credit to housing and building developers? Do you have any ideas there?
Well, I think we mentioned some of those. Those minimum pre-sale requirements have moved from 75 to 100% for certain loan-to-value ratio projects down to 30%. So that's something from a risk appetite perspective that banks can do. We've talked, Senator, about zoning laws and other types of planning administration that, as I said, local, state and federal governments have actually made changes to. They all help. There's nothing, you can't get away also from some of the broader economic impacts like interest rates land values for a residential construction developer. They really need to see the economics stack up. Cost of labour and construction costs, we know, have increased over the past few years, particularly construction costs at a fairly rapid rate for a number of reasons. So, there's no one, I think, silver bullet, unfortunately, Senator.
I understand that, but we're talking about the financing of housing here. So I'm trying to zero in on whether there's anything that can be done in terms of pre-sales or other things. I think your answer is that you think it's just a judgment for the bank. Is that right?
Yes, and I think many banks, including our own, have taken those broader appetite decisions.
Okay. So what about on the retail side then and mortgage innovation? I mean, we have a highly concentrated banking system, as you know. What are your thoughts on the position of innovation in mortgages in Australia?
Thanks, Senator. I mean, look, we obviously continually focus on ensuring that we can make it as timely and easy as possible for consumers to apply and be approved for housing credit. We focus on removing pain points. We utilise technology to speed up time to approvals, and that's an area that we continue to invest in. There's no sort of big individual leap. It's a continuous journey.
Okay, so the CBA's position is that there's no policy change or legal change that could help in the financing of housing in relation to prudential and banking policy in Australia.
I would say that there's no one big ticket item that you could point to. If I reflect on more smaller changes that have made more recently, APRA allows us to use exceptions for, say, borrowers with help debt. We implemented that last year. That allows younger Australians to access housing. Those are examples that I'd say we continually adapt as opposed to one individual silver bullet.
Okay, because we're in a very bad position on housing in Australia, so I'm a bit surprised you don't have more ideas about what could be done to move the place forward. I guess your position is that you think that the bank can do a lot of these things without any policy change, which is a reasonable position for you to take. What about the National Construction Code then? Because that's something that's within the purview of the Commonwealth Government. Do you have any views on how that could be streamlined and that could drive productivity?
Well, we would say ultimately that is a matter for Parliament. Insofar as if the construction code is contributing towards a higher increase in construction costs, we would support measures that can ultimately bring down construction costs and speed up time to construction.
Yeah, anyone would agree with that statement. So what are the opportunities to reduce costs in the building sector then and to drive productivity?
Well, I think as we've said, there's a number of factors that are sort of underway that we see at the sort of local, state, and federal government. It's really a matter for government as to what the policy settings should be. We will work within those policy settings to set an appropriate risk appetite and to provide credit in the most efficient way we can to residential construction developers.
Okay, so what is the CBA's position on the NCC?
I'm not aware that we have a firm position on that, Senator. It's not my area of expertise. I can't comment on any.
But you're here to represent the bank, so you have to take it on notice if you don't know.
That's fine.
You have to take it on notice. What about productivity, fraud issues inside the banking system? I've read a lot about fraudulent loans and all that sort of stuff. What's your take on that?
Yeah, look, that is economic crime is a material productivity drain on the Australian economy. It was over $80 billion in 2023-24, and there's a number of impacts of that. Most of all is the impact it has on victims that we see every day to people we all know. Secondly, it's a drain on productive capital that could be spent elsewhere. So in CBA, we're spending nearly $1 billion in this financial year on prevention of fraud, scams, economic crime and related capability. And the third thing, as we know, is it erodes trust in institutions and digital assets. So I think there's a number of things we can be doing there. I would say, firstly, the partnerships that institutions like banks can have and do have with law enforcement agencies and regulators like AUSTRAC and the AFP through things like the Fintel Alliance, the joint cybercrime Commission and the JPC3 and the Australian Financial Crime Exchange, which helps us to share intelligence on bad actors, are all things that are working well and have much more opportunity to do things to combat and prevent crime. And
Can I just ask you on that? So when you say 80 billion, how much of that goes to mortgages?
Well, I think I don't have a figure to hand on that, Senator, but what I would say is that I think the articles that you're referring to around recent mortgage fraud is something that the Fintel Alliance has actually been working actively on. It is a blight on our society, and it is where criminal syndicates exploit vulnerabilities.
So what do you think needs to be done?
Yes, good question. So I think there's probably a couple of really clear things. First of all, it was mentioned earlier in the ANZ session where the consumer data right could be used to help customers to share safely data in relation to income verification, which would help us go to the source, like, for example, ATO portals. One of the risk vectors, if you like, or vulnerabilities that have been exposed by trusted professionals like accountants has been that issue of the banks not being able to go to the source of truth, which is income verification. So the industry is working with the ATO and government on that. The second thing is continuing to invest in productive intelligence sharing, peer-to-peer and peer-to-regulator and law enforcement through Fintel Alliance and the Australian Financial Crime Exchange, because the best defence we've got is actually disruption and prevention.
Okay, well, I'll go to Senator Darmanin.
Chair, I think just to follow on that line of questioning, the ABA submission talked about the problem of fraudulent loan documentation being used to obtain larger loans. And you've talked through, I think, a few actions that are occurring around this. But I wondered if you could talk, in your opening statement, you talked about the use of AI and productivity. And I just wondered, the ABA submission talked about the use of AI kind of making this phenomenon worse. And I just wondered, from the ANZ's point of view, do you see that? And if so, how are you ensuring that, kind of implementing automated processes, is kind of keeping up with the fraudulent actors in our system?
I'll speak to CBA's view, not ANZ's, just to be clear.
Sorry, CBA. Sorry, my apologies. We just had them.
So look, I think AI works on both sides of the fence. So it clearly makes bad actors have a more scalable, efficient way to find and exploit attack vectors. But for CBA, we also are using AI to our benefit in relation to prevention and disruption. And so that is things, Senator, like scanning millions of transactions a day and sending more than 40,000 alerts to customers where we think there is suspicious or are unsure and want to check that it is actually them, and blocking suspicious transactions as well. The recent mortgage fraud that has been reported in the papers, that industry issue, that was picked up by one of our fraud models initially. So, I think it is a double-edged sword. There's tremendous amounts we can use of it to fight this kind of crime. On the other side of the fence, it's a strong attack vector that scales, allows them to scale.
Okay, so your fraud detector has picked up, you said, what some of that recent reporting has come up with. So, like, what proportion? Like, are you seeing an increase in that sort of fraudulent activity attempt? And how many customers have you kind of intervened to sort of save, if you like, through that process? And are you seeing the kind of systems being used to get through changing?
Yes. So look, I would say, since about, I think the latest figures we have, since about 2023, we have reduced customer losses on fraud and scams by about 70%. So, we're making inroads into that. But as you would be, well aware, Senator, this type of activity is rising, and it is very hard to, combat it on all levels, every day, all the time. And so, the best we can do is to just keep investing in really multifaceted ways. So there's education to customers, there's helping customers when they are a victim of a crime to try and recover the losses, and secondly, try to, wrap our arms around them from a extra care sort of perspective, and there's various things we can do there. The scam prevention framework is, we're very supportive of, and is an excellent lever to create a whole of ecosystem response, because that's what needs to happen. The banks can't do it alone. Many of these scams originate on platforms like Facebook, and we're really conscious that every player in that ecosystem needs to play a role in both disruption and prevention, and then responsibilities for roles they play in that.
Yeah. Just turning more broadly, Mr. Parker, in your opening statement, you talked about the increasing adoption of AI. During the economic roundtable, we know that for white collar jobs in particular, so I'm kind of switching to productivity within the bank itself. Calls for a just transition to protect white collar workers being replaced by AI. I just wondered if you could talk a bit about how you think how the CBA has approached capturing productivity benefits of AI while continuing to look after your workforce, help them transition, and for customers to receive high quality service.
Thank you, Senator. The use of AI, we believe, and we're on public record saying that we think it will have a profound impact. We think that it is we need to be cautious and maintain a high degree of human oversight, and engage with a variety of stakeholders, and that would be both employees, government, and regulators on how we look to adopt and utilise AI. We do believe that it is a productivity opportunity that we think is substantial, and so therefore we would continue to want to evaluate that across those dimensions.
And CBA, Senator, has also made some statements in relation to the $90 million we're spending over 3 years to support our staff to upskill in relation to AI, but also acknowledging that some of those jobs that exist both at CBA and elsewhere in the economy are going to morph, change, and potentially disappear over what is an uncertain time horizon. And so it's really important for us that we help our staff to retrain and to be, in the best case scenarios, be able to move into a different and AI sort of enabled area somewhere else in the bank, or with great skills externally to CBA.
Mm-hmm. And in terms of kind of staff and productivity, I understand that you've recently announced the offshoring of hundreds of jobs to India. Is that right?
I don't know the specific quote that you're referring to. We do have a hub in India. I wouldn't characterise it by saying we're offshoring hundreds of jobs to India. No, we look very carefully at all roles that we both employ in India, and the roles that are no longer required in CBA, whether that's in India or elsewhere. There's a number of processes that we go through, including consultation with our union, the FSU, so that we can ensure that we're taking all the right steps to protect our staff.
Mm-hmm. And in terms of when you make those decisions, to what extent are you thinking about the productivity benefits internally and then more broadly for the Australian economy, if you think about those things at all?
I think we have turned our mind to productivity in a broad sense, Senator, in CBA, and that sort of sits squarely in that how is AI going to change the focus, the activities, and therefore the role that our staff play. I mean, we've implemented AI use cases, fairly material ones in different parts of the organisation. And one thing I would say, having been involved closely in some of those, is that there's absolutely no doubt that humans still need to be, at the helm in terms of those AI use cases. And what we've discovered is that actually what happens is that the role of the humans actually don't go away, they often change and morph. And so we've been, I would say it's really difficult, and I think our CEO's on record, around this as well, to be able to measure the productivity specifically of AI, and the benefits and trade-offs. But we are sort of turning our mind to looking at how our roles and the productivity of different parts of the bank changed over time.
Yeah, I mean, I think that's the critical question about how you measure those benefits. So kind of any further information that you can perhaps provide on notice about how you're thinking about that would be very useful to us, I think. Thanks, Chair.
Okay. So we just have one quick one. Thanks, Senator Darmanin, just from Senator Nana Raja, then we'll let you go.
Thanks, Chair. Just to follow on that, I understand that CBA is looking or has perhaps done a deal already with a US AI company. How do you protect yourself, say, going into the future, 5 years, 10 years, 15, 20 years from now, from companies like this ratcheting up their costs? Once you are enmeshed in them and they have their tendrils well and truly into an organisation like the CBA, what stops them from ratcheting up their prices and then that being passed on to the Australian people? How are you diversifying your risk? And a follow-on question is, are you looking to procure this kind of capability from Australian companies?
Yeah, it's a very good question, Senator. So we partner with a number of different organisations in this sector, and you may be referring to one of those, but we have partnership agreements, partnering and collaboration agreements with a number of them, including OpenAI and Anthropic, Microsoft. We use a number of vendors. I think one of the key ways that we can and organisations and the broader Australian economy can protect ourselves from that risk is by that very factor of making sure that we have a diversified group of partners that we collaborate with, vendors, etc. That issue, by the way, is not necessarily a new issue. Getting all in with a single vendor or cloud provider, etc. Increases concentration risk, and that's something that CBA and all organisations need to be thinking about. And that's why we definitely are diversifying in this area of AI technology in terms of who we work with, but also with other technology vendors and other suppliers as well. That's going to be a really important factor going forward.
You mentioned 3 US companies. Microsoft has a big stake in OpenAI. What is stopping these 3 US tech companies, the ones that you have or considering working with, from colluding on price? I mean, yes, you've diversified on paper procurement from 3 US companies, but Microsoft has a big stake in OpenAI. And these are US tech giants. What is stopping them from colluding on price going forward? Because I don't actually see that as diversification.
Well, I think there are a number of players that are sort of evolving in this market, not just with foundational models, but with products that will sit over the top of those foundational models. And I think that this, it's uncertain as to how this will play out, but there's no doubt that there's going to be, a relatively competitive landscape going forward in this space. There's a huge amount of investment capital going into that space. And as I said, CBA, they're not the only companies that we are working with in that space. Named a few of them. We'll continue to look at how we make sure that we don't have concentration risk that we feel is inappropriate.
Okay, thanks, Chair.
Thanks very much to you, and we'll now move to our next witness, which is the National Australia Bank. Just seeing if they're online. I'm not sure that they are.
Can you hear us?
Yes, we can. Thank you very much. I understand the information on parliamentary privilege and witnesses giving evidence to Senate committees has been provided to you. Please state your name and capacity in which you appear.
Matt Dawson, Executive, Home Lending Platforms.
And Pete Steele, Group Executive of Digital, Data and AI.
Do you have any opening statement?
Certainly. Good morning, Chair and members of the committee, and thank you for the opportunity to appear today. My name is Matt Dawson and I lead the Home Lending Platforms at NAB. Joining me is Pete Steele, NAB's Group Executive for Digital, Data and AI. NAB's CEO, Andrew Irvin, has described productivity growth as the speed limit for the Australian economy. If productivity slows, our economy's capacity to grow, lift living standards and create opportunities slows with it. From NAB's perspective, one of Australia's clearest productivity challenges is housing. Housing affordability is fundamentally a supply challenge. Australia is simply not building enough homes to keep pace with population growth and demand. Housing is often discussed as an affordability issue, but it is also a productivity issue. When we don't build enough homes, it becomes harder for people to move to where jobs are being created and harder for businesses to attract workers. There is no single solution, but there are practical ways to help unlock supply. That includes streamlining planning and approvals, ensuring enabling infrastructure keeps pace with growth, and supporting innovation in areas such as modular housing. For modular housing scale in Australia, state-based building, insurance and consumer protection frameworks need to keep pace with new construction methods. The same principle applies to the home loan process. If we want faster, safer and more efficient lending decisions, policy settings need to support trusted digital tools as well as new ways of building homes. That is why we welcome the government's budget announcement committing to explore how customers can share their ATO tax data safely and securely with their bank through the consumer data right. This would allow banks to rely on a single source of trusted data rather than asking customers to submit multiple documents, such as income payslips, for loan applications. These kinds of practical reforms matter because productivity is not abstract. It is about removing unnecessary friction from the systems people rely on. Alongside housing, artificial intelligence represents one of the most significant productivity opportunities available to Australia. At NAB, we're already seeing how automation can help bankers categorise and analyse home loan applications, reducing manual processing and helping customers receive decisions more quickly. We're continuing to refine AI-driven process improvements so our people can serve customers better and faster. We look forward to discussing how both housing and technology can help lift Australia's productivity and answering the committee's questions this morning. Thank you.
Look, thanks very much for being there. So are you saying you think that the payslip and all the other information issues that are causing fraud in the system could be addressed in part through government doing some things?
Absolutely. We welcome the government initiatives such as the exploration of sharing of ATO data through the consumer data right. It would streamline and accelerate loan applications. It would strengthen fraud detection, and it would also deliver broader productivity benefits and customer outcomes. To be honest, work could also be done to investigate the possibility of a direct ATO to bank data sharing system that would provide a more secure and verifiable alternative.
And you think this would help with the huge problem of mortgage fraud?
Yes. As I said, it would help with documentation verification, and it ultimately would prevent fraud.
Okay. What about the issue of lending to developers and builders? How's that going at the moment?
Well, I mean, we've been playing our role. You would have seen the announcement earlier in the year, or you may have seen it, I should say. We've made a $60 billion commitment, or a housing affordability finance ambition. That's split evenly between supply side finance for residential development and then demand side support for first home buyers.
Okay. Is there anything else that the government can do in Canberra to help with that?
I think there's probably the allowance. We've continued to engage with the government to ensure that we consider ways to remove support lower building costs, the regulatory impost, and then the labour shortages.
Okay. What about on mortgage innovation? Is there anything you think that can be done to help get different kind of mortgages into the field?
Well, I think there's probably a couple of different layers to that innovation point. One would be from a product perspective in areas such as modular housing and consideration of product support to support that modern method of construction. And similarly, and the leveraging of AI to support, as I said in the opening statement, to support better, safer and faster outcomes for customers by leveraging new technologies.
Okay. What about but in terms of like financing of housing, I mean, is there anything at all that you think that could be done to help get more money out the door? I mean, it's clear we're not getting enough houses built. So I'm just wondering whether there are barriers between banks and builders and developers.
I think, at a practical level, and maybe I'll touch quickly on modular, and I would defer, maybe take a broader position on notice. As I said, governments at all levels should continue to look for ways to streamline planning and approval processes to ensure that the right enabling infrastructure is in place to support the delivery of new housing supply. Specifically for modular, if we want modular to scale in Australia, it's important that the building insurance and consumer protection frameworks can keep pace with the new construction methods. Currently, state-based building insurance schemes don't cover modular construction phase and delivery, and therefore, in the event of a manufacturer insolvency during that construction phase, consumers could lose that upfront payment and potentially be left with negative equity. We have raised this challenge with the federal government, and we will continue to engage constructively with governments at both federal and state levels across Australia as they look to address the challenges such as appropriate insurance.
We might get you to provide that in more detail on notice. What have you seen? What have you seen since the budget in relation to first home buyers? Because the clearance rates are pretty low still in Sydney. Anything you've seen there?
Yes. Again, there's probably a couple of points to make in this space. Post the tax changes, they're clearly looking towards shifting more investment into new housing. But to be transparent, it's too early to be definitive about the market impact. Right. Our CEO publicly said in June, mortgage activity has slowed, particularly amongst investors. But people are waiting to see how those changes play out. When they feel uncertain, they tend to pause.
What about in relation to the pre-sale? So what do you require in terms of pre-sales before you finance a building?
I sit in the home lending business. I'd have to take that question on notice, I'm afraid.
Okay. And have you noticed anything to do with the SMSF ban in terms of pre-sales?
Similarly, I'm not across the detail on SMSF, I'm afraid. I'll take that on notice.
Okay. Okay. I'll hand the call now to Senator Ananda Raja.
Thanks, Chair. I'm interested in understanding what the bank is doing to support build to rent. I had the opportunity of touring a NAB financed build to rent precinct, I guess, in Melbourne not so long ago, and it was quite impressive, actually. Really beautiful development. So interested to know what you're doing to encourage this asset class. It probably hasn't received enough attention. And do you think that the changes in the budget will see an increase in build to rent from institutional investors, particularly?
Certainly. Thank you, Senator. Great question. NAB supports measures that increase housing supply across all tenures, including owner-occupied housing, affordable and social housing, modular and build-to-rent. As Australia's largest business bank and a major institutional lender, we finance a range of residential development projects, which include build-to-rent. Because increasingly housing supply is critical to improve affordability and easing rental pressures. Build to rent, though, is not a replacement for home ownership, nor should it be viewed as an either-or choice between institutional investment and the individual investors. Build to rent developments can attract both domestic and international capital. The key question is whether investment is helping to deliver this additional housing supply. And Australia needs more housing of all types. Build to rent is one mechanism for delivering that additional housing stock to address the broader housing shortage across Australia.
Do you have any forecasts as to what numbers of build to rent buildings you see going forward or dwellings you see going forward you expect?
I don't have specific numbers to hand, I'm afraid, Senator. Again, I'll take that on notice. But as I said, we're seeing it as one of the classes of innovation in construction and product that we're exploring to support that broader supply.
Okay, thank you. Thanks, Chair.
Just before we let you go, I just wanted to see what's the one thing you think we could do to get supply up in Australia that's in the preserve of the federal government, given that we are not getting enough houses. We used to get a lot more. We have a bigger population. So is there one thing you think that we could do that would help on the financing and mortgage and banking policy side that would really make a big difference?
Very good question. Unfortunately, I don't think there's a single silver bullet. As I mentioned, any work that can go to removing those practical barriers, building costs, regulatory impost, what we talked about, that support from federal and state governments on alignment on planning processes, and then from a modular perspective, support from an insurance perspective to support consumers, such that we could then look to scale modular housing as a product set.
Thank you very much. You go with our best wishes, and we'll now go to our next witnesses. And I believe we have them in part. And so thank you to FinTech Australia for being there. And we'll ask you to just indicate that you have received the information about parliamentary privilege and the protection of witnesses giving evidence to Senate committees, and state your name and capacity in which you appear.
Yes, we have. My name is Rehan de Almeida, CEO of FinTech Australia.
Yes, we have. The Head of Policy, FinTech Australia.
I think we're just waiting for the other witness. So do you have a brief opening statement?
Yes, we do. Thank you, Chair and members of the committee, for the opportunity to appear today. As mentioned, my name is Rehan de Almeida, CEO of FinTech Australia, and I'm also appearing alongside Jack Morgan, our Head of Policy. FinTech Australia is the peak industry body representing Australia's financial technology sector. Our members range from early stage startups through to established providers operating across payments, lending, wealth tech, wealth management, reg tech, open banking, digital assets, artificial intelligence, and digital identity. Our central message today is simple. FinTech is the productivity infrastructure for the Australian economy, not just an industry that operates in isolation. Productivity growth increasingly comes from reducing friction, helping businesses transact more efficiently, improving the allocation of capital, lowering compliance costs, and giving consumers better access to financial services. FinTech is enabling each of these outcomes. This is borne out by the evidence. Deloitte's recent national study found that 79% of Australian fintechs identify improving business productivity as their primary source of value creation, ahead of every other benefit. These businesses are digitizing workflows, reducing fraud, lowering transaction costs, improving data quality, and automating manual processes across the economy. They contribute directly to sectors as diverse as housing, agriculture, health, retail, and government. The opportunity extends well beyond fintech itself. The Productivity Commission has estimated that mature economy-wide data sharing could contribute around $10 billion annually to the Australian economy. The consumer data right is a foundational part of that opportunity. When implemented effectively, it reduces search and switching costs, improves competition, supports better lending decisions, and enables innovative services that help households and businesses make better financial decisions. One particularly important next step is the inclusion of ATO tax data within the consumer data right. Secure consumer-directed access to verified tax information would streamline mortgage and business lending by reducing documentation requirements, accelerating income verification, and improving credit assessments. It illustrates how well-designed data sharing reforms can simultaneously improve productivity, competition, and consumer outcomes. The CDR is particularly relevant to this committee's interest in housing finance, open banking, digital ID, AI-enabled credit assessment, and modern payments infrastructure have the potential to reduce the time and costs involved in obtaining and refinancing a mortgage, increase competition between lenders, and improve access to finance, particularly for consumers and small businesses whose circumstances are not well served by traditional assessment models. Australia is not short of innovative businesses. The challenge is ensuring they can scale here. Across our submissions to the committee, the Productivity Commission, and Treasury, a consistent theme emerges. Young, innovative businesses continue to face unnecessary barriers to growth, access to investment, uncertainty around venture capital settings, access to banking services and payments infrastructure, and delays in implementing productivity enhancing reforms such as the consumer data right. These issues may appear technical in isolation, but together they determine whether innovative firms can compete, whether new technologies diffuse through the economy, and ultimately, whether Australia lifts its long run productivity performance. Our message today is that productivity policy should focus on removing barriers to business dynamism, encouraging long-term investment, and accelerating the adoption of technologies that reduce friction across the economy. If we get these settings right, we won't simply build a larger fintech sector, we'll build a more productive Australian economy. Thank you.
Thank you. So the first question I'll take to you is on the issue of mortgage innovation. So what exactly do you think should be done to get more competition and more innovation in mortgages?
The key one from our position is, similar to what NAB had mentioned previously as well. It's the access to data and the streamlining of flowing of data will enable for faster decision making, a reduction of fraud, and a key element of that, alongside with the consumer data right, is the access to ATO data as well through the consumer data right. That creates a secure approach to sharing information from the ATO directly with decision makers that can enable faster lending decisions.
So what's the barrier to that happening?
Getting access to ATO data primarily, which is of course a big project in itself. And we do believe when we work through the use cases, there is an opportunity to find the right approach and cost-effective approach to make it happen.
Okay, so it's a decision of the government that's needed, is it?
Yes.
Okay. In terms, so you think that would help address the fraud issues as well?
Absolutely.
Okay.
This is the opportunity to disintermediate the user from having the opportunity to manipulate that information if it goes directly from the ATO into the bank or the fintech or the third-party decision maker, there's no way for the document to be manipulated.
Okay, so then what about the issue of macro-prudential tools and the way that APRA deploys them? Are there any things that could be done there to help promote competition and innovation?
I'll have to take that on notice. Jack, do you have any thoughts here?
I do, but I think we'll set them out in detail on notice.
Yeah.
And so, but what about different types of mortgages? I mean, what are the prospects for getting different types of mortgages into Australia?
What do you mean by different types, Chair?
Well, rather than just being all, long-term variable interest.
I'll have to check with our members, Chair, before I have a comprehensive response for you. So I'd like to take that on notice.
Okay. So your main point is that you think that the getting access to the CDR tax data would help generate more competition and it would deal with the fraud issues.
Absolutely.
Okay, that's your and what's your? Do you have any other kind of principal points? Was that your main wish list? That's your major ask, is it, in terms of financing and mortgages and that sort of policy?
With the access to consumer data, right, and ensuring there's more streamlined flow of information, not just limiting it to ATO data, but also further development of the consumer data, right, is the key ask. Okay.
I understand that Barrenjoey has now joined us, so if Mr. Mott could just state his name and capacity in which he appears. We can hear him. I'm not sure we can hear him. Mr. Mott, are you there?
I think he's on mute.
He's on mute. You're on mute. Well, he'll solve that, I'm sure. Okay, while he's doing that, I understand that Senator Darmanin has a couple of questions for FinTech Australia. So if Senator Darmanin is available to ask those questions now, that would be helpful.
Great. Thanks, Chair. In your submission, I think you made some comments around state procurement frameworks favouring large established vendors, and that by including smaller fintechs, it would increase competition. Can you just talk about that a little bit more in terms of what you think would be useful to make some changes there? You
made some comments around state procurement. Absolutely. Thank you, Senator. Apologies for background sound.
I'm hearing myself in trouble.
Good. So thank you, Senator, for the question. Absolutely, there is an opportunity for government, both state level as well as federal level, to really open up its procurement processes to early stage and more established fintech companies. A good example of that is the New South Wales Treasury opening up their payments and banking support tender to both fintechs as well as banks and traditional financial institutes. It's still in early development, and as I understand, the New South Wales Treasury is building frameworks to better enable fintechs to work directly with state government. So this is an opportunity for government to have these procurement processes be developed such that fintechs also have the opportunity to present as well as provide their services and technology and early technologies that can really enable productivity within government so that they can access these fintech services. At its current state, there is no clear process for fintechs to be pitching their solutions to government.
Mm. And do you think that's a kind of large opportunity, or can you give us a sense of, how that would contribute to the kind of growth of some other parts of our fintech sector?
Absolutely, Senator. So a good example of this I have stated in the past is within the public transport system, for example, we have Australian-based payment companies that can provide tap-to-pay services for the public transport system. As these public transport systems are upgrading their technologies. However, as we've seen, a number of state governments have continued to procure these technology solutions from international markets and from other areas, while the local fintech that has the technology is providing its solutions to Washington and to London and to those larger, more developed markets, but still doesn't have the opportunity to provide their services here in Australia itself. So that's a good example of, supporting local innovation for the local market, and then being able to further support jobs and innovation in Australia itself.
Yeah, thank you. If I've got time for one more quick one. Yep. Just very quickly, in your, you mentioned earlier, I think it was in your opening statement, this comment around AI-enabled credit assessment. Can you talk a bit about how we balance up the risks around an increasing use of AI, particularly, there's been a bit of a theme already, and around increasing fraudulent loans and the like. How do we balance those things?
That is part of what I mentioned also with the ATO data access. So there are opportunities for really not just reducing friction, but also enabling the transfer of information directly from the source to the decision maker, right? So that way you don't have AI with access to this information to be able to manipulate the data. And that is a key ask that we believe can reduce fraud in a number of ways. However, AI is a growing threat in every form, and if not regulated, the challenges as new consumers begin to trust AI and do things manually by themselves, there's more risk for the consumer as they, start downloading information and sharing it with their AI of choice to get answers to questions or apply for loans or make any of those decisions. So the real need here is to regulate it such that information is protected and also ensure that data safety and data privacy is maintained.
Yeah, great. Thanks, Chair.
Senator Nataraja, we're just going to exhaust FinTech Australia, then come to Barrenjoey.
Thanks, Chair. Just a question regarding the consumer data right. We have now opened this up to non-market lenders. I guess that's you or many of your members. Can you just talk us through what this means for your sector and for consumers?
Absolutely. There's huge benefit for the consumer with the ability now for decision-making to go beyond just the banks, to be able to share their overall data based on any lender that they are currently utilizing or using for their services, for their lending services. So this really opens up the opportunity to get a more holistic view of their mortgage or lending service that they're accessing. And this could enable for better switching, better costs, faster switching as well, and faster decision making for the switching, as it is enabled through data sharing via the CDR. Previously, it would have to be more manual with information being downloaded and then uploaded, or as we've discussed previously, the ability to manipulate that information using AI or whatever that is accessible to these users. So we do see this opportunity really opening up more competition and more choice for the consumer and business.
What is the sector doing to increase uptake of the CDR amongst consumers? My understanding is that we have about 1.3 million Australians who have signed up to this. It's voluntary. Not many people know about it, actually, whereas just about everyone touches a financial institution at some point, right? So what is the sector, what sort of thinking is going on within the sector to increase uptake?
The key approach continues to be not direct consumer education about the consumer data right. It may be unnecessary in a lot of situations, but really streamlining the approach for sharing data and the consent flows that happen when a consumer is asked to share their data, there's a lot of mistrust in the within consumers when they're asked to share their data with a third party. So to be more clear about what they are actually enabling and how this is safer than traditional approaches where they were previously asked to upload information or share it via email can be a lot less secure. The industry is doing a lot in terms of those consent flows. However, there's still a long way to go to ensure I believe consumers do not need to understand that they're sharing data via the CDR, but more know that the traditional approaches for sharing the data is higher risk and less secure and can lead to more issues in the future.
So just walk me through how a consumer is actually signed up to this then during a transaction. Say they want to switch loans or something like that.
So if they're applying for a loan, when they apply through the service provider that would assess whether it's a broker or whether it's directly with a bank or a fintech, what they would do is the app or the website would ask them for access to their data, and they have to give consent. So as they give consent, as they provide consent, then the technology or app has access to the transaction information from their previous service provider. But those consent flows can be a little cumbersome, and consumers may feel that they don't trust the system that they're using to share the data, because there are certain instances where different apps and different banks have different messages on what it means to share data. So it may create more fear within the ecosystem of consumers when they have to give their consent. So a large part of this is also having clear communication on why this is extremely a safer approach to sharing their data versus traditional approaches.
So what is fintech on that point? What is fintech doing, Australia doing to increase trust in this sort of information sharing platform?
Currently, most of our work is through the consultation process, working very closely with Treasury, working closely with the data standards body to ensure that the standards are streamlined, such that communication can be clear on why this is the safer approach to sharing your data.
Okay, thank you, Chair.
Thank you. I just wanted to now try and bring in Barrenjoey. So, Mr. Mott, can you hear me?
Yes, can you hear me now?
Yes, we've got you. So if you could state your name and capacity in which you appear.
Name Jonathan Mott, and I'm the banks analyst at Barrenjoey.
Okay, do you have any brief opening comments?
Yes, I do. I'll read that now. Senators, thank you for the opportunity to talk on the availability of credit and competition in housing finance. And today I'm going to provide you with some positive news. As a starting point, Australia has one of the most efficient and competitive banking systems in the world, which provides credit efficiently to Australian households within the constraints of the responsible lending laws and the Hayne Royal Commission of 2018-19. The dynamics of housing finance have changed dramatically over the last 20 years, with mortgage brokers now originating about 80% of home loans. These brokers are responsible to find the best products and pricing for their clients. Another dynamic in the housing market has been the rapid rise of Macquarie Bank. Today, Macquarie provides about 7.25% of all housing credit in Australia. It's up from only 3% 5 years ago. Macquarie is growing at 28% per annum, which is 4 times systems level, and now has a $180 billion mortgage book, which is roughly the same size as Bendigo Bank, Bank of Queensland and ING combined. Macquarie offers very efficient technology, turnaround times, product and pricing, which is well received by the brokers and their customers. This intense competition has seen the margin that the banks are making on their mortgages fall sharply over the last decade. 10 years ago, the banks were generating a return on equity of around 25 to 30% on their mortgage books, and today it's below their cost of capital at about 8 or 9%. Even over the last few weeks, we've seen a renewed bout of competition in housing finance. 3 weeks ago, Commonwealth Bank of Australia reduced their mortgage rates on new business by between 5 and 8 basis points on average. The other banks have since matched that, sometimes better, and then CBA actually went again, and even this morning, Bendigo reduced a lot of their mortgage pricing. This will flow through to mortgage customers over time as they refinance their loans or they contact their bank or their broker to ask for a better rate. Once again, this will push the returns the banks are generating on their mortgage book back below their cost of capital. So competition for housing finance has never been greater than it has been in the last few years. If we also look at the availability of credit based on the ABS statistics for the quarter to the end of March, we can see that over the last 3 years, owner-occupied credit has risen 42% and investor finance is up by 85%. Over the last year alone, the banks have lent $400 billion in new credit to the housing market, and housing credit growth, so their outstanding stock, is growing at about 7.5% per annum. Now, however, since February, following 3 rate hikes, a war, and the tax changes with the budget, housing lending has fallen quite sharply. We put out some research this morning on data from Loan Market Group, which is Australia's largest mortgage aggregator, which shows that home loan applications are down around 23% since the start of February. Within this, mortgage applications for first home buyers are down 19%, owner-occupied upgraders are down 15%, while investors are down 35%, all seasonally adjusted. It should be noticed that this is mainly as a result of a reduction in demand. It is not as a result of change in underwriting standards by the banks. One area of concern is the distribution of this credit. Higher interest rates since 2023 has materially reduced borrowing capacity under the responsible lending laws enforced by APRA and ASIC. Combined with house price appreciation over this period, especially outside Sydney and Melbourne, borrowing has become increasingly skewed to the rich. I'm going to put this into perspective, and this is based on numbers from Commonwealth Bank of Australia through to December 2025. Twice as much money is now being lent to investors who earn more than $500,000 per annum than to all households who earn less than $125,000 per annum to buy their own home. Housing credit is freely available, but in a high inflation and high interest rate environment, buying a house has become increasingly a luxury good. Thank you for the time and happy to take any questions.
Thanks, Mr. Watt. So effectively you're saying that it's very difficult at the moment for first home buyers, and first home buyers are not able to easily get into the market.
Well, really, that comes down to housing affordability and the available of housing. That's a supply issue that I think we've all been talking about for some time. The price of housing has become extremely difficult, which makes it hard for first-home buyers to get in the housing market. I think that's a well-known statement.
So what could be done to help get more wholesale financing to builders and developers?
Look, I'm a banks analyst. I don't really know specifically about the building industry themselves. So that's probably something you should ask the builders and the banks rather than specifically in that topic.
So in terms of then on the retail side where the mortgages are applied for, is there anything that could be done to help individuals get access to finance?
I think that's the key point, is that the banks are lending very freely at the moment. They're trying as best they can to lend. The problem is that housing affordability has become so stretched that a lot of young Australians, first-home buyers, and people on median incomes are struggling to get into the housing market because of housing affordability. That becomes a function of house prices and the affordability rather than the banks going and saying, hey, we need to lend more. The challenge is house prices.
So effectively, that comes back to our old friend of supply, that we haven't built enough. And therefore the
Absolutely. I think we'd all love to have, given the rapid growth in the population that Australia's experiencing, we need to build more houses. We need to build more apartments. We need to turnover, the velocity of housing needs to improve so that older Australians who are now in the empty nester stage can move on and free up bedrooms to all Australians. I think improving the supply and availability of housing would be a fantastic outcome. And if we could have a situation where house prices were flat for 10 to 15 years in nominal terms and fell in real terms, improving affordability, that would be a great outcome for all Australians.
So in summary, because your data that you read into the record at the start is quite shocking. So your effective position is that this is a supply challenge. We need to build more houses to reduce the price. And you're not recommending any changes on the demand side.
I think on the demand side, people want to move into their houses, and it's a supply issue. I think that's well known that we need to build more houses across the spectrum, not just for first home buyers, but we need more houses for first home buyers, for families, and probably the one that's talked about the least is more for downsizers. As the population ages and a lot of people are now moving from their family home as they become empty nesters, and before they move into to aged care, we need to have more housing stock for those downsizers to enable the velocity of housing to turn over so that we can improve the turnover and people moving into houses. There's a lot of empty bedrooms in Australia. I think the statistic I saw was 13 million empty bedrooms, and a lot of those are people whose children have left home. Not all of them want to downsize, some of them do, but if we can do that, it would really help the supply. But you are quite correct, it comes down to the supply of housing that we need to address.
So I know your comments about Macquarie Bank developing as a stronger player. What sort of money are the banks making out of mortgages in Australia?
Yeah, that's a great point. The return on equity that the banks generate on their mortgages have come down dramatically over the last few years, and that's the result of, number one, mortgage brokers, which are really helping people find the best deal. And remember, they're paid to get customers the best deal for their mortgage. And then new players like Macquarie come in and driving the margins that the banks are earning down. So the way we think about it is, what's the return on the equity that they're generating? And if we went back to before the Royal Commission, say around the middle of last decade, 2015, the banks were generating 25 to 30% return on equity on their mortgages. And today it's at or below their cost of capital, which is around 8 to 9%. They're making a higher return on equity on their proprietary loans than they are on their broker-originated loans, but it's very, very competitive. And, that is a result of, number one, the mortgage broking industry coming in, and number two, new players like Macquarie entering the housing market.
So, final question, do you think we still need the Four Pillars policy?
I would not like to see the four major banks consolidate. I don't think that would necessarily be in anyone's interest outside another financial crisis, and hopefully we don't have another one of those anytime soon. But I think what we are increasingly seeing is the four major banks and Macquarie becoming bigger and bigger players. And that's because, as Rohan was saying before, that we are now seeing technology. We are now seeing competition. We're now seeing prices being driven lower, and it makes it increasingly difficult for some of the more traditional smaller players to compete. People have gone from banking locally to using technology to bank. And that's one of the, I think that's some great comments there. I think we need to see more of that to drive competition.
Okay, thanks, Mr. Mott. Thanks for your evidence. Committee will now break for 15 minutes.
Hey.
Welcome Westpac to the hearing. I understand the information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. Please state your names and capacity in which you appear.
Lucy Ellis, Chief Economist for Westpac Banking Group.
And Damien McRae, General Manager of Retail Banking for the Westpac Group.
Okay, thanks for being there. Do you have any brief opening comments?
We do, Senator, and thank you for the opportunity to appear this morning. Lifting productivity is critical to improving living standards, driving economic growth and addressing some of Australia's biggest challenges, particularly housing supply, regional development and infrastructure delivery. As Australia's oldest company and first bank, Westpac has an important role to play in participating in our national discussion on productivity. Last year, we submitted our Building a Stronger Australia productivity submission to the government, and more recently, we contributed to the current Productivity Commission consultation. In each submission, we have focused on suggestions offering simple, practical and budget-neutral reforms to boost productivity. Both submissions are tabled for the committee's reference, as well as our recent consumer market update. We see firsthand the impact of unnecessary friction that can be placed on consumers and businesses by outdated regulation. There is no better example of this than when someone applies for a home or a business loan. Today, the processing of a loan still relies heavily on either printed paper or the emailing of PDF files for document verification. Customers are required to collect and submit payslips, tax records, and other financial documents, creating unnecessary friction and data storage risk. One simple and practical reform that could deliver immediate benefits to Australians is enable banks to access ATO income data with a customer's consent. The government's consumer data right was built at significant cost to banks for exactly this type of secure data sharing. 6 years on, it remains a productivity oddity that government-mandated secure data sharing system, yet government data isn't shared within it. Advances in AI are making it easier to manipulate or generate convincing financial documents, placing growing pressure on traditional income verification processes. While banks continue to invest heavily in fraud detection and prevention measures, an AI versus AI battle is entirely unproductive when an irrefutable digital point of truth already exists and is held by government. Providing customer-consented access to ATO data within the CDR would improve customer experience, reduce processing time, strengthen fraud controls, and provide lenders with a single trusted source of information. This is a practical reform that would improve efficiency, strengthen system integrity, and support the broader productivity agenda. We ask the government to progress its implementation with urgency. Thank you.
Well, thanks for that. That was a very useful opening statement. Thank you for that. The CDR has been around for a while. I understand the banks have invested heavily into it. Of course, this is one area where the major banks and the fintech industry agree, which is quite a remarkable development. And so everyone is saying this is a way to resolve the fraud issues. How big do you think the fraud issue is in relation to mortgages?
Well, Senator, I'll start and then I'll hand to Lucy. The risk is real, and we're seeing that play out. The reason we put forward our initial statements is the take-up of CDR at the moment we see as low, and we think there's two reasons for that. Use cases aren't there, and the trust in sharing data isn't there, and we see the opportunity there for sharing government data through the ATO is one of the ways that we can restrict fraud that we're seeing currently within the mortgage system. Lucy, anything to add?
I think I would just clarify to say this isn't about the system as we have it now. The level of fraud is not currently, so high that you would say that it's a burgeoning problem. It's the issue is that this is a new technology. It's developing quickly. People are learning how to use it, and so this is about heading off a problem that could become much bigger.
Well, especially if we have versions of Mythos and other things deployed into Australia. Okay, so if I mean, how many people use a CDR at Westpac now? If a consumer wants to get a loan from Westpac, is anyone using CDR now?
It's a very low number. Damien, perhaps if you'd like to take
Senator,
that.
the take-up has been, I'm happy to take that on notice. The take-up has been extremely low to date, but happy to take that on notice, the exact numbers, and share that back with the committee.
So, I mean, it's always good that these parliamentary committees to work through practical examples, because this is quite dense information. So if we wanted to, if we all assumed that the CDR was going to be a good thing because it was going to help reduce fraud, so therefore higher usage is a good thing, what are the main barriers to using it now? Like, is it the brokers don't like it because it's clunky? Is it because it doesn't have their government data in it, so it's useless? What are the main reasons?
Yeah, Senator, we're seeing at the moment the use cases just aren't there, and there's a level of trust from the consumer. We believe by leveraging ATO data, a central source of truth, a digital source of truth, would remove those two barriers, and we see significant benefit for that. Firstly, we don't have a decisioning issue at the moment. We have a verification issue. So this would reduce time to verify. It would reduce the amount of paper that our consumers and our customers are having to provide us as they're going through a mortgage or a business loan activity. And lastly, as called out, the level of fraud, we'll be able to manage fraud and reduce the level of fraud we're seeing within the system.
So would brokers use it?
If there's use cases and trust, Senator, yes, we believe they would.
So, but I mean, most of the loans now are originated by mortgage brokers, aren't they?
It's sort of 3 out of 4 loans at the moment, Senator, come through the mortgage broker system.
It's pretty high. So if they use it, then it'll be taken up quickly and in a dense way, won't it?
That's a fair comment.
Okay. So effectively, this is all, reasonably new to us, I think, in Canberra. So effectively, you're saying at the moment, if you go to a mortgage broker, you've got to find all these different pieces of paper. And that raises a fraud risk because the pieces of paper could be false pieces of paper. And then you're saying, well, you and the others are saying, well, if you have verification sitting behind a system, government verification as well, then you would eliminate a large amount of that fraud risk.
Yeah, the digital point of truth that we believe the ATO could provide us, Senator, would go a long way to removing that risk.
So the decision that you need is effectively a decision of government to allow it to happen, isn't it?
That is correct.
Okay. We are spending a lot of money on housing, but we're getting fewer houses. So what do you make of this? What is your business tell you about lending to developers and builders?
Perhaps if I'll start with the general observations about productivity in the construction market. The reality is this is a global issue, and I'd refer you to the research report that the Productivity Commission released last year. It is the case that in most countries, the construction industry lags in terms of productivity performance relative to other countries and relative to other industries. And Australia isn't particularly the worst here, but most comparable countries face the same issue. So what's going on? Part of it is inherent because every location is different. So building a building is inherently bespoke in a way that manufacturing a car is not. But there are also structural issues around the industrial organisation of the industry that make it hard to reap scale economies and, in particular, to diffuse sort of new methods of working or better methods of working. So I refer you both to both the Productivity Commission report on this, but also the CEDA work that I believe one of our counterparts also mentioned around the small scale of home building firms relative to commercial builders of commercial construction. That small scale of operation does make it difficult for new methods of building or just better, more competent methods of building to diffuse across the industry. And it does speak to a balkanisation of regulation where small firms are meeting a particular market that they know well, but because the rules are different in the next local government area, then they can't compete as well in the next local government area. And I think consistency of rules may be one contributor to this small scale of local operation, but I think there's just also an awful lot of history behind that.
Plus, you have the CFMEU, which I imagine doesn't help.
Senator, I would observe that unionisation in residential construction is actually lower than in commercial construction. So that may be an issue in apartment construction, although actually, if anything, the productivity lag in apartment construction, according to the Productivity Commission's report, is less than in building of detached homes. So I think diseconomies of small scale seem to swamp whatever may be going on, at least for the residential building industry.
Okay, so is there anything that you can do to get more money out the door to builders and developers? Are there any regulatory or policy barriers?
Senator, the observation I would make is that Australia as a nation has chosen more safety in its regulatory environment across a range of domains than its peers. That's a choice that we've made, and that has consequences that we do not want to wish away because we've made that choice for a reason. And I think back to the Murray inquiry of 2014, where the government of the day chose more safety than the global minimum around financial stability. I note, though, that actually out in consultation at the moment, APRA has a consultation process out at the moment called Getting the Balance Right, where it is contemplating some small changes to the capital framework that, in our view, would be helpful in providing a little bit more leeway for some areas where perhaps they hadn't got the balance right. And I refer particularly to Clause 29, Paragraph 29 of the Draft Prudential Practice Guide, which is on APRA's website. The marked up version notes that they are proposing a change, firstly to allow build to let to be more explicitly in the rules, but also to ease the pre-sales and pre-lease qualification rules and to allow a lower threshold of pre-sales and pre-lease requirements. Now, this is for the standardised capital rules. So this doesn't directly apply for large banks like Westpac or the other ones that are allowed to use their own risk models, although it does influence the kinds of models that APRA would allow us to use for our risk modelling. The standardised framework applies for mid-sized banks and smaller lenders, and my read of what they are proposing is, an appropriate and a modest and appropriate revision that would get the balance right in property development by easing pre-sales requirements for certain kinds of exposures. And the specific reference is paragraph 29 of the Draft Prudential Practice Guide that they've released on their website. I note there that the proposed date that those rules would come into effect following consultation is April next year. I think it's entirely, it could be contemplated that could come in faster. I don't think there would be any objections to some of these changes.
So you think that the pre-sales threshold should be loosened?
I think that Australia has overall chosen more safety for good reasons. That sometimes means that we've chosen specific details of the regulatory framework that on reflection may have been too tight. This, having read the marked up version of the Draft Prudential Practice Guide, my observation as a former regulator is that this is a sensible and moderate change to the rules that nonetheless stays within the risk appetite that Australia has set for itself.
So what is the threshold you use at the bank now for pre-sales?
I don't think there is a specific threshold. Our institutional and business bank lenders will be looking at this on a case-by-case basis because, of course, they have a risk model. And, of course, it is always possible to lend without those kind of requirements. But the way the standardised framework works for the smaller lenders is, the risk weight is higher, the cost of capital is higher if you don't meet those thresholds. So what tends to happen? As happens in, for the smaller banks with mortgages, if you don't meet that threshold commitment, it doesn't tend to be economic, and so you tend not to see lending with those kinds of characteristics. And we see this also in the mortgage industry where, loans with a low down payment, with a high loan to valuation ratio, they have a higher cost of capital. And, the specific tweaks then, so then you end up with, the government being involved in that particular segment because the economics of lending at the higher cost of capital don't always work. So, there are sensible requirements. And so APRA has been through a process of considering what might be, sensible and moderate changes to the rules to get the balance right within our broader national risk appetite.
So, and what about, are you aware of the proportion of SMSFs that get involved in pre-sales?
So Westpac isn't in the business of lending to self-managed super funds. And I might just step outside. As you'd be aware, Westpac Economics is actually independent of Westpac management team. And so I would hark back to my experience responding in my former life to the Murray inquiry, where lending to self-managed super funds was on the table. And my recollection of the 2014 submission by the Reserve Bank to that submission was that actually, organisations shouldn't be in the business of lending to self-managed super funds, because self-managed super funds are people's superannuation. They are for retirement income. Leveraging them, results in an unacceptable level of risk. This is, what the Reserve Bank said at the time. And in particular, most self-managed super funds, if you're borrowing for a property, that ends up with a big asset concentration within that self-managed super fund. You have, most of your super being in one apartment or one commercial property. That's not really consistent with the principles of asset diversification that you'd want to see in someone's retirement fund. I want to be clear that what I just said is not a Westpac position, but I'm harking back to some of the arguments around why you might want to do that from my former life.
Okay, just finally from me before I write out the call, is there anything else on capital and serviceability? Because it sounds like you're quite open to a loosening up of those quite rigid rules.
Look, I wouldn't characterise the capital framework as rigid. I think it's always going to be the case that there are specific thresholds and requirements within the standardised treatment in the capital rules. And of course, Australia is bound by the global minimum represented by the Basel framework. So there's a limit to how far you would go. And as I mentioned, Australia consistently, we have a lower risk appetite than some other countries around these issues. And therefore, we should tread carefully. What I would like to say is that the changes that APRA have proposed in the standardised framework, which I emphasise is not specific to Westpac. We're a big bank. We have our own risk models in these areas, but the standardised framework that covers other lenders, some of the change, we would regard some of these changes as being appropriate.
Okay, thank you, Senator Nandaraja.
Thanks, Chair. Just going back to the CDR, I just want to tease this out a little bit more. So my understanding is the banks are sharing information through this platform, but you're not able to, you're not linked to government agencies like the ATO, for example. Is that right?
Yeah, that's correct, Senator. At the moment, we don't have a direct linkage into the ATO to source the ATO data directly.
Okay. So when someone has to provide their tax return or their pay slip and so on, they're physically handing you a document. Is that what's happening rather than you getting it from?
Yeah, sorry, Senator. It's either physical paper or a PDF emailed to us, which would be received from their accountant or directly from the ATO, which obviously heightens the risk around that information being shared.
And is some of this behind some of the income misrepresentation we've seen in the media around AI synthetically generating documents?
If I took a step back and reframed it, we see a risk of not being able to go directly to the source that increases the risk of fraudulent documents being produced.
So is it a hard thing for the ATO? Like, I don't actually know what the holdup is on our end with regards to the ATO sharing data, but what kind of conversations have you had with government agencies around this?
Yeah, that's something, Senator, that we'd be very comfortable to have directly with the government and with the ATO around how we see this working and how we could fast track this in the future. Okay, that's good. The other question I have is around build to rent. What do you see build to rent as an asset class going forward? What do you, in terms of its growth or contribution to our housing repertoire?
Senator, historically, almost all of the rental property in Australia has been owned by other households. They've been attracted both by an asset that they understand, and also the concessional taxation that's been available through the combination of negative gearing and capital gains. And again, in the past, I was often encountered people who would like to do build to rent, but it has been very hard for the economics of that to stack up when you're looking for a rental return that is higher than what an individual investor will accept. Now, that's just ended up. That's how our rental markets ended up. And I note that one of my counterparts in a hearing earlier this morning noted that Australia has a relatively high share of housing debt relative to housing income. One of the reasons is that the household sector owns all the housing. You don't have some of the housing being owned by corporations or by pension funds, which is the case in a number of other advanced economies. And so all of that debt is attributed to households rather than some of it being attributed to other sectors. It may well be the case, and we Westpac Economics, when we did an update to our housing forecasts following the budget, noted that one potential medium-term impact of the recent budgetary changes is that we may see, some corporatisation and professionalisation of the landlord sector, because the economics of the rental market will evolve over time, such that a corporate landlord that doesn't negatively gear can then actually make the economics stack up. And so build to rent is starting in certain areas, but of course, in Australia you build a block of apartments and it's all Torrens title. Some of them are rented. They're all owned by a person. Some of them are owner-occupied, some of them are rented. That's not necessarily the model that other countries pursue. So, for example, in Canada, it's quite typical for a corporate owner to own a whole apartment block and rent all of it out. And in fact, if you rent out a private house, a detached house or a condominium, they call it non-conforming rental. It's unusual for them to do that. It's known as non-conforming rental. And so, there's a question, is that actually a rental model we want, where you have large companies renting homes to people, or do you want the kind of the cottage industry that we have today, or a mix of the two? There is some build to rent in the market. Student housing works very well in that model because you tend to have all students all living in the one place. But, it's not necessarily the case. Build to rent for detached housing, is less of a viable business model given the relative rates of return on rental. But we anticipate, and so Westpac Economics envisaged and anticipated in that that note that we put out, which we can supply to you. It's on our Westpac IQ platform. We envisage that it's possible that we'll have a bit more build to rent because the relative economics and the relative returns for a corporate landlord versus an individual landlord will start to shift a little. But I think that's a medium-term evolution that will be sometime in the future.
That's very helpful. Thank you. And do you think, just on the topic of corporatisation of landlords, do you think that there's going to be potentially new products available for retail investors through the build to rent model?
Well, it's possible. I mean, there are certainly real estate investment trusts already on the market that people can invest in, but currently they invest in commercial real estate. There are products in other countries where, large financial firms buy up a whole bunch of housing and then rent it out, and then that becomes something that's available for other retail investors too. So there's a middleman then in between versus owning the property yourself. Of course, the difference is if you own the property yourself, you own one or two properties and you're exposed to all the idiosyncratic risk of owning one or two properties, whereas there is a sense of portfolio diversification if you're doing it in that, intermediated way. But I think, one would need to consider that policy option holistically in terms of the experience of renters as well. So, in the end, what you're doing is you're in the business of providing housing services to your customers. And there's, not a lot of discussion about the renter as a customer as part of that discussion.
And just my last question, you did mention real estate investment trusts only offering commercial property. Is that shifting, or are there regulatory barriers preventing them from dipping into residential, for example?
I'm not aware that there are regulatory barriers from doing so, Senator. My observation of the housing and mortgage market in Australia is, as I pointed out, that in Australia, most of the rental property is owned by individuals who will accept a lower rate of rental return because, of course, they've had access to concessional capital gains and will continue to do so in the context of new build. So for that reason, they will accept a lower rental yield than a corporate landlord would. And so it's not economic for corporate landlords to compete, particularly in an environment where you might be buying, one or two houses here, one or two townhouses. The economies of scale don't actually add up. So it's not a regulatory barrier as such. It is more the structure of our ownership of the housing market and, the way that's been taxed. And of course, once you do that for a number of decades, you have a huge path dependence there.
Okay, thank you. Thank you, Chair.
Thank you very much for being there. You go with our best wishes. And we now move to our next witness. Just checking whether we have them online. So I now welcome the Australian Banking Association. I understand the information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. Can you please take your names and capacity in which you appear?
Thanks very much, Chair. Simon Birmingham, Chief Executive Officer of the Australian Banking Association.
And Craig Evans, Head of Economic Policy at the Australian Banking Association.
Thanks for being there. Do you have an opening statement?
Thanks, Chair. We do, and thank you to you and the Senators for the chance to be with you today. Improving productivity is one of the defining economic challenges facing Australia and many developed economies. Productivity ultimately determines whether real wages rise, whether Australia remains an attractive place to invest, and whether the next generation is better off than the last. The banking sector plays a pivotal role in enabling productivity in Australia's economy through credit provision to businesses, infrastructure and home ownership, along with world-leading payment systems. That is why the ABA joined with other industry associations in a joint alliance advocating for practical measures to boost productivity. What unites the alliance is a shared belief that Australia needs better regulation. Australian organisations now spend around $160 billion a year complying with federal regulation, more than double the cost a decade ago. The alliance has called for an economy-wide regulatory stocktake and a 25% reduction in regulatory costs by 2030, aligning with targets already adopted in the United Kingdom and the European Union. For a bank customer, reduced regulatory delays and duplication mean faster service and quicker approvals. A concrete example of a very practical reform with win-win benefits is set out in our submission, and I acknowledge it's been subject of some questioning today. Today, even when a customer explicitly asks for it, the Australian Tax Office legally cannot share that customer's own tax information with their bank. So, when Australians apply for a loan, they are left to gather and submit sensitive documents like payslips, tax returns, bank statements, all too often submitted by hand. This process is an anachronism in the digital age, unnecessarily burdensome for customers, and creates unnecessary risk in our financial system. Buying a home or securing a business loan should not begin with a scavenger hunt through your own financial records. This is why the ABA has been advocating for a secure, consent-based way to share ATO data with banks through the consumer data right for the purpose of credit decisions. This is a genuinely productivity-enhancing reform. It would mean faster, more certain loan approvals, less paperwork for customers, and less time spent on manual processing across the financial system. It would also strengthen the integrity of lending, Fraudulent loan documentation is a growing problem, and artificial intelligence is making fake payslips and doctored statements frighteningly easy to produce. Verified ATO data will give lenders a single, trusted source of truth for a customer's income, helping to prevent document fraud at its source. The single best defence against fake income documents is real income data, and the ATO has it. We therefore welcome the government's recent budget commitment to explore this reform. It is a positive step, and we encourage progress to be made on it as soon as possible. To the issue of home ownership more broadly, nowhere are productivity challenges more visible or talked about more than in housing. Banks are central to home ownership. In 2025, Australia's banks extended more than 556,000 loans for housing, nearly a quarter of them to first home buyers. That figure represents an increase of 34,000 loans from the previous year. Bank lending also supported the construction of approximately 110,000 new homes in 2025. But persistent constraints on housing supply remain a significant handbrake on home ownership, limiting labour mobility and intensifying cost of living pressures. Lifting productivity in housing requires clearer and more consistent planning settings that deliver faster and more certain approvals. It necessitates affordable building standards and a construction workforce big enough and flexible enough to meet demand. And it means making sure roads, power and water keep pace with where we're rezoning for homes. Finally, a word on how banks are regulated. The ABA has long argued that regulation should be proportionate to the size, complexity and risk of the institution being regulated. A one-size-fits-all approach imposes disproportionate compliance costs on smaller banks, costs that ultimately flow through to customers. We therefore welcome APRA's recent commitments in this area, including its move to formalise a three-tier approach to proportionality, to streamline accreditation and to improve the transparency of its licensing and capital decisions. These are essential steps if smaller and mid-tier banks are to successfully compete while maintaining a viable return on equity. APRA is consulting on variations to credit risk capital settings, potentially giving banks greater capacity to lend to the priorities that drive growth: new housing, infrastructure and small business. These are welcome initial steps to refine prudential settings to support productivity while keeping our financial system unquestionably strong. As the committee weighs how best to lift Australia's productivity, we would urge prioritisation, reforms with clear benefits, smarter regulation, tangible reforms like secure ATO data sharing and faster housing approvals and builds. Thank you again. We look forward to taking your questions.
Thank you very much. So I'll go to the consumer data right issue first, because historically the banks and the fintechs haven't always seen eye to eye on this, but now it seems that everyone agrees that it would be a good idea to have verification of some tax information provided through the CDR. Of course, we have strong laws around tax secrecy in Australia. So what are the barriers that need to be overcome if this is to be achieved?
Thanks, Chair. And indeed, we have expressed significant concerns in relation to the CDR in the past. When I started the ABA late last year, CEOs of smaller and mid-tier banks were virtually table thumping in their anger at the costs of implementation of the CDR and the way in which those costs had burdened their businesses. We welcome steps that are taken to rein those continued costs in. The new chair of the Data Standards Board, Scott Farrell, has been very clear in terms of putting a pause on the development of new standards which would require and necessitate additional changes in bank systems, and that's very welcome. It comes at a time where I think the last published data shows that there was around 1.3 million Australians who used CDR in some form. There is still clearly some way to go in terms of how that is used, but we clearly see the ATO data as a really beneficial opportunity for that. In this year's budget, the government allocated some $62 million over 2 years to extend the operation and participation of the CDR and, importantly, to explore the potential to enable taxpayers to share certain ATO-held data through the CDR. And that really is, as I said, a win-win opportunity if we can get it right. It does require some changes to tax laws, which Mr Evans can touch on. It, of course, requires the ATO to tap into the CDR system and for those technology systems to safely and securely work. We understand that all Australians want to know that their tax data is held and handled securely and sensitively. But that said, these examples and parallels do exist. When you get your tax return done, your accountants and others are able to access certain information pre-populated in returns and the like, and it cannot be beyond the means to cost effectively and safely build a system where the same can apply for Australians seeking credit and loans from their banks, and to stop the situation which is so out of touch with 2026 where people are photocopying, posting, emailing, dropping off copies of documents that sadly those who wish to undertake fraud and other activities find all too easy to now manufacture illegally.
Yes, so just to add to that, in terms of what would be required specifically, that would need to be amendments to Division 355 of the Taxation Administration Act to permit the ATO to disclose limited verified taxpayer information to ADIs for income verification purposes, strictly on the basis of explicit and revocable taxpayer consent. Because under the current framework, the ATO is unable to share taxpayers' information even when the taxpayer has explicitly requested that the disclosure occur. As a result, as Simon has outlined, individuals must manually gather and transmit those sensitive tax documents to support the loan application. So that is the kind of tangible change that would be needed. And then we would also need to work with government about how that information could best be shared through the CDR or as has been outlined in the budget.
How big do you think the problem is in terms of mortgage fraud? Have you got a number on it?
We don't have a number that I can provide, or indeed I don't have an aggregate number, Chair. I'd say simply it's too big. Anything is too big in that space. And that in terms of the type of tools available to fraudsters, technology is enhancing the opportunities for them, but it's also enhancing the opportunities for banks and regulators to fight back. We have a close partnership with AUSTRAC, and I note that AUSTRAC from the 1st of July acquired new powers and responsibilities that go to touching on real estate agents, accountants and others that we think will be helpful in this space. The FinTel Alliance work we do with AUSTRAC is also very important and helpful in terms of sharing information. The AUSTRAC CEO and ourselves and our board have been in close and continuous engagement in relation to these issues. There's also, of course, the work just touched on in terms of the way we see ATO data as providing a much more secure process and one that will then better enable a triaging. If we have complete confidence in the accuracy of information that some loan applicants are giving us because you've got it verified by the ATO, it makes it easier to dig a little deeper into some of the others if it doesn't have that verification, and to make sure that that is triaged and effectively tested. But also note really important welcome steps in terms of linking director IDs to the company's register and ensuring that in relation to other sources where banks use government data and government registries to verify information, that they are as joined up and accurate as possible.
If you could take on notice any numbers that you can put around the scale of mortgage fraud, that would be helpful. I imagine that you haven't thought about how much it would cost the Commonwealth Government to actually create this back end. Have you given any thought to how expensive that would be, or do you think it would be a reasonably inexpensive systems build?
Chair, we would hope that it can be done, of course, for least cost. Now, what that actually looks like, clearly the scoping work that was funded in this year's budget will assess. But we're talking about relatively straightforward data points, at least initially. We're working through, from ABA members' perspective, precisely what those data points look like, how it could apply. Let's say it's not without precedent in terms of certain other sectors being able to have certain tax information shared with them. So using those precedents, using the pre-existing model of the CDR, we think should achieve a least cost outcome.
Okay. I want to ask you about APRA's mandate and its macro-prudential tools. Do you think it should have a mandate to consider in some way the promotion of home ownership and the deployment of finance to developers, builders, but also mortgages to first home buyers?
I think APRA has certainly shown themselves to be, firstly, very conscious of having an unquestionably strong financial and banking system in Australia, and that is an objective that we support. I note that the government updated the mandates statement of expectations for both ASIC and APRA just last week, and in doing so, put a growth mandate into both of those statements of expectations. That again is something the ABA industry have been asking for. It's analogous to what had occurred in the UK, where a secondary objective had been put into the equivalent statement of expectations for their prudential and conduct regulators, and where I think there is positive feedback in the way that has changed settings. I think there is a test that follows on from that, partly for the Parliament and elsewhere, as to then how those regulators are held to account for that new expectation in relation to growth. There is often a lot of scrutiny in relation to how they regulate conduct, as there should be, but there also needs to be appropriate scrutiny to make sure that with the government having made clear they have a role in ensuring regulation provides for growth in the Australian economy, how are they actually measuring and delivering upon that? In terms of broader changes in relation to their mandate, I say we welcome the changes that have been made, the changes that we have asked for, and we think there's a big test to make sure that they are actually now effectively delivered upon.
Okay. What about with housing finance construction? What are you seeing there? What could be done, if anything, to help promote the amount of housing that is funded by Australian banks?
Thanks. So APRA, as I think has been referenced today, has undertaken or begun consultation into changes that I referenced in the opening statement around their credit risk capital settings. They're across three areas that they are looking at changes. One in relation to infrastructure lending to allow lower risk weight for large domestic public infrastructure exposures, and another in relation to land acquisition, development and construction lending, which seeks to adjust criteria to allow for more exposures to qualify for the lower 100% risk weight for residential property development. A third relates to unrated corporate lending. That's welcome, but I'll put that to one side for this question. But the two around land acquisition, development and construction lending and around infrastructure lending are both welcome, as they may facilitate increased investment and increased credit into new residential construction and the infrastructure necessary for new residential construction. And we certainly welcome those as an important step. We will continue to monitor carefully the adequacy of that step and any other opportunities to ensure those regulatory settings are encouraging the lending and credit availability necessary for those projects to get off the ground. But this is definitely a pointer in the right direction.
Okay, just finally from me, because it sounds like your main point that you wanted to make today is in your submission and you've dealt with today, which is around these issues of fraud in the CDR. But can I also ask you while you're here, in relation to innovation in mortgages, is there anything that you think that the federal government could do or APRA could do to help promote different ideas, different concepts coming into the mortgage system? Because we have a very high level of concentration and a very low level of innovation in terms of the products people can actually use to buy a house.
Thanks, Jeff. I'll contest a little of that I think in terms of the concentration point you make. If we look at the data in terms of mortgages being written across the Australian economy. We can see increased diversification there, and that is driving competition. I note you had Baron Joe, his banking analyst, before talking about the margins falling sharply across the banking industry, and particularly in terms of the mortgage industry, and the struggles to actually meet cost of capital that a number of banks are facing. And the competitiveness in the industry is shown by the fact that last year in 2025, there was a 20% jump from the previous year on the number of borrowers who renegotiated or switched their home loans. Some 640,000 plus mortgages were refinanced through 2025, and 64% of those were refinanced by people switching to another bank, another financial institution. So that shows large numbers of Australians, record numbers of Australians, finding competitiveness, choice, and going out and seeking a better deal that is saving them thousands of dollars. I think more broadly, as we indicated and have been consistent on even prior to my time, the supply challenges are the real ones. How do we ensure effective supply of housing, planning approvals being fast, construction costs being as low as possible? They're critical. Liquidity of housing stock as well. And I know that goes to an element of your question there. But again, ensuring that there is that supply for older Australians to choose to downsize, and the costs of downsizing are as minimal as possible, I think, are the key constraints rather than necessarily the financial products that are available to them.
Thank you. Senator Ananda-Rajah.
Thanks, Chair. Just want to draw you out on AI, and from your vantage point, if you could perhaps give us an overview about how the sector is considering AI, what it's doing in terms of adoption, and is there any activity to build in-house capability within the big banks particularly? And also, are they looking to procure from domestic vendors? Because I did hear earlier from CBA that their idea of diversification is to sign deals with US tech giants, which I have major problems with, considering that I came from the health sector, which is pretty much handcuffed to US tech giants with regards to the electronic medical record, and it has not gone well 10, 12, 15 years down the track. So interested to know what your perspective is on all of this.
Thanks, Senator. And I note firstly that the chair of the Productivity Commission has identified that artificial intelligence utilisation across the Australian economy could be a boost of up to 4% to our productivity over the next decade. So while I understand the many issues that need to be managed in relation to AI, we do need to be clear that AI adoption is not a change that Australia can opt out of. It is one that is necessary if we are to seize productivity gains and the opportunities of economic growth across the economy. Certainly, major banks are very cognizant of the need to adopt AI, but to do so responsibly and safely and securely. And so their test in terms of vendors is one where they'll use those measures around safety, security, and the opportunity that is provided. Obviously, I think many would welcome the opportunity in relation to Australian developed product where it is available and where it does meet those tests, and the opportunities that they are looking to use AI for. Scam prevention and fraud prevention being key, and that is a big area, and there are all sorts of innovative approaches to that. I didn't catch all of CBA's evidence before, but as is public, one of the things that they have used AI tools for is actually to have chatbots who take and receive scam calls and basically waste the time of scammers. Equally, I know that another major, Westpac, for example, has an AI tool that works alongside human callers in their scam centre, but provides them with prompts as it listens into the caller and says, well, they've just used these words in relation to cyber, which means you should ask about these particular matters. And each of them, ANZ, NAB, all have different tools they're deploying at scam and fraud prevention to make sure that they're really seizing all of the opportunities available, but also the chance to transform the customer experience. And clearly there are opportunities to do things faster, smarter, more accurately, and to provide potentially the type of information or analysis to customers in a secure, well-managed way. But all of these tests also require good, skilled staff, and we are very cognisant. I've met with the FSU in this role to talk about the type of investment that banks make in their staff. And I note that many are in the marketplace looking for those type of skilled technology workers as well to be able to help them with that transformation.
And are the banks developing in-house capability as well?
I'd have to leave that as a question for each of them, and there is always, of course, a competitive aspect to some of those things, which is where there come to be the limits as an industry body as to how much information is shared around our table, because clearly we take competition law responsibilities very, very seriously. But we do bring our members together and have also done so with customer-owned banking association and smaller authorised deposit-taking institutions across the country to share information around cyber risk and how that is best managed. So adopting a collaborative approach to the risk management side, where I think it is well accepted by regulators that a threat to some is a threat to all in terms of those cyber risks and to confidence across the system. So making sure that we are sharing that knowledge and information on the risk side, but when it comes to the development of in-house capabilities that may go to how we're deploying opportunities for potentially competitive advantage, well, they're matters for individual banks.
I like the set of examples you gave us, Mr. Birmingham. It just makes it real, makes the idea of AI real for customers. If you could maybe supply us with on notice a list of other scenarios, that would be most helpful.
Very happy to do so. Thanks, Senator.
Okay, well, thank you very much for your time and for being there today, and you go with our best wishes.
Thank you. Good to see you all again.
Okay, we now move to our next witness, just checking if they're already online. We've got two. We've got Mortgage Stress Victoria and the Insurance Council of Australia. Just checking if they're available. I think we'll suspend while we find the witnesses. We're suspending. We welcome Mortgage Stress Victoria as we wait for the Insurance Council to join us. I understand the information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. To start with Mortgage Stress Victoria, can you please state your name and capacity in which you appear? As we wait for the Insurance Council to join us. I understand the information on parliamentary privilege and the protection. Quite a bit of a repeat there, I think.
Apologies, I had the streaming on another screen, so I was getting a bit of an echo. Thanks very much, Senator Bragg. My name's Denise Boyd. I'm from Mortgage Stress Victoria.
Okay, and the Insurance Council, Mr. Hall, are you there? Okay, we'll come back to him. Okay, do you have just sort of some very brief opening comments?
Yes, I do. Thanks, Senator. So on behalf of Mortgage Stress Victoria, just for some context, we're a Victorian government-funded community legal centre supporting Victorians experiencing mortgage stress to maintain stable housing through an integrated practice model. It's quite unique in Australia that brings together legal advocacy, financial counselling and social work. Our caseworkers see every week the practical consequences of a mortgage market that has concentrated almost all the interest rate risk onto households and offers very little genuine product choice or innovation. I also have the privilege to reference on their behalf the work of our colleagues and research partners, the Consumer Policy Research Centre, an independent not-for-profit that conducts research to understand how Australia can create fairer markets. Earlier this year, some members of the committee will be aware of this. We released a report, Australia's Broken Mortgage Market, which explores alternative products that are not available to Australian consumers, as well as an analysis of the hardship provisions offered by various lenders. Now, I'm supposed to be joined today by Dr. Deborah Ralston. I don't know if she's made it onto the call yet. She's a member of our expert reference group established by MSV and CPRC to advise our work on fairer, cheaper mortgages. As some of you may know, Dr. Ralston has decades of experience in public policy and innovation in banking, in mortgage broking, superannuation, funds management, fintech, financial advice and education. She's also the inaugural chair of ASIC's Digital Finance Advisory Board. So if you're looking to get your first home loan, you actually in Australia have very few options about the type of loan that you're going to get. Unlike in many other countries, there's no government support that makes long-term fixed rate home loans possible. And that means that mortgage holders are unable to predict how much their home is going to cost them. What we want is for private markets to be well regulated to deliver safe, secure and affordable housing. The levers to deliver better housing are shared between all levels of government. At the federal level, there's three actions that would most help fix the problems that we've seen in the mortgage market. First one is action to make mortgages cheaper and fairer, and that includes exploring how the federal government can encourage long-term fixed interest rate products like we see across Europe and the Americas. Better mortgages would actually offer borrowers price predictability for their housing. Another issue is fixing lenders' mortgage insurance. This is the only insurance product a consumer pays for which they get no direct benefit or protection. Standardising hardship support is critical so that when someone who's been able to buy a home, that if their circumstances do change, as they do over the course of a loan, they can access a reliable standard of support to help them keep that home wherever possible. In February of this year, demand for MSV services spiked, and since then, monthly demand has been around 25% more than the average month in 2025. Due to demand, we target our services to low-income households and people affected by family violence. Australian homeowners with a mortgage are under serious financial pressure, with almost half, about 45%, spending more than a third of disposable income on mortgage payments in 2025. That was the financial year. Household debt as a proportion of disposable income has more than doubled in a generation, and mortgage stress is now the leading reason people seek help from the National Debt Helpline. At the same time, of course, renting is no longer a reliable fallback, with capital city rents at record highs nationally. So being forced to sell your home can lead to housing insecurity or even worse, homelessness. MSV supports households on fixed or low income struggling to meet their mortgage payments. When interest rates fluctuate, our clients, and indeed all Australians, act as shock absorbers for financial risk. But it doesn't actually have to be this way. homeowners with a mortgage are bearing the brunt of the economy-wide fight against inflation, and the impacts as a proportion of overall earnings are greater for low-income Australians like our clients. Excuse me. Another driver for the broken mortgage market was the fact that MSV caseworkers actually got tired of seeing wildly different responses from lenders to same or very similar hardship requests. So currently we've got a lender's lottery. So who you bank with determines what rights and protections you have and the support you can expect when you reach out for help. Private lenders, such as the non-banks, are not required to meet the same standards as mainstream banks. And it shouldn't be that way either. Compare this to, say, in energy markets. While they're imperfect, private companies in energy have clear requirements for how they treat their customers. If a person experiences financial hardship and can't pay their energy bills, they can access payment plans and are protected against disconnection. In the water sector, water quality and safety is protected through strict frameworks. Those higher risk and low income borrowers that are most likely to need hardship protections and supports are most likely to bank with private lenders who offer the weakest protections. But lenders really shouldn't be competing on their hardship response. A mandatory Australian Mortgages Charter, which incorporates the highest hardship standards and mandatory AFCA membership, should apply to all residentially secured lending, including small business lending. We regularly see low-income people trapped on expensive loans as mortgage prisoners. They can't switch to a better offer, sort of things that Mr. Birmingham was referencing, because of their risk profile and or their credit score. And given the lenders aware of the limited options available to the homeowner, there's limited competitive pressure to offer a lower price. Variable mortgage products, which require lenders to charge with reference to the bank's cost of debt, for example, a tracker mortgage, would reduce the so-called loyalty tax we just talked about and assist mortgage prisoners who can't switch. Australia has the capacity to be more innovative and do better for Australian homeowners to ensure that they can get access to fairer, cheaper mortgages and improve the likelihood that once they've actually broken into the housing market, they can keep their home. Thank you.
So what are the policy or legal changes that you're recommending?
So some things can be done now. So, for example, requiring standardised hardship provisions across all the lenders, particularly for residential property. That's something that could be done very quickly. It's what we refer to in our report as some of the lowest hanging fruit. We also think that tracker mortgages could be available. Those are mortgage rates that track the a certain rate, like the RBA rate, and move up and down with that. There could be changes that require variable, that offer products that are variable, but the rate may be variable, but the payment that the borrower is paying remains the same. Some of the other changes, for example, long-term fixed interest rates, that actually does require more structural change because it will require some level of government intervention.
Okay, so what about with the standardised hardship? Are you recommending that's something that is still administered by the banks under law, or is it something that's taken on by AFCA or someone else?
Look, it's a good question, Senator. Currently, there are various codes of conduct that the banks operate. So those codes require the banks to offer additional support, going beyond what they're required to do by law. But as I said, it's basically it's a lender's lottery. If you get your home loan through one of the ABA member banks, you've actually got access to the banking code of practice, which currently is kind of best in show. But beyond the banking code of practice, the protections and provisions that are offered by other lenders are lesser in many cases or virtually absent in others.
Okay, Senator Darmanin. She's got a couple of questions for you.
Okay. You did ask, just while we're waiting, you did ask if that needed to be regulated. I think that we could note that self-regulation is a privilege, and where self-regulation has not delivered standardised, good quality hardship provisions, then there's clearly a role for regulation there.
Okay, just while we find, find Senator Darman, and we might just introduce the other witnesses. So are the other witnesses online good to go? Believe so. So we've got Mr. Gruen and Mr. Hall. Okay. Well, I now welcome you to the hearing. I invite you to state your name and capacity, please.
Thank you, Senator. Andrew Hall, CEO of the Insurance Council of Australia.
Nicholas Gruen, CEO of Lateral Economics.
Okay, thank you. Do you have any opening comments you'd like to make?
Yes, Chair, if you don't mind, I've got a quick statement. I can do
Please,
that. So thank you, Chair and Senators, for the opportunity to appear here this morning. The Insurance Council represents the general insurance sector. Our members write around nearly 90% of premium in Australia. Last year, our members paid out an average of $226 million in claims every day, helping households and businesses recover from losses. Among our members are Australia's four lenders mortgage insurers, Helia, QBE, Arch and ANZ. For 60 years, LMI has helped Australians buy a home with a small deposit, and it's been backed by capital private and price to risk. Before the pandemic, 3 in 10 first home buyers used LMI to get into the market. Today, it's just 1 in 10. Across the industry, we've gone from as many as 30,000 policies a quarter to fewer than 15,000. The Australian government's 5% deposit scheme is well-intentioned, and we share its goal to help Australians into home ownership. But its recent expansion has effectively channeled billions of dollars into bidding up the price of existing homes rather than building new ones. Independent modelling we commissioned found that around 9 in 10 people using the scheme would have bought anyway. And in the very part of the market first home buyers are competing in, prices are rising faster than the savings the scheme actually delivers. The buyers hurt most are those on lower incomes. They're the ones likely to be priced out altogether or pushed towards cheaper land that too often carries the highest flood risk and the highest fire risk. That's capital churn, not capital formation. There's another risk building. Buyers who use the expanded scheme bought at record prices with just 5% deposit. As the market softens, they're the ones most exposed to negative equity and mortgage stress. That means tighter household budgets, less saving, and less resilience as the next shock arrives. The effective displacement of the private market is transferring risk onto taxpayers with exposure in the budget unquantified. None of this requires abolishing the scheme. It's our view it requires better targeting so that it supports flows to those who need it, and private capital can keep doing the job it's done for nearly 6 decades. Finally, we welcome the committee's questions on related issues in terms of national productivity, and that is our continued underinvestment in the preparedness and prevention of climate risk. Every year, skilled trades, materials and capital are being drawn into repairing and replacing flood-damaged homes, often the same properties in the same places, rather than actually adding to Australia's housing stock. Breaking that cycle by building resilience and building where it doesn't flood is one of the most practical productivity gains this country could make. Chair, we welcome your questions. And can I also introduce the two colleagues that are joining me today? I'll let them introduce themselves, but they are the authors of the economic analysis that we have done. So maybe Nicholas?
Yeah, and also I think Jean, who's been let in a little late, should also, well, you may want him to introduce himself.
Please.
So I'll ask Jean to do that, and then I'll make a couple of brief statements.
You're on mute.
Okay. Hello, Senators. Jean Tunney, Senior Associate, Lateral Economics.
Okay. I guess one of the things that I wanted to follow up Andrew's comments with was to say that when Lateral Economics took this job on, there were lots of economists who said, look, all help for first home buyers is just going to drive up prices. It's all a terrible idea. I wasn't of that view. It's certainly not perfect policy, but the idea of giving home buyers some assistance is, if it's done well, is a reasonable compromise between politics and economics, but it hasn't been done well. The way in which the scheme has pulled forward demand has meant really quite extraordinarily that it's harmed pretty much everyone except property owners, because first home buyers have found themselves paying more than they otherwise would have because of the price effect. And in fact, a small number, relatively small number of less well-off first home buyers have actually been forced out of the market. So that's a pretty poor result from a scheme that was, as Andrew has said, well-intentioned. I'll leave it there.
Okay, so what have been the price impacts, do you think, since October 1 when the scheme was changed?
Jean, do you want to say something on that?
Well, all we've got to go on really is what's been reported by Cotality. If you look at what their analysis, and they can probably speak better to this, you've got this roughly 3 percentage point difference in the property prices above and below threshold. So this is analysis that they've done based on all of their, rich data set. And, a significant part of that would be related to the 5% deposit scheme. I don't think there's any doubt about that. The proportion you could probably argue about. I mean, there could be other factors going on, but broadly, I'd say the 5% deposit scheme is the reason that you would have seen the bulk of the divergence between price growth in the affordable. The price growth above the threshold and below the threshold, much stronger below the threshold, as we expected, as we predicted in our report.
Yeah,
we had much higher. Yeah. So
the world's a complicated place, but everything that's happened is entirely consistent with the sort of outcome we suggested would occur.
And Ray White has produced similar numbers, not using a different methodology, where it shows that properties at the 25th percentile, so the cheaper properties have grown at a faster rate. So I think there is evidence out there. That's all I'd say at the moment about that. Others would be able to speak better on those impacts.
Okay. I want to ask you about the capital arbitrage issues here that you've documented in your submission. So can you just give me some worked examples of the capital treatment for an LMI loan versus a no LMI loan versus a home guarantee scheme loan?
You're talking about capital adequacy?
The capital treatment in the Insurance Council submission, yeah.
Jean, are you?
I mean, we've discussed that as one of the issues. We don't have any worked examples in the report for you. I mean, we could come back to you with that, but we don't have any to speak to at the moment. We just noted that difference in the report.
And it wasn't a report on that. We certainly noted that it was a kind of a bit of a surprise. But there were swings and roundabouts because they're very different instruments, the HGS and LMI. So, we weren't delivering a report on prudential regulation.
No, I think, Senator, maybe if I can help, I think probably, not from the work that Lateral did, but just from the Insurance Council's perspective, we've held this concern for a while now, which is that APRA has different capital treatments for the scheme loans and for LMI loans. Now, the issue is here, when APRA is looking at the prudential stability of the lenders, the reality is LMI provides them with far greater protection than what the scheme does. The scheme is only covering the 15% shortfall in the deposit. It is not covering the loan if it fails. And it's often been something that has perplexed us as to why the scheme is treated with such generosity compared to the private market scheme, which has for a very long time provided a very strong backstop for Australia's lenders, the effect of which is that, of course, that those that still use LMI for the second or third home buyers, for example, the smaller banks and the like, are faced with higher capital costs than the large banks that are using the scheme to get first home buyers in.
Okay, so effectively the position is that you express is that you get a bigger discount if you use the 5% deposit relative to using private LMI. You don't have any answers as to why that's been done, do you? It's not clear to you?
No, it's still something that we don't understand why APRA treats it that way.
Okay. And so then what about the bank, does then the bank favour using the 5% deposit scheme over LMI as a result of this or not?
Well, LMI was always useful as a level playing, something that would level the playing field, I guess, between the large and the small lenders. By making LMI more expensive or shifting the first home buyer market cohort particularly hard to the large banks, it has disadvantaged the smaller lenders who now face a higher cost product with LMI. That definitely will impact in the long run competition for the first home buyers.
So are most of the 5% deposit scheme products being issued by the major banks? Do you have any data on that?
You will find that, yes. That will be the case. We knew that was always going to be the case. When this thing was announced, we knew that it would skew it towards the large lenders.
Okay, and the capital
because they're large enough to be able to say, if we have a set of loans failing in first home buyers, we'll be able to absorb it, whereas your small lenders would need to still access the full cover that an LMI product gives them versus what the scheme gives them.
Yeah, okay. Thank you. Senator Darmanin, I think you have some questions.
Yeah, hopefully you can hear me now.
We can.
Yeah, great. Firstly, just for Mortgage Stress Victoria, I wondered if you could just take us through how increased mortgage stress has an impact on Australia's economic productivity, please.
Thank you, Senator. I'll start and then I may hand to Dr. Ralston. The problem with mortgage stress is that it has a cascading effect on families across Australia. So if you find yourself in mortgage stress, it can affect the housing market by placing additional pressure on rental, social and affordable housing. People are unable to stay on their homes, but it can reduce productivity. It can reduce productivity when people are unable to work because they've got caring responsibilities or are unwell. There's a whole range. I'm happy to take, rather than take a lot of time talking about this, I'm happy to take that on notice because we could provide some case studies for you that would show what we think highlights impacts on productivity. But Dr. Ralston, are you able to get in?
I'm not sure if you can hear me, Denise.
Yes, thanks, Deborah. I can hear you.
I'm sorry, I've not done this before.
If you could just state your name and capacity, then we'll go on with you, Dr. Ralston.
I'm Deborah Ralston, and I'm an expert witness here for the mortgage group.
Great, thank you. Go ahead, any questions?
Yes, thank you. I'm sorry, I let Denise down. I've had it terrible. It's quite difficult to get into these meetings, you know.
Sorry, the Senator Darmanin's got the call. She might have a question for you.
Okay. Yeah. So it was just I think we were just having a discussion about the link between mortgage stress and productivity, and I think we were going to get some case studies, which would be very helpful if you could provide those on notice, and whether Ms. Ralston, you had anything to add to that. in terms of the impact of mortgage stress on productivity in Australia?
Yeah, I think that the thing that is incredibly important is if we're to have a really active mortgage market and a very productive one. I'm very enthusiastic about the statements that have been made about consumer data right. That's absolutely critical. It's not only critical in lending, but it's critical for people with their superannuation funds and getting retirement planning done well. There are so many efficiencies there that would greatly improve productivity. I think also there has been some discussion about the fact that we do have a pretty competitive mortgage market, but nevertheless we've got something like 71 Australian licensed ADIs, yet about 75% of our lending is still with just 4 large banks. So I was very pleased to hear for smaller lenders there are two concerns. One is the cost of compliance to all of this regulation, and the second one is the cost of funding. And I think that there are some very good things in the report from the Consumer Policy Research Centre about the Canadian experience, where they provide securitisation for the smaller institutions so that they can get more cost-effective funding, which is, it seems to me, offers some very interesting perspectives on that. I think very important is that we make switching easier for people to get from one loan to the other. And I think that there's been a few issues. We've greatly increased regulation of lending over recent years, and things like the 3% buffer. It has done a terrific job in ensuring the stability of the mortgage sector, but when people go to switch loans, sometimes that's really quite a challenge. I know that you can make some exceptions, but they're fairly narrow on that. So consumer data right for better efficiency and productivity. It'd be good to see smaller institutions become a bit more competitive in this space. But I really support many of the comments that Denise has already made.
Thank you. And just a couple quickly for the Insurance Council. I note that in, I think, a paper or something related to the Productivity Commission's work in terms of the 5 pillars that's, I think, relevant to this inquiry. In terms of Pillar 5, you talk about supporting a national prevention investment framework that prioritises mental health prevention and early intervention to reduce healthcare costs, workplace absenteeism and insurance claims. And obviously that, is directly relevant to economic productivity in our country. I just wondered if you could, if there's anything that you see internationally here that we could learn from, or if you could just talk a bit more about what that could look like.
So, Senator, let me just make a couple of overarching comments, but I'd have to take that on notice in terms of international so that I'm better informed in my response to you. We know that mental health injury in the workplace is now running twice the rate of physical injury in the workplace. So with workers' comp schemes that we cover, we know that intervention and support to get people back to work early is critically important for good outcomes for them to keep being able to be productive, be able to make their mortgage repayments, do all those other things that can cascade on from having a mental health injury. So it is an issue that is of real concern. We see it where they're in workers' compensation, where the state-run schemes are at the moment under a lot of budgetary pressure. Interestingly enough, in Australia, we have the opportunity to compare between states because some states have state-run schemes, other states have private market schemes. Those private market schemes, while they're a little bit more expensive on the premium side, are doing a better job at getting people back to work and having lower claim rates. So we think that there is some difference there, but I'd have to take it on notice to talk about internationally, and it could be something that I'm sure when we have a look in overseas markets, particularly out of London, out of Lloyd's and those places that, and the reinsurers, they will have a view that we could probably help the committee with.
Thank you. And I understand I missed it due to tech problems, but in your opening statement, I think you talked about the challenges around natural disaster and climate change. I wonder if you could talk a bit about the sort of workforce relationship in recovery. And again, I think going to Pillar 4 and some of the previous work that you've done, you talk about removing unnecessary licensing barriers and that could reduce recruitment timeframes in order to improve labour mobility during disaster recovery. So just unpack that a bit more in terms of case studies and how this is relevant to what we're talking about today, particularly I guess around rebuild of housing and the like.
Yeah, absolutely. So a lot of this came to light, particularly in 2022, when we had Australia's largest insured loss event, which were the floods. And we actually had 5 events over the course of that year down the East Coast. What we saw was a massive drain on the supply of labour for the rebuild effort that was required. And I think we've been playing catch up still ever since. I'm just preempting here, but our annual catastrophe analysis report will come out in the next few weeks, which looks back on the last financial year at the cost of nat cats to the Australian economy and the insurance industry. It is a fair bet to say we are spending more time and more money repairing existing homes than we are building new homes in this country. And that's a legacy issue from where homes were built, the standard to which they were built and the like. But the fact is it's taking longer to rebuild them. It's becoming more expensive to rebuild them. All that is flowing through to the cost of home insurance premiums. We do have a skills crisis when it comes to builders and tradespeople in this country. We are very concerned about the coming 5 or 6 years where Queensland has to build major infrastructure to host the Olympic Games in Brisbane. Queensland's a source of 60% of all natural disasters. We know there will be a knock-on effect there to accessing trades and skills when we will need them, when events happen, not if they happen, up and around Queensland and into the Northern Rivers in New South Wales. So it really is a question now. We tested this in 2022 where we got relief from a number of the states around recognising skills and trades to enable mobility across borders quickly, so that if we needed to get a cohort of 30 or 40 electricians into an area that had been flooded to do the immediate electrical checks, we were able to do that, and we were bringing people across from WA then. But it is a case that the system of trade registration nationally, we should be thinking about this from a national mindset, number one. Number two, our immigration scheme desperately needs to be hardened up when it comes to skilled migration. We're only filling half the spots we need for the builders and tradespeople we need that are available in the migration scheme. So really, the country should only be letting in first those people with the building skills that they've got before we then add to the population elsewhere. Otherwise, we're just chasing our tail. And the problem for the insurance sector is we're rebuilding homes that are already existing, which is not a productive. The most expensive home is a home you've got to rebuild 3 times in 20 years, and we're only adding to the cost of that. We're not adding it to it in a productive way. So I think the system's got to be thought of in a more holistic sense, both the trade pathways through TAFE, the ability to leave at year 10 and do a properly supported trade and the like. These are all things that we work hand in glove with the builders on and support them, and not, very much so in trying to get that up and running. But it's a wicked public policy challenge. You've got to get the federal, states, governments all lined up on this.
Thank you. And just quickly and finally, and you may have covered it in your opening statement, so if so, I can catch up on the transcript. But I guess related to that point that you just made around building of existing homes rather than new ones, from the perspective, I guess, climate planning, what's the importance of, rigorous climate planning in maintaining productivity, particularly, I guess, as it's related to housing, but, reducing the economic costs that are associated with the risks?
Yeah, well, it's one of the things that we've talked about for a number of years now. There is no central natural hazard database in Australia that a consumer can access and understand before they buy their house. Quite often, the first indication they've got that they've bought a house with a high peril exposure is when they go and get an insurance quote, and they either get a very expensive quote or the insurer refuses to offer them cover, full stop. We think that Australia now, and particularly as AI is accelerating this, and we talk, and I've heard the discussion today about the consumer data right. One of the downsides of the consumer data right, quite frankly, is that it's going to accelerate individualisation of data, and in an insurance sense, that completely erodes the community pooling effect that insurance has. In other words, homes that are in high peril risk locations with people with low incomes and the like are probably going to be those that are going to be left with no insurance cover into the future. So what we need to do for those people is find ways to reduce the risk. If you can get rid of the risk in the first place, the market starts to function in a much more normal way. So the highest risk areas that we've got in Australia when it comes to where homes are built is flood. We do have a challenge with cyclone, although we have a cyclone pool now. We do have a big challenge with bushfire, but we do have very good building standards now that when a home is destroyed through a bushfire, it's built back to a flame zone standard, and it's likely to withstand future bushfire events. The problem with flood is that we just build the same house back in the same location with the idea that it's never going to happen again, and we put in the carpet and we put in the electronics and all that sort of thing, and then we turn around. As we've seen, for example, in Port Macquarie, I have one insurer that's replaced the same house now 3 times in 5 years. So flood is our biggest problem. In Australia, we have about 220,000 homes that were built in the wrong location. Compare that to the United Kingdom. They've got the same amount of homes, but that's on a consumer base of about 65 million people compared to ours. So we've got a disproportionately high problem when it comes to dealing with our flood homes in this country, and all of that has a knock-on effect to the productivity in this country. And I think probably finally, we've got to empower local communities to come up with the solutions. I don't say this, when I talk about a natural peril database and that sort of thing. Once we do know where the risks are and we can help people, we actually have to give those local communities the power to make their own decisions. So whether you're in Rochester or Lismore or wherever, you've got to decide what's right for your community. It can't be Canberra telling you you've got to move house. It's got to be the local community deciding, do we build a flood levy, do we raise homes, or what do we need to do?
Great. Thanks so much. Thanks, Chair.
Thanks very much. Thanks very much for being there. You go with our best wishes. And we now move to our next witnesses before lunch, which is the Inco Link and ACIRT. I understand the information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. Can you please state your names and capacity in which you appear?
My name is Dacia Bennett. Sorry, who's going first?
You go.
My name is Dacia Bennett and I appear on behalf of the Australian Construction Industry Redundancy Trust, ACIRT, and I am their Chief Executive Officer. Thank you.
Thank you, Dacia. My name is Matthew Toner. I'm the CEO of Incolink and I appear on the behalf of Incolink.
Okay, do you have a brief opening comment?
Yes, I do. Thank you, Chair. Incolink is Australia's largest provider of severance benefits and income protection insurance in the commercial building and construction industry. Incolink provides security of redundancy payments, portable sick leave insurance, and income protection insurance. We provide direct distributions to our worker members, comprehensive health and wellbeing services, and invest significantly in industry training and OHS programs, all with earnings made from prudent investments. Incolink has $1.5 billion in funds under management and over 55,000 actively contributing members, both workers and employers, and is an established example of addressing structural labour market risks through effective collaboration between employers, workers, and their representatives. Inklink is one of several other employee entitlement schemes that exist to address structural issues in construction and adjacent industries. Schemes such as Inklink have become a necessity within the building and construction sector due to the prevalence of project-based work, fluctuating demand, and frequent worker transitions between employers. Continuity of employment is often limited, with the sector consistently featuring one of the highest rates of job mobility of any industry, and an insolvency occurrence rate that represents 24% of all insolvencies. Australia's unemployment benefit replacement rate, which is only 41% of the minimum wage, causes a systemic reliance on redundancy pay to keep workers financially afloat. Employee entitlement schemes exist to respond to this structural reality. Rather than the entitlement sitting with an employer, employers contribute to the scheme on the worker's behalf as required under the relevant industrial instrument. Because the entitlement is held independently of any one employer, it remains portable as workers move between employers and secure if an employer becomes insolvent. In the 2024-25 financial year, Inklink paid out $230 million in redundancy claims alone, providing much needed financial security to our worker members. At almost 96% of the federal entitlements guarantee, our fund delivers financial security on a comparable scale. It also minimises knock-on impacts on the social security system and other adverse economic impacts associated with unemployment, all while ensuring that critical skills are retained in an industry that sorely needs them. Member entitlements are held in trust and invested prudently, with board-mandated capital adequacy targets protecting all funds. In addition, new requirements to hold Australian Financial Services licence and comply with regulatory obligations will provide further confidence in the protection of member entitlements. The returns generated from member entitlements held on trust are reinvested into the workforce and the industry, strengthening workforce capability, improving safety outcomes, and delivering productivity benefits for employers. The building and construction industry's experience with employee entitlement schemes demonstrates that structural, industry-led responses to labour market risk can lift productivity without imposing new public costs. Inklink welcomes the opportunity to provide further evidence to the committee and to discuss how portable entitlement models might inform the committee's recommendations on national settlement strategy and priority opportunities for productivity growth in the construction industry and beyond.
Thanks, Mr. Toner. Ms. Bennett, do you have any comments to make, or are we happy to go to questions?
Just very quickly, just a brief overview of ACIRT. The Australian Construction Industry Redundancy Trust was established in 1994, as Matthew outlined, to protect redundancy entitlements for workers in the construction industry. For more than 30 years, ACIRT has operated as a recognised workers' entitlement scheme across Australia and has built a strong reputation across the construction industry. Its governance model is jointly overseen by employer representation and union representation, and this brings a balanced oversight and supports decision-making in the interests of workers and employers. Our board representation is drawn from a wide range of national and state-based stakeholders. The representative structure, together with ACIRT's profits to members philosophy, has enabled the organisation to remain focused on delivering fair, sustainable and member-centric outcomes for more than 30 plus years. ACIRT has 90,000 members and we invest approximately $800,000 million on behalf of members annually. ACIRT's core benefit is to pay benefits to members when their employment ends due to redundancy. The fund does offer a range of other member benefits and ancillary benefits. ACIRT, as a profits to member fund, has paid an annual member distribution since the fund's inception for over 30 years. ACIRT does not pay a dividend or distribution to any shareholders and firmly believes that members' funds earned on investments above the costs of running the fund should be used to benefit the member via an annual distribution. Over the last, in 2025, we paid out $190 million in claims and $30 million annual distribution to members. ACERT strongly supports transparent governance and the new ASIC licensing framework. In regards to the construction industry productivity, ACERT does not deliver construction productivity programs directly. It contributes indirectly by providing, as Matthew spoke, a redundancy safety net and other member ancillary benefits like health and wellbeing programs. ACERT supports a stable and mobile workforce in a project-based industry. This helps workers move between projects and employers with greater financial security, supporting the workforce across the construction industry. ACERT believes that workforce retention can be a productivity lever, but I'm happy to take any questions from the committee.
Thank you very much for being there. So how much is in each of these funds at the moment?
So we have $1.5 billion under management, and we have a service level agreement with another organisation to the tune of $75 million.
Okay.
And ACERT, Senator, invests over $800 million, considerable amounts of money.
Okay. So how much are the premiums that the contributors pay on average?
So I'll take, Matthew, you probably have got other ways of answering that question because you offer insurance at this stage. But ACERT, we do not pay members a fee, a record-keeping fee. And what ACERT does is all profits go to members. We collect their money, we invest that money, we take the basic costs of the fund out of those investments, and each year for 30 years, all profits after that are paid as a distribution to members in November direct into their bank account.
So my question is, how much are the premiums that the employers pay?
So, Senator, thank you for that question. The answer to that question is quite complex. So income protection and redundancy contributions are features of enterprise bargaining agreements. Inklink operates in Victoria, Tasmania, South Australia, and New South Wales. And in each of those states, and depending on who the employer and the employees are, there are various types of insurance contribution rates because there's various types of insurance coverage, and there are variances between the redundancy rate that is collected depending on what is stated in the enterprise agreement.
So what's the average?
I don't have that detail on me currently, but I'm happy to provide that to the committee on notice.
Is that the same for you, Ms. Bennett?
Yes, there is a range, but also ACERT is included in awards. The award nominates a weekly payment, and I'd have to take that on notice, but it is around approximately $50, but I would take that on notice to get that exact figure to you. And in enterprise bargaining agreements, ranges from project to project, from state to state. ACERT has coverage in New South Wales, Queensland, Western Australia, South Australia and Tasmania. And it's a different range depending on which level of tiered enterprise agreement, Senator.
Okay, so the builder or the employer pays a premium. You manage the funds. You've got a couple of billion bucks between you, and you make payments to the employees under certain circumstances if they're injured or if there are other things that happen. That's a fair summary of the schemes.
Yes, I would say that is a fair summary of the schemes.
Okay. So what do you do to ensure that the premiums are as low as possible, given how expensive it is to build houses in Australia and how uneconomic it can be for builders and people in your industry to make it into a viable proposition?
Thank you, Senator, for your question. In terms of our insurance arrangements, we follow best practice, and because we're obtaining insurance on behalf of, in our example, over 55,000 actively contributing members, we use our group purchasing power to drive down and obtain the lowest rates possible for the workers and the employers in the industry. And that means that some of the results that we can achieve through that are income protection insurance. So that would cover people if they are injured or encounter an accident outside of work, where work cover insurance or transport accident insurance doesn't exist. And it means that instead of needing to come back to the workforce and risk themselves by gaining further injury by coming back too early, they're able to have some financial security and focus on their rehabilitation and return to work at the proper point in time.
Okay, and so are you mainly servicing small employers, or are big employers using you as well?
We've got some of the largest employers in the country who are members of Incolink who are contributing to us. So we've serviced the full scale of employers in the industry, whether they be head contractors that employ their workforce directly, or any number of the subcontractors that operate in the industry. And usually the subcontractors are the ones that employ the overwhelming majority of the workforce.
Okay, so then in terms of transparency, you have to publish accounts and provide all that information about your expenditure and your disbursements to ASIC, don't you?
So we're in the Incolink has been very supportive of ASIC regulating funds like ours. ASIC has announced earlier this year that we will be regulated. Previously, we had an exemption from being regulated as a managed investment scheme.
Yep.
From the 1st of September this year, we will be required to apply for an Australian Financial Services licence, and we will comply with all regulatory obligations as well as provisions of the Corporations Act that link to the managed investment provisions.
Okay. In terms of your board, so you have an equal representation style model, yeah? You have employers and you have unions.
We do have an equal representation model. We have 4 directors who are from union backgrounds or nominated by unions. We have 4 directors who are nominated by employer associations.
Yeah.
We also have an independent director and an independent chair who comprise our full board.
And do either of your organisations have the CFMEU on your boards?
Chair, yes, we do. ACERT has 14 board representation. We have a 7 member organisation representatives, and we have 7 employer representation on our board. We do have 3 CFMEU representatives on our board, 1 from the National CFMEU office, 1 from ACT office, and 1 nominated from the New South Wales office.
And Senator, in terms of Incolink, we have 3 CFMEU nominated directors on our board. Those directors we received new nominations shortly after the advent of the government-appointed administration of the CFMEU, so that administration has made 3 new appointments to our board when that took effect.
Now, what have you done to protect member funds in light of the criminal behaviour which has been well documented, undertaken by the CFMEU?
Member entitlements are held on trust and protected securely for the benefit of our members. That when a redundancy event occurs, the amount that has been contributed over the course of the employee's journey as an employee within the industry is held securely on trust. And if they qualify for the genuine redundancy, then when a redundancy trigger event occurs, every dollar that is paid in to the fund on behalf of the employer is then paid out to the employee upon the trigger event, being the redundancy.
So what obligations or what standards do the directors have to meet if they're nominated by the CFMEU? What sort of probity requirements are they subjected to?
As we move into a newly regulated environment, which some of the members of this committee will have some familiarity with, our directors will be required to meet a fit and proper person test. We're fulfilling statements of personal information for the purpose of ASIC, and we comply with all other requirements as a trustee. As a corporate trustee, we are also held to the requirements under the Corporations Act and comply with those requirements at all material times.
Okay, well, can you just provide on notice all the details of your directors in relation to their professional activities, which union, which employer group, all that sort of stuff? That's the basic information, nothing kind of private, and just your internal policies for managing conflicts of interest. And I think if you could provide that on notice, that would be very helpful. And then I'm going to hand the call to Senator Darmanin.
Thanks very much, Chair. Thanks to both of you for coming along today. I want to talk a bit about mental health in the workforce. I asked this question earlier in a different context of the ICA, but in terms of the members who work in your industry, I understand that I think construction workers face a higher rate of suicide than their peers. And obviously this, apart from the devastating toll on families and workmates and communities, presumably it does have an impact on the productivity of the workplace. So I just wondered if you could both give some reflection on that in terms of the experience of what you've seen of your members in this area. Maybe start with Incolink.
Thank you, Senator, and thank you for your question. There's no doubt that mental health is a significant detriment to the building and construction industry. It's devastating to understand that even though construction is one of the most dangerous industries to work in, workers are 6 times more likely to die by suicide than by workplace accident. And construction workers are also almost twice as likely to die by suicide as compared to other males in other industries. So understanding that these are just not statistics. These are Inklink's members. They're our family and friends of members, and they're colleagues of our members. And so Inklink has established a Blue Hats program to tackle the prevalence of mental ill health and suicide in our construction industry. And that has several facets to it, including providing mental health prevention toolboxes on site, identifying and then training Blue Hats, who are basically the first aid, mental health first aids on site, and then they are then linked up with free counselling that is provided to our members to ensure that they can get the help when they need it. We also just recently hired a mental health nurse to provide crisis support to our members. So we know that mental ill health is a problem in terms of the productivity facing the industry, but it also having devastating consequences in terms of suicide and related issues facing the industry.
Thank you. Ms. Bennett, do you have anything to add from your member's perspective?
And I agree with Matthew that mental health on site is a significant issue in the construction industry. ACERT researched all of our 90,000 members late last year, And the number one issue on site was mental health issues, followed by workplace security, and followed by they wanted financial education. But mental health was one of the biggest issues facing construction workers. ACERT works with a range of mental health specialists and organisations to proactively support a number of programs on site nationally, and we will continue to work with those organisations and put mental health at the forefront of wellbeing on work sites that we're involved in. I'm happy to take any other questions. Thank you.
Thank you. I understand that the Black Dog Institute's done some research on this, and that for every 10 there's a ratio of 10 to 1 for every $1 invested in training through increased productivity and reduced mental health related workers' comp claims. You've both talked about some of the programs that you run. Would you, I don't know if you keep any data on this or not, but from your observations, would you say that the data from the programs that you run around mental health are, a factor that keeps people in the industry, particularly when we've heard, throughout the morning already about the challenges of recruiting and keeping workers in construction, and they are so desperately needed in our country?
Senator, yes and yes. Every time that we sit down, I sat down with a meeting with an organisation called Mates in Construction last week, and the work that they do is absolutely incredible for not just for workers on site, but also for employers. Because remembering, if an incident like that happens on site, it doesn't just impact the workforce and the family, but it also impacts the employer as well. We also have been doing training for all of our client service team who talk to construction workers, because they need to be trained, because they quite often are the first people who talk to someone on the work site about a mental health issue, because they're trusted and they become very close to construction workers on site. So ACERT has been committing to put all of their client service people through a specific training with Mates in Construction to ensure that they have the ability to manage all of those issues on site, but also for them to be able to respond in an appropriate way. So it is a very, very big issue, and I would commend Mates in Construction and the likes of Foundation House and a lot of other organisations that invest time around mental health on site.
Mr. Toner, do you have anything to add?
Just in terms of Incolink, so I've got some statistics from a campaign that we run last year, because we know in the construction industry it's heavily male dominated. So over 90% of the employees are blokes. Coming with that is all sorts of stigma attached to helps, not wanting to acknowledge that there's mental health issues, not necessarily having help seeking, and there's a lot of stigma about mental health issues. Last year, Incolink invested our own campaign to encourage tradies to reach out to mental health support during the summer break, which is a difficult period for many. And over the course of that campaign, we saw an 88% increase in calls to our free counselling line. And that meant that over 440 tradies received additional help of free counselling from our trained psychologists to support their mental health through a very difficult time.
Thank you. And maybe just finally, just to move away from mental health for a minute, in my previous life, I've spent a long time advocating for portability of entitlement schemes because they reduce the loss of important skills to the industries within which they operate. I'm assuming that given the large size of funds that you both manage on behalf of your members, that these portable entitlement schemes and redundancy protections are an important part of retaining the skills in the construction, and that you see your members do actually move from job to job rather than leave the industry altogether, which is really what we want.
I totally agree, Centre. Having the redundancy safety net there is vital for workplace retention and security, and is a direct productivity lever. Just a couple of figures, 2,700 construction businesses have gone into solvency since COVID. Now, ACERT and other redundancy trusts around Australia were able to protect those members' money. And by protecting their money and being able to pay out those claims very quickly, ACERT pays out claims within 3 days for members. And being able to pay those claims out efficiently and effectively for members decreases their stress, but also gives them the ability to remain in the industry. So that's of vital importance that we go into this new ASIC environment, which I highly support. These funds are investing a large amount of members' money and holding it on trust for them. So ACERT agrees and looks forward to the strong regulatory framework and ethical behaviour of the industry so that we can continue to provide these type of claims and support for members going forward.
Thank you.
Absolutely. Totally agree with everything that Dacia has just sent. And in terms of data, I don't have that available right now, but I'm happy to provide some data. But we know it's kind of a notorious fact that all of our members who access our genuine tax-free redundancy, because of the project nature of the construction industry, a job will finish regardless of, so no one really has kind of ongoing full-time employment as they do in other industries. Once a job finishes, unless that worker has another job to go to, it is absolutely essential that they be provided with the genuine tax-free redundancy, which operates as a financial buffer to carry them through to their next job.
Thank you. I think that concludes our questions for you today. So thanks very much for joining us, and the committee will now suspend for a lunch break, and we'll be back at 1:15.
if that's possible, and already has, which is great, with the Master Builders of Australia. So basically, I understand the information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has already been provided to you. Please state your name and capacity in which you appear.
Shane Garrett, Chief Economist, Master Builders Australia.
And Melissa Byrne, National Director, Policy and Legal, Master Builders Australia.
Do you have a brief opening statement?
Yes, we do. Thank you. Chair and Senators, we thank you for the invitation to appear before the committee today. I'm Shane Garrett, Chief Economist of Master Builders Australia. Joining me is my colleague Melissa Byrne, our National Director for Policy and Legal. Unfortunately, our nation's productivity crisis is all too familiar to everyone in our industry. The amount of work done per person per hour in the construction industry is 21% lower than it was a decade ago. The result? Home buyers are now paying 44% more for a new home compared with just before the pandemic. Completing a new apartment now drags on for 33 months, a journey which used to take just 21 months a decade ago. It's not just a problem for the construction industry. Bad productivity in our industry contaminates the rest of the economy. Unaffordable housing and infrastructure erodes the buying power of people's wages and incomes. The incentives to work and innovate become diluted, making it even harder to boost living standards. Fortunately, housing finance conditions can drive real improvements here. We acknowledge federal government initiatives like the Housing Australia Future Fund and Help to Buy. But the good work being done here is at risk of being wiped out. As we sit here today, the housing market is in disarray. The federal budget imposed restrictions on negative gearing, the capital gains tax discount, and SMFF-related borrowing. The housing market has since stagnated, with real fears that housing investors will abandon housing as an investment option altogether. All this turmoil is anticipated to reduce new home building by 8,700 homes over the next 4 years, at a time when we're already not building nearly enough. Even before the federal budget, builders and developers complained that the financial case for proceeding with many new housing projects wasn't strong enough. Today, the business case is even weaker. It's vital that financial system settings are as supportive as possible to the new homes we need and the enabling infrastructure we require. With the housing market navigating such uncertainty, we need to look at how financing conditions, tax settings, and other policy measures can be harnessed to maximise new home building activity over the years ahead. Thank you for your time. We look forward to answering any questions you might have.
Well, thanks very much for being there. I'm just going to kick off with the witnesses we had before, which was IncoLink and the redundancy funds. How much do builders on average pay in premiums to these organisations?
Well, that varies depending on the enterprise bargaining arrangement. So we can take that on notice to give you some specifics, but they can be anywhere upwards from $50 to $100, I think, on average a week. But we can take that on notice and get some more specifics.
Is it a material thing, these redundancy funds? Is it something that's really adding to the cost of construction?
Well, it does, because it adds to the wages bill for the employer, because the employer is the one that pays it. So it is increasing costs, but it's just one aspect of factors that are increasing costs for the industry.
But is it a cultural thing, or is it something that is still required today? That it just strikes me as peculiar that a large employer would be using these funds. I understand why a smaller one might want to use a pooled arrangement or get access to pooled insurance, but for a large employer, they should have enough purchasing power to be able to buy their own insurances and the like. So, is the current system working well?
Well, these funds are a unique creature of the underlying modern award, which sets up a redundancy arrangement which is specific to the industry, which requires payment of redundancy in any instance of the end of employment, including resignation. So as a result of that, there is, in some instances, a desire to put aside funds to support and comply with those arrangements.
So is it an efficient process? Is it an inexpensive and productive way to do this?
I think it adds costs, like we were talking about. So if adding costs results in less productivity and less efficiency, then we would say it is inefficient. But for some in the industry, it serves a purpose of compliance and ensuring that those entitlements are paid when they're due.
So is it effectively a mandatory thing because it's built into the awards and the agreements?
Well, it's mandatory to pay the redundancy. How you factor that in is ultimately a choice for the employer.
Right. And do you think the premiums are too high?
Well, it comes down to the enterprise bargain that's entered into. As I said, the current arrangements, the amounts vary, but they are not insignificant. And so it's like I said, I can provide the details on notice, but they do vary and they are a creature of the enterprise bargaining system.
Okay, so how could that system be improved?
Well, we're already seeing moves in that direction through the Queensland Commission of Inquiry. They've released some recommendations that include some suggestions akin to a building code. And in that documentation, there are suggestions around how contributions to these funds could be managed and how they could be negotiated for a better outcome for everybody.
Okay. What are the ideas you like there?
That is a result of a genuine bargain. At the moment, what we see is the patent agreements, which just roll out the same amounts and conditions across the industry. What is being recommended are, as I said, some genuine agreements that take into consideration productivity, as well as worker wages and entitlements.
Okay, and that framework's been articulated in a draft report, has it, of the Queensland process?
Yes, there's some draft recommendations from the Commission of Inquiry.
Okay, and you think that those could be a big improvement?
Yes, we do.
Okay. I want to ask you about the impact of foreign taxes in the Australian housing system. I mean, do you think that these often state-levied taxes on foreigners are helping or hindering the housing system?
Hindering, absolutely. We need demand for new homes in our market, and when people put taxes on foreign buyers, it muffles the demand in our market and it leads to fewer new homes getting built. So if you look at markets like Sydney, if you look at markets like Melbourne, on kind of a typical priced house, if you're talking about the foreign investor stamp duty surcharge, you'll be paying well into the six figures just for stamp duty when you buy a new home if you're a foreign investor. And obviously that means less money into the pockets of the building industry. And what it generally does is it just means that foreign investors don't bother buying in those places. And it prevents and obstructs new homes from getting built. So I would say that those taxes are negative. I can understand, I think they do have some justification when it comes to the established housing market, but when it comes to building new homes, they're counterproductive. Look back a decade, you'll see that there was a much freer flow of foreign investor money into Australia. Cities like Sydney and Melbourne produced huge amounts of higher density homes back 2015, 2016, 2017, all driven, well, not all driven, a substantial portion driven by demand from foreign investors. And they since introduced these surcharges, and it has depressed the ability of our industry to generate new homes in those places when we need them so badly at the moment.
Is Victoria the worst?
It isn't. Sydney and Victoria are joint worst, if you want to look at it that way. The states, the specific amounts paid for in each capital vary. The surcharges, I think, are very high in both New South Wales, Victoria, and I think Queensland. They're lesser in some other jurisdictions. I'll get you the precise details of this. And then in the ACT and the Northern Territory, they don't actually have foreign investor stamp duty surcharges at all, which is, I think, to their advantage in terms of trying to attract foreign capital in. They've got a much nicer tax selling line or selling point than other parts of the country does.
If you could provide that on notice, that would be very
sure.
helpful. I want to take you to the National Construction Code. So there's been a number of inquiries and processes looking at this. Effectively, if we wanted to get back to a pretty bare-bones structure, have you given any thought as to how we could do that in detail, effectively going back to a much earlier iteration and having the additional components as add-ons?
Yeah, we've given that a lot of thought, Senator, and really for us it comes down to making sure the code is fit for purpose and true to its scope. So ensuring the code is targeted at providing safe, quality buildings and not letting that leach out into other areas that might be dealt with better through, for example, planning regimes. So
it could be an anchor with a bunch of links.
Essentially, as long as I suppose there was certainty around scope, as I said, that there were sort of quite bright lines around how that would work, but certainly looking towards really a national construction code as the foundation for minimum standards, and then anything additional to that, state-based planning regimes could deal with that in a better way.
Okay. And what do you think would be the benefit of that approach?
Well, the benefit would be certainty and consistency.
But wouldn't it also guarantee there's not going to be scope creep on what the minimum viable product is?
Well, if you get the scope clear, which, as I said, we feel there's some work to do in that space, then everyone would be on the same page about what was appropriate to include in the code and what was not, and then everyone moves forward on the same page.
So we're talking about a building code that protects for safety, flood and fire, effectively.
The minimum standards to build safe, quality buildings, yeah.
Yeah. Okay. So if we could get that on notice from you, that'd be very helpful.
Sure.
What you think that would look like.
Yep.
Then I wanted to ask you about the accreditation scheme within the Federal Safety Commission. Do you know about this?
Yes.
Yeah, so it appears to me that it has its own edifice and its own quite duplicative framework above and beyond WHS and other things. What's the justification for that?
Well, look, I think that's probably a question for the government. From our perspective, our members need to comply with it if they want to receive federally funded work. So, for example, the projects being delivered through the HAF, they all require federal work health and safety accreditation. We have received grant funding to support our members secure that accreditation. It can be a costly, time-consuming process, and as you indicated, it does apply safety requirements well above the minimum work health and safety legislation across the country.
Yeah. Okay. So, So the benefit is not clear to me, other than it establishes another framework that helps certain groups lock in certain outcomes, I imagine. Have you done any analysis to show the duplication or the crossover?
Not in that level of detail, but it is quite clear from just reviewing the OFSC guidelines that it does rely on meeting the minimum standard, but then imposes additional obligations on top of that.
Yeah, it would be useful for our purposes to see any analysis you have on that.
Okay, we can think about what might be one way to explain that. I think the biggest sort of add-on, if I can describe it that way, is around the documentation of systems and processes. So under minimum work health and safety laws, there are documentation requirements, but certainly under the federal system, that is much more comprehensive.
Okay. I just finally want to ask you about this issue of, we discussed it this morning with the banking and finance types in relation to the funding of a new building and the pre-sales component. So what sort of pre-sales usually need to be met to get a building off the ground?
I think it's about 40%, Senator Bragg. And, you know, I think it's up to the bank initially, but if they get a certain minimum level of pre-sales on a new development, then the bank is willing to extend the finance. And then it's just a case of selling the remaining 60% or so either before construction has finished or after, depending on what the preference of the builder is. That's my understanding.
Okay, so in relation to the latest change that was made quite briskly in the Senate in relation to SMSFs and pre-sales, so those are now not able to participate in pre-sales where they have borrowed. I mean, most people borrow to buy new housing in Australia. So what impact do you think that might have, if any?
It'll be negative. I believe about 4,000 properties are bought every year through self-managed super funds. So it could mean that up to 4,000 homes that would have got built might not get built. It probably will be less than that, to be honest, because some of the homes bought by self-managed super funds would, of course, be established homes. But again, it is a situation it'll deprive our industry of customers that it needs at the moment when it comes to building and selling new homes.
It seems to me to be a ban on building new houses in some form.
Well, I think the effect of it will be similar to a ban on building new homes. It'll prevent some of our homes from being proceeded with that would otherwise have got the green light and got the go ahead had this restriction not been introduced.
Yeah, I think from our perspective, it's simply just another handbrake on supply. When we know we're already falling short of the Housing Accord targets, we certainly don't need more policies in place that will just put more barriers in front of delivering the homes that we need.
Okay, Senator Darmanin.
Thank you. Can you hear me?
Yes.
Yeah.
In your submission, you recommend increased resourcing so that productivity can be measured more precisely and consistently. I was just wondering if you could elaborate on this proposition and how it relates to the building sector specifically.
Yeah, so productivity, I mentioned the dreaded 21% figure earlier on in the submission. That's how much productivity has fallen right across the construction industry over the last decade or so. Now, what we don't know is we don't know what productivity actually looks like in the different sub-components of the construction industry, and there's a huge amount of variety. So we got, the big cranes and the big mining projects out in Western Australia and places on the one hand, and those figures are kind of thrown into the same soup as the figures related to the building of detached houses and higher density homes. So it's very tricky for us to get a bit more clarity on what the precise sources of our poor productivity performance is across the industry. And if there were more resources to do that, we could look at it on a sub-sector basis. We could also look at it on a geographic basis. So we don't have any construction productivity figures broken up by state and territory either. It would allow us to pinpoint the sources of the problem much more precisely and help us deal with it then. Okay.
So what you're saying is we don't actually know what the drivers are of that 21% figure that you're talking about, whether it be subsector or state. Like, we can't measure that at all. We can kind of infer it.
If you look at the figures, we just get a productivity figure for the construction industry as a whole. That's all we get. And we then have to try and figure out what might be going on. Like, for example, if you go back to, say, 2013, 2014, there was a surge in productivity in the construction industry back then, and that was a lot to do, you would think, with the mining investment boom that was happening at that time. And similarly, some of the lost productivity since then has been due to the decline of mining investment, for example. But in the absence of kind of more pinpointed figures, we can't be sure as to what the true cause of the lost productivity is. And if we did have a better idea of what it was looking like in each of the subsectors, then we would be able to prescribe more specific policy interventions.
Mm-hmm. And so what would be your kind of top recommendations when it comes to how we could improve our measurements so that we could know what to do to boost productivity?
So sorry, were you asking what the changes to the measurement are?
What would be your top recommendations in how we measure productivity so that we can then, if we don't have a measure, how can you manage something that you can't measure? So what would be your top suggestions about what we should measure and how would we do that?
Okay. Well, when we look at the industry as a whole, it measures something called gross value added, which is a very technical term, but it looks at that. It basically looks at the amount of output produced compared with the amount of inputs sort of used up or consumed in the process. So what do we want? We would love it broken down by state and territory. We'd love it by subsector, but it'd be very helpful as well for us to get better indications around things like the number of homes built per construction trades worker. We've made estimates of that internally within Master Builders Australia, but figures around how effective our labour force is amongst the different streams. You see, a lot of people who work in our construction industry, they're not on the tools, they're actually working office jobs and things like that. But it'd be very useful for us to know a little bit more about what the productivity performance is, for example, amongst tradies. It might be very helpful for us as well if we look at the productivity performance of apprentices at various stages of their training. All of those things will be useful for us.
I think just to build on that, there's some suggestions in our submission as well. So things, for example, around how long it takes for utilities to come and connect services, and also information about the speed of building approvals. They would be very helpful indicators as to the state of the productivity of the industry.
Yep, that's helpful, thank you. And so I guess similarly to that kind of measurement question, in your opening statement, you said that the cost for a new home is 44% more now than it was before the pandemic, I think. Can you give a breakdown of what is the drivers of those increased costs? Like, there's more than one input, obviously. The workforce is one, but there's also supply, regulation, etc. Do you have a more granular breakdown about what's the driver of that number?
We can sort of speculate. We can't I couldn't honestly break down that 44% and say that 12% of it is down to this, or 5% of it is down to this. But what I can say is that one of the things we've seen since the pandemic is that the time it takes to build a new home has exploded, for example. And that is something that has contributed to higher costs. But the cost, every cost component in our industry since the pandemic has moved in an unfavourable direction. So we've had building materials go up very significantly. We've had labour becoming more expensive. And then thrown into all that mix is the productivity situation, whereby the amount of work that our workers get done per hour has actually gone down over that period as well. And we've had things as well, like interest rate increases have a negative effect, obviously, on the cost of creating new homes because, financing costs. And then when you couple rising interest rates with the fact that more time is being spent to build all of the new homes that we're building, it kind of double magnifies the cost impact of that. But we're happy to provide you with more sort of detailed information about the cost components on notice, if that's helpful to you.
Yeah, that would be helpful, thank you, because I think, again, these are complex questions, and if we don't really understand the breakdown of which particular drivers, it's hard to sort of then develop, policy solutions that address the different things and, what are the key components of that. Maybe I'll leave it there because I think colleagues have questions too. Thank you.
Senator Ananda Raja.
Thanks, Chair. I just want to turn to the makeup of the construction sector and this dominance of small businesses, as well as in some cases micro businesses employing 5 people or less. It's very, very high. I mean, my AI is telling me it's over 90%. I don't know if that's accurate. Keen to hear your thoughts. But what kind of issues does that present from a capital investment perspective and a productivity perspective when you have so many small players in a sector?
Yeah, so our estimates are about 98% of the industry are small businesses. So certainly it's a massive consideration in terms of how the industry operates, reflects the nature of independent contracting arrangements in the industry, and it also reflects the nature of the multiple sort of sub-trades that are required on all sorts of building and construction projects. And so they all have to work together, they all have to work efficiently, and they all have to work to a schedule. And when those things don't pan out, that's when you see, just talking about those cost increases, that's when that starts to come into effect. But in terms of how small businesses in the industry are affected, obviously regulation and red tape is a huge impost on small business, particularly for our industry that is one of the most heavily regulated in the economy. Also, the workforce shortages obviously hit them quite squarely, and even options like skilled migration to get additional and supporting trades and workers is not a viable option for small business given the cost and time involved. So they're just a couple of examples of how things hit the small businesses in our industry more than sort of the larger, more well-resourced operators.
Is it a disincentive towards capital investment when you have such small players? I mean, how do, micro businesses, for example, or small companies with 20 or less people, employees, actually invest in the kind of capital infrastructure or technology needed in order to deliver their products more efficiently? And what sort of policy settings should we consider? Because to me, this seems extraordinarily inefficient. This entire industry seems extraordinarily inefficient that it is so heavily skewed towards these tiny, small businesses.
A lot of the time for the smaller businesses, they're structured as sole traders or partnerships. They're often family-run affairs and they rely on their family home in many cases when they want to borrow money. That's the cheapest way for them to do that. Is that an efficient way to do it? No, it's not. If you had the construction industry full of much larger firms, the capital financing option in that situation would probably be better because they could, achieve economies of scale with respect to finance. They'd have lower interest rates as well. They'd have all sorts of alternative financing options as well, like things like equity and share issues, whatever you're having. So that's one of the tricky parts in terms, I guess, we always have to be looking at supporting small businesses in every way we can. Financially, what can we do to make small businesses more robust so that their sort of borrowing capacity and their ability to borrow money cheaply can be improved? We currently have the trust issue under the microscope, whereby there are proposed tax restrictions and tax increases being applied to trusts. We reckon we got about 90,000 plus trusts within the construction industry, and that kind of structure is used by the businesses in our industry as a way of optimising their cash flow and optimising their asset protection and things like that. We have to sort of think twice about things like trusts, but we do also have to look at the ability of firms to achieve the finance capital in different ways. We can get the government to help out. The government has helped out with the instant asset write-off, for example. That is a way for companies to get the tax benefit of capital investment more quickly. We have called for it to be made permanent, which the government has very kindly helped us with and responded to. But we think that the instant asset write-off should be a good bit bigger than it is at the moment, especially for smaller businesses. And we think initiatives like that could be much more helpful to companies in our businesses, in our industry, I beg your pardon.
Do you have a number with regards to that instant asset write-off for construction in particular?
Yeah,
that it should be bigger?
Yeah, we've said 150. Yeah. Thanks, Mel. 150,000 in the past. That's a kind of a target figure. You know, it's something that could be worked towards. We're not looking for tomorrow morning or anything like that. But if it was something that was sort of phased in over time, I think would be very, very helpful. You know, for the obvious tax reasons, but also for the fact that when you're a small business, labour is your biggest constraint. And if you can get machines and equipment to do more of the work for you, like through buying something impressive and high-tech and AI consistent, you might well be able to achieve improved output or achieve cost position by doing that.
Let's go to that, because I'm just curious as to whether, and I don't know whether it's happening in Australia or in other advanced economies, whether there's any thinking going into creating a common pool of infrastructure that small builders and so on can actually tap into, a bit like a library, if you know what I mean. Is there, because I don't see, I'm just trying to come up with some pragmatic solutions to this issue. And I agree with you. Of course, we want to support small businesses, but we're also a free market economy, right? And some businesses will rise and fall based on their business. So we can't, you know, prop up all kinds of inefficiencies in any sector for that matter. But yeah, I'm interested to know whether there's any thinking going around on common pool infrastructure or common purpose infrastructure.
So would this be housing enabling infrastructure, or are you thinking about it
construction more broadly?
Okay.
Whatever it is, whatever equipment it is that these companies would need, you think, to cut costs, because a lot of those cost pressures you highlighted earlier are not necessarily going to go away anytime soon. So I feel like there needs to be some innovation within the sector as to what kind of steps they can take to reduce costs. Yeah.
That would be helpful. I mean, if we were to pool resources, again, if you're looking at it from the perspective of a small construction business, what would it mean? It would mean probably less risk for that business, which is good, and it would also mean lower financing costs for that business, which is good as well. So any ideas or any initiatives along that line would be very welcome. I would imagine that where we're going with our industry at the moment, if you look at the sort of scope for technology to deliver better outcomes, modern methods of construction, prefabricated housing, modular construction, all of those things, if our industry is to have a sort of a big productivity bang, it's probably going to emanate from something like that over the years ahead. And that's why, you know, we welcome any additional funding or any means to make that more viable and more realistic for our firms to be able to engage with.
So can I take it from your answer that there is no current thinking going on within the sector around developing common pool infrastructure, for example?
Not that we're aware of.
No.
Is it something that your members have raised?
The focus of our members, as Shane indicated, is more around making sure that land is shovel ready. So having enabling infrastructure ready to go so that when they get in there to build the homes, there's not these roadblocks around, for example, utility connections and getting enough roads into the area. So that's really what our members are calling for, is greater support and investment in enabling infrastructure.
And just my final question, this dominance of small businesses and even micro businesses in Australia in the construction sector, is that residential construction sector, is that peculiar to Australia, or is that seen in other advanced economies as well?
I don't know for sure. I suspect it's the same in other advanced economies.
It's the nature of the trade arrangements that you need multiple different sorts of trades to facilitate building and construction work that lends itself to smaller businesses.
Sure. Okay. Thank you, Chair.
Thanks for being there today. You go with our very best wishes, and now we move to the next witness, which is the Urban Development Institute of Australia and the Urban Task Force of Australia. We get you to please state your names and capacity in which you appear.
Andrew Miner, I'm the Head of Policy and Government Relations for the Urban Development Institute of Australia.
Charles Dowd with the Urban Development Institute of Australia National, and also in a professional capacity as a builder and developer nationally across the housing spectrum, from social housing right through to owner-occupier luxury housing.
Paul Waterhouse, I'm Head of Policy at Urban Task Force Australia and currently acting CEO while Tom's overseas.
Okay, we're just looking for brief opening statements if you have them.
Okay. Would you like me to start, Senator?
Please.
Okay. Well, look, thank you very much for the opportunity again to talk to you about the housing industry. Given our two previous hearings, we'll take it as read that we continue to support the recommendations on NCC, environmental reform and removal of backlogs that we talked about previously. Importantly, however, the recent tax changes to negative gearing CGT and self-managed super fund housing ban is creating a handbrake on the market. It's in direct conflict with building the 1.2 million homes in the Housing Accord, and it's imperative that we drive more supply. If we don't drive that supply, the net impacts of the tax hikes and restrictions will be higher cost housing, accelerated rentals and less supply built per annum. Now, in order to make the buildings more affordable for Middle Australia, we also need to make sure that the industry is viable to supply that housing at higher rates to meet those needs. Government taxes and charges are up to 42% of the cost of a home, and environmental and planning approvals can take years. Construction finance is significantly harder to obtain for housing supply than mortgage finance for housing demand. Now, that's a function of risks to the investor, to the lender, and there is some work being done at state level on pre-sale finance guarantees, which we definitely support. However, in relation to all of this, what we're really talking about moving forward is, number one, all governments should be driving faster, cost-effective planning. And the federal government can use existing federal funding incentives to halve planning times, for instance, upfront bonuses for housing construction certificates, more code-based and state-assessed planning, and ensuring that there are as-of-right or code-assessable density and height increases. Secondly, removing all federal and state territory taxes to reduce the burden on, reviewing, not removing, reduce the burden on property prices rather than merely swapping one tax for another. So this is actual reductions in property taxes and charges, as well as potentially broadening out the base, taking into account critical consumer needs and reducing development fees, charges, reducing stamp duty thresholds. And then actually reviewing what's happened with negative gearing CGT and SMS housing ban to ensure that we do actually drive supply of long-term rental that is affordable. Thirdly, we want to be focusing on boosting housing supply through broader federal and state initiatives for medium-priced housing to the benefit of all Australians. MMC should be supported by further seed funding to set up off-site manufacturing in Australia to deal with logistics. And we need to ensure that housing prerequisites for federal funding contributions are put in place, like, for instance, publishing data sets of performance on things like planning, environment, and tracking infrastructure. And a lot of this can also be done by implementation of KPIs and metrics across government agencies that impact housing, so that they can include housing targets and affordability measures across the board for planning, infrastructure and environment. I'll leave it there for the moment, and we'll leave the rest to questions.
Thanks. Does the Urban Task Force Australia have anything to say? You're on mute, so you won't be able to hear anything. Well, we won't be able to hear you, even if you do have anything to say.
Sorry, I didn't realise I was still on mute. Thank you for the opportunity to address here. We appreciate your efforts to investigate the impediments to housing delivery that are currently contributing to the housing supply crisis. Unfortunately, governments at all levels talk frequently about the need for more housing without addressing the barriers that they themselves have often created, albeit with well-meaning intent. Too often, the revenue associated with fees, taxes and charges on a property, a burden that adds 35 to 40% to the cost of a dwelling, are too great a prize for treasuries to ignore. But to solve the current crisis, at least to some extent, they must. Similarly, those that regulate planning and building construction must also ease their grip on their beloved rules and regulations to increase productivity and increase supply. Ultimately, every intervention, every new piece of red or green tape contributes to making projects unfeasible. They all add to the cost of construction. If housing projects are not feasible, they will not be built, and the consequences are many. Supply drops, prices increase, government revenue declines, social licence evaporates, and we have a crisis that's even worse. One area where the states have added to the burden is through the placement of a tax on housing development in the form of affordable housing contributions. These euphemistically titled contributions, they're a tax on housing supply, actually add to the cost of housing for new home buyers. They make the problem worse. Given the current affordability crisis, we support government investment in affordable and social housing. We support the HAF. Government investment in affordable homes, even better if done in concert with private sector developments, helps to solve the problem. In contrast, we did not support governments adding to the cost of new housing by targeting new home buyers with contributions to pay for a problem that has evolved over decades as a result of planners failing to oversee sufficient housing supply. This is just one case of state and government policy that works against housing. Our submission highlights many more. Another example of a counterintuitive policy prescription is where many of these state and local fees and taxes are levied prior to the issue of a construction certificate, before the bulk of the revenue for a sale has been received, rather than at the occupation certificate stage when the sale and process for that sale have come in. We welcome housing productivity boosting initiatives such as declaring growth centres, facilitating fast-track rezoning and supporting more state government-led merit-based assessment through mechanisms like the New South Wales Housing Delivery Authority. But housing enabling infrastructure is essential if many of these projects are to get off the ground, and even more Commonwealth support is urgently needed. In its absence, state or local authorities have to cover the cost of infrastructure, leading to more financial pressure being placed on the housing sector to fund it. And so the non-feasibility and non-supply cycle continues. In an economic climate of 3 interest rate rises, international conflict, and a federal budget that has knocked confidence out of the property development sector, and where construction costs are also increasing, the focus on all forms of productivity improvement, no matter the source, is welcome. Thank you.
Okay, thank you. Firstly, do you have any views about redundancy funds?
I'm sorry, I'm not quite sure what you mean by redundancy fund, Senator.
Okay, that's fine. What about the idea of the National Construction Code, which we have canvassed in the past with you? If you're going to have it focused on just safety, flood and fire, just the basics, what's the best way to do that?
I'm happy to start with that. So we provided quite an extensive submission after Tom appeared at the last inquiry, going through some of these things. I think partly a lot of it is structural. I think there are 100 pages of tables of content, for example, in a 937-page document. There are also lots of sections where you've got explanatory notes on top of explanatory notes or on top of definitions, which need to be reviewed. But I think part of it would be... to be honest, I think there's a fair bit that needs to be a bit of a root and branch review of it. Obviously, safety and amenity are important issues. It really needs to go back to what its focus was in the 90s when it was trying to cover those essential parts of construction, but also simplifying it so that if you're building a certain building type, you've actually got all the information there. You're not having to wade through a whole lot of information that's not relevant to the type of construction you're pursuing in order to find what you need to do. So I think there's some structural issues or some structural elements that could benefit from a bit of investigation and further streamlining.
So effectively, the proposition would be, I'll get your take on this too, urban development.
Yeah, national.
Is that the proposition is that there would be a basic sort of minimum set of standards, and then everything else is you add on as you wish. That's through a link. So if you want to do something above and beyond, then you just you go to the next link that takes you to that book.
Yeah, so certainly that would be helpful. I think there also needs to be a return to more rigorous cost-benefit analyses so that we're not just ending up with standards being adopted without the proper costing being done.
There's no doubt the process has been poor. I guess I'm trying to pivot this debate now into what actually could it look like. So we might take your view on that Urban Development Task Force. Sorry, Urban Development Institute.
UDIA National,
yeah,
probably,
thanks.
Senator. We struggle with it too, don't worry. Look, in very, very simple terms, we have got 2,000 pages. It is a patchwork quilt of everything that people would need, as well as things that they would, like to have. So the simplest way is we work out what it is that means there is a good standard construction of the building, and that means, safety, that means, structural codes, etc. And then we simply go through all of it, identify which are actually related to building that good house and which are, more importantly, best practice or they are nice to haves, or things that you would do that are not specific to a general build, but to a very highly specialised build. And what you do is you take all of those out and you put them into guidelines and codes on the idea that you give people a guide on how best to make it look, but you give everyone a break and you give them a standard. That means you've got a good quality house, which can be either no frills or more frills, depending on who you're selling to. And the price point will determine how that's received by the market.
Yeah, so I think we had that on notice from you last time. So assume you don't have any additional thoughts, so we'll refer back to that body of work that we have from you. New South Wales have put out a patent book of basic designs. How do you think that's going, and is that something that could be adopted more broadly?
Actually, on that, Senator, I have Charlie here, and he's intimately involved with this, so it might be good to hear from the coalface.
Yeah, Senator, we've seen it, we've investigated it. We're doing some work with the state government in New South Wales, and they are certainly very supportive and looking to get approvals on their own land to do it. It's something that we think is great. You know, anything that reduces the time in planning, particularly in New South Wales, is going to be welcomed. We would like to see it being applied more broadly and more flexibly, perhaps, because, as you know, with New South Wales in particular, and even across the country, there's lots of jurisdictions that they all have their nuances in their planning systems, and you've also got very different subdivision patterns as well across the country. And what that means is that, unfortunately, one size doesn't fit all. As much as we try and make it that way, it would be great to see a bit more flexibility in that patent book approach.
The additional thing we would add to that, Senator, is in relation to patent books, if you've got a difficult site, Sydney in particular has this problem where you have areas that aren't a large piece of land, or they're narrow, or they're odd in some way, the patent book doesn't necessarily help you. What would be useful is being able to modify those patent books within a standard way and still be able to use it in a as of right or a code accessible approach, so that you don't lose time. And thirdly, what we would probably say you need to do is take the idea that if you've got larger developers who want to develop their own patent book, they can agree up front with the states what that patent book should look like so that they can use it moving forward. That would give you enough flexibility.
So surely it would make sense to have some basic patent books to be published adjacent to the NCC.
I think that would be correct.
Finally, on modern methods of construction, I imagine you also see that some of these standards could be encapsulated inside an NCC as well.
Yes, that's absolutely correct. The most important point, however, is that when we are actually redoing the NCC codes, we don't necessarily assume that it's all traditional build, so that it actually does accommodate the modern methods of construction. I think also one of the important points about modern methods of construction is it is so time consuming, and I'll get Charlie to talk about this as well, but it is one of those things which has to be able to survive a cycle. We're talking about industry at the moment. It's a cottage industry building cottages. We need to move to a manufacturing base. The manufacturing base is more like a James Hardie than it is a particular developer. And you need to be able to build within across cycles, because while it's easy enough to manufacture at a time when the market's doing well, when the market downturns in one area, you have to be able to pivot to other areas. So it has to be at least nationwide, if not international. And what that also means is that you need somebody who is prepared to provide to all people, effectively white label. So we think that seed funding is something that federal as well as state governments should do in order to get these manufacturing bases up and running, because one of the largest costs that kill modern methods of construction, especially in things like prefabricated or modular, is the logistics cost of getting it to site. So the shorter the distances, the more appropriate it becomes. But I think, Charlie, you got more to say.
Yeah, Senator, I'll circle back and tie it to the NCC question as well. And my comment is, in order to get MMC up and running and scalable, you need certainty and you need volume. the certainty will only come if you have a baseline in terms of the NCC and what it is that you can produce that will, for the next 10, 15, 20 years, be able to be used in projects. It takes 2-3 years to develop prototypes and then to obviously to go through the regulatory processes, then to start the manufacturing. The cycle for actually doing something meaningful is probably somewhere between 7 and 10 years. And we would need a baseline or an NCC freeze, if you like, to be able to explore that. The other thing that we would need, I think, as an industry, as Andrew said, we are a cottage industry. There isn't sort of one, Coca-Cola or Apple who's producing a product and can just distribute that product. And what that means is that the industry really needs certainty of volume as well. And in order for us to have certainty of volume, there's a number of things that need to happen. But certainly in the climate that we're in today, which has to a large extent sort of disincentivized investment in residential housing as it stands, it's very hard for developers to make that investment, I suppose, in MMC because they don't know where their sales might be coming from in the next X number of years.
Okay. Finally, then, I just wanted to ask you about are you involved with pre-sales on buildings?
Yes.
Yeah, so what about this SMSF thing? I mean, it seems like a bit of a crazy idea to be banning the development of more houses. What's happening with that?
So, again, I'll pass to Charlie for the coalface view, but from our point of view, the reality is it is setting apart even from the changes that were made to negative gearing by banning all housing when, the greater alignment would be allowing purchase of new housing. Where we have got data from industry, we're seeing that there's estimates of, 6,000 SMSF houses that are not going to get built because of this. So it's substantially more than Treasury. And the problem is that a lot of these SMSFs are used in the creation of projects for large apartment blocks, which means that, the pre-sales that you're talking about. And because those pre-sales disappear, you will find that projects will either be delayed or, in fact, halted in particular. So we have actually got examples where a particular developer has had to halt 2 projects that were going to come up, specifically because they sell to between 50 and 60% of their stock to SMSF. And so, you're going to see supplies go down in relation to ordinary housing.
So how many houses do you think this will cost us?
In the SMSF space, it's going to be about 6,000 a year. So we're talking about 18,000 over 3 years. But then if you look at the pre-sales on top of that, it's going to be a magnitude above that because obviously, if, for instance, there is a developer that uses 30% pre-sales and let's assume that 30% of those pre-sales are SMSF, that means that SMSF has created 1 rental property, but 2 other properties for other homeowners. So you're looking at take the number and double it again for more houses that would be delayed.
That's great. So close to 40,000 houses won't get built.
Somewhere in the vicinity of that, depending on where you're looking, but on an average, we're looking at about 18,000 a year.
Fantastic work. Okay, thank you very much. We're going to go to, let me just check, Senator Darmanin.
Thanks, Chair. I think my question has mostly been covered, but maybe if the Urban Task Force wanted to add anything, just in terms of the roadblocks to adopting modern construction methods from your perspective.
Sure.
That would be handy.
So one of the
talks about encouraging innovation.
Yeah, so certainly, as the others were saying, seed funding is very important, and I note that the New South Wales government is starting to move down that line. But planning impediments need to be removed as well. For example, the land leasing in the Sydney Basin is banned for residential construction, even though outside the Sydney Basin you can do it. That's an area where modern methods of construction would actually be very useful and would create a lot more demand for the product. I think at the moment there's a fair sort of expectation that social housing and government buildings will be used to bolster the industry, the burgeoning industry, but there actually needs to be a more organic opportunity, and that means removing the barrier. It is a viable alternative to construction for construction purposes.
Thank you. And in terms of the seed funding, can you talk a little bit more about what that would be for?
The state government seed funding. So they're looking to partner with industry to create to support manufacturing. So for companies that are already working in this space, but also for new companies that are coming in, they're looking to try and create more of an industry by putting some state government funding into it. From memory, most of that is 50-50. So it's not just handing a whole lot of money to a company that's come out of nowhere. It's actually there's a balance in terms of how much is being contributed. But the idea is to help the industry develop, which is a good thing. But again, it's great to have the manufacturing and to have the materials, but you need somewhere to be able to use it, and that's the planning is really a big impediment that needs to be addressed.
Senator, can I kindly add to that? I think there's also an exercise for the government to be involved in as it relates to banks accepting modern methods of construction of prefabricated parts, and also the insurance industry getting its head around it as well. There's I suppose, a lot of sort of barriers or obstacles that would need to be navigated on an individual basis by builders. It would be great if government took the lead on that, and then we would have certainty about the way the building would be insured, the way construction is insured, and then also making sure that the banks can lend against a product like that.
Yeah, thank you. And are there, outside of MMA, do you have thoughts on other sorts of innovation that could be encouraged in this space? That's probably Urban Task Force.
So in terms of new alternative ways of building, or in terms of
well, yes, but I mean, if you've got ideas more broadly, I think anything that can help us tackle this challenge that we have, like all ideas.
Yeah, look, I think the biggest issue from our perspective, and I said in our opening statement, is the level of fees and taxes being put onto development. That's actually creating one of the biggest hurdles, because ultimately, if you've got 35 to 40% of your the cost of your housing going to fees, to taxes, to contributions, be it local infrastructure or affordable housing or even GST, that's a big slice of what the homeowner and the home buyer is actually paying. So you're effectively costing people out of the market, which is making it harder to sell product. The problem we face as an industry, and Charlie, I'm sure, can talk to this as a practitioner, is that if you have so many things placed on the cost of the construction, it ceases to be feasible. Nobody's going to build something if they can't actually sell it for more than they built it. And ultimately, if you don't get a reasonable buffer on what you're building, you run the risk of banks starting to call in loans and foreclosing on what you're trying to do. So we're very keen to try and get a rethink on a lot of these the charges being placed on top of the construction costs, because that is actually one of the biggest impediments. Things like modern methods of construction and pattern books and all this help to deal with the cost of the construction itself as it's going on. But you've got to make all this stack up before you actually get your approval, or you're not going to be able to go to that level of construction. And so it's trying to get rid of some of those things that are being a really big hurdle that is most concerning to the sector, and is actually over the last 6 months has been harder and harder with all the extra economic pressures that have been coming into the community. It's making it even harder to get these projects to stack up, which means that if people don't have to build, they're walking away, or they're putting it on hold until it's a better time, which nobody wants to do, because then it just burns money.
No worries. Thanks, Chair.
Sorry, Senator, if we could just add one quick thing to that. Absolutely agree with what Paul has been saying in that particular circumstance. What I would also say is, with all the tax changes that we've had, we are actually now at a point where we have to drive supply. So, we were talking just earlier with Senator Bragg about the SMSF ban, and the reality is it could be up to 18,000 houses delayed or in fact stopped over 3 years. We've just got to see how that plans out. But what that basically means is if you're going to make sure that actually is going to be brought into the market by something other than, for instance, investors, you have to start supplying more housing that is actually incentivised to be at medium prices. So simply opening up, for instance, enabling infrastructure, which we are wholly supportive of to unlock supply, is going to unlock supply at existing market rates. And those existing market rates, as was already been said, are very, very difficult to meet at the moment. Charlie can certainly talk to that. The reality is we are now at a point where we are going to have to incentivise a supply of housing to Middle Australia at more affordable rates. And that's where the lion's share is going to come in. In terms of regulations and simplifying and all of these things, from a federal point of view, metrics and KPIs across any bureaucracy, state or federal, that touches housing is going to go a long way by essentially creating enlightened self-interest by all bureaucracies involved in it, where that metric and KPI is measuring what its impact is going to be on affordability and what its impact is going to be on targets. Right. That way you don't have to then be dragging people through the mud to try and get them to do something. They'll be doing it by virtue of the fact that they're incentivised by their own metrics and KPI.
Thanks. Thank you.
Thanks very much to the urban development people and task forces. Thanks for being there. Now we move to our next witness, which
Thanks,
is, thank you, the Housing Industry Association. So I understand information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. Can you please state your name and capacity in which you appear?
Simon Croft, HA Chief Executive, Industry and Policy.
Do you have an opening statement?
Yes, Senator, just a short one today. Thank you for the opportunity to appear before this inquiry again. At the previous hearing, much of the discussion focused on the National Construction Code, the NCC, and the regulatory burden imposed during the building phase of a project, which is critically important. Today, though, I would like to focus on what happens before the construction even begins. Australia's productivity challenge is increasingly being driven by complexity, fragmentation, unpredictability of the process that sits between the strategic intent and the first sod being turned. Planning, zoning, environmental approvals, infrastructure provisions, finance, taxation and insurance all influence whether a project proceeds. Yet they operate largely in isolation, administered by different organisations under multiple, often competing legislation and guided by different assumptions, priorities and timeframes. A new home, apartment building or housing estate does not move through a single development pathway. It moves through a series of disconnected gates, each adding requirements, reports, assessments, costs and uncertainty. The cumulative impact is substantial. We have examples of projects on land already zoned for housing taking more than a decade before construction commences, and where proponents have been required to obtain more than 17 separate specialist reports before approval can be secured. While every individual requirement may be justified in isolation, and we are not arguing against standards, strong safeguards are necessary, the real question is whether the system is delivering sufficient public value to justify the cost, complexity, uncertainty and delay it imposes. Productivity ultimately demands that we stop assessing individual processes in isolation and start evaluating whether their combined burden is producing better outcomes, because every delay has consequences. Extended planning approvals affect landholding costs. Environmental uncertainty impacts financing decisions. Infrastructure delays affect delivery schedules. Insurance costs increase as projects are prolonged. Tax settings, contribution regimes, and financing arrangements continue to accumulate. In other words, project feasibility is not determined by one approval, it is determined by the interaction of all approvals. Yet those interactions are rarely considered in broad policy design. Housing finance settings, infrastructure charges, insurance affordability and taxation arrangements are frequently designed independently from planning and environmental systems. The result is that governments may seek to encourage housing investment through one policy lever, while another part of the system simultaneously undermines that objective through delay, uncertainty and additional cost. This inquiry provides an opportunity to examine housing delivery as an integrated system, rather than a collection of disconnected regulatory processes. Importantly, we already have examples and evidence that improvement is possible. One example includes the Housing Approval Strike Team, established under the EPBC Act in August last year, which has been prioritising clearing a backlog of approximately 26,000 homes that have been stuck awaiting decision for years. The lesson is clear. When governments focus on bottlenecks, accountability and decision-making, approvals can be delivered faster without compromising appropriate safeguards. We should be looking to establish a more integrated approvals pathway that starts at the strategic planning stage, flows through environmental assessment and infrastructure planning, and ultimately connects to building approval processes. One effective way of achieving this is through greater use of pattern books and pre-approved pathways. If governments can identify suitable growth areas, establish strategic environmental assessments, pre-plan infrastructure requirements and develop standardised planning outcomes, much of the uncertainty can be removed before individual applications are even lodged. The concept is not new. States have increasingly been exploring pattern books. The next step is to integrate them, these initiatives into a broader end-to-end approvals framework. Imagine a future where strategic environmental issues are addressed up front. Growth areas have pre-approved infrastructure pathways. Pattern books establish accepted development forms. Building designs are pre-certified against code requirements. Proponents can access a streamlined approval pathway by selecting from approved templates. Progress can be monitored through publicly accessible real-time dashboards, and performance of approval bodies against agreed benchmarks is publicly reported and tracked. Rather than requiring every project to repeatedly prove the same outcomes, we would focus regulatory effort on genuinely novel, complex or high-risk proposals. Importantly, the technology to support this already exists. AI can today review planning controls, identify assessment requirements, validate submissions against regulatory rules, detect inconsistencies, automate routine assessments and provide applicants with real-time guidance. In many cases, AI can significantly reduce the administrative burden currently imposed on both applicants and regulators. The issue is no longer whether the technology exists. The issue is whether our regulatory frameworks are written in a way to harness this approach effectively. Too many of our approval systems were designed for a paper-based era, when information needed to move slowly between different agencies and operated largely independently. Yet we continue to layer new requirements onto those systems rather than redesigning them with an integrated approach at its core. If Australia is serious about lifting productivity, increasing housing supply and delivering infrastructure at the scale required, we need to think differently. While planning, zoning and many infrastructure functions sit within state, territory and local governments, federal leadership remains critical. The Commonwealth has the ability to drive reform through the EPBC process, infrastructure funding agreements, national digital standards, NCC modernisation, AI-enabled regulatory modernisation, intergovernmental agreements and targeted incentive funding. This inquiry presents a rare opportunity to move beyond identifying, reforming individual processes and instead focus on the performance of the housing system as a whole. Continuing to tackle bottlenecks one at a time will simply shift the delay from one stage of the process to another. But if we redesign the system end-to-end, we can materially improve productivity, accelerate housing supply and strengthen Australia's economic performance. Finally, the question is not whether this reform is necessary. It is the capacity, buy-in and drive to make it happen and embed it for the long term. Thank you, and I look forward to contributing to this important inquiry.
So to start with, it sounds like you think the patent book idea is a good idea, but it should be expanded and it should be sitting alongside the construction code.
Absolutely, Senator. We think that, from all the work that's been done on the EPBC, we've got 26,000 case studies there. We've seen ones where it's been approved inside 16 days. We've seen a lot that's been approved, 700 lot in 62 days. There is case studies there in the EPBC. We've got planning case studies all over the country, and we've got the NCC. But at the moment, they're all through separate gateways, through separate regulations, and they're disconnected from each other. So we think that there is real opportunity to connect them together, and AI can already do many of these functions altogether. We just need to think about it differently rather than as a disconnected approach.
So maybe the best way for this to be progressed is just to say, well, here's your basic safety standards, and everything else is an add-on, and you refer to this or you refer to that. I mean, isn't that sort of the most simplest way to proceed?
A house is a house, no matter where you are. Yes, you might need to do different things if you're in North Queensland from a cyclonic condition or if you're in a bushfire-prone area, but it's still a house at the end of the day. So why can't...
So in a technical sense, how is that achieved?
In a technical sense, this is where I think there's federal leadership here. We've already got some New South Wales doing some patent books. We've got the EPBC, got, as I said, 26,000 case studies just there. Why can't we just be publishing them and saying, here's your reference building? For going forward, if you want to do an EPBC project, here's what we agree are the accepted benchmarks around that. There is no reason why we can't put that up and put those case studies up on a publicly available dashboard and then be able to track them through going forward. Similarly with planning around the different states and territories that are already doing it, but we're looking at it, unfortunately, through either an NCC lens or an MMC lens or through a planning lens rather than as a collective lens.
So what do you think should be published, the EPBC decisions?
Absolutely. Yep. As I said, there's all these case studies that we've just done that have shown what's possible in clearing those bottlenecks and what are accepted projects and what would be the accepted offsets for those as well.
So what is not published today you think should be?
I would like to see all of those ones where I mentioned the 16 days in Queensland, the 62-day one in Rosedale in New South Wales, those really good examples of where it's been a well-developed, well-documented, the offsets are clear, and they're therefore proponents know going in what's accepted, what's not, and they can move forward in actually putting that application forward. As I said, AI is already powering these applications in many parts of the country. We saw an example of a DA issued inside 2 days for Newcastle City Council. So
effectively, if you want to get them now, you've got to FOI them, right?
Yep.
It's not a very efficient process, is it?
No, it's not. And we've said this when the EPBC reforms were going through. Let's not lose all these fantastic case studies because we know this is complex. We know that more land that we have left is going to have environmental overlays. So why can't we lean into these ones and look at it and go, OK, if that house has been approved under the EPBC, what does it now need to do from a planning perspective or a zoning, or what's the difference? The last thing we want to see is you do this large, detailed environmental or sedimentation report, and now you've got to do it again when you get to the next stage of the process from a planning and a zoning, and then you potentially need to do another version of that when you get to the NCC and the building approval process. There's so much duplication.
Yeah. So I'm liking you to take on notice exactly the technical specs that are required for a safe house. Maybe we go back in time for that, but we just need that from you, and then the rest we can just add on as layers. I want to. Do you have a view on the redundancy funds?
I did listen to the question before, Senator. There is one that we can take on notice and provide some additional feedback on it, but we do know things like IncoLink and these portable redundancy funds are holding significant amount of money around it, but we'd like to see probably greater transparency about how they operate and how they feed into things, because it is a different part to the mix that you're sort of obliged to contribute to as part of your building and your fees that go into a new particularly multi-res apartment project.
Okay, well, if we can provide that on notice, or you can provide that on notice, that would be very helpful. Then I wanted to ask you about the foreign estate taxes on new developments. So any views on the taxes on new houses?
Yep, plenty. I don't know that many of the other submitters have also talked about this one. HA has done our groundbreaking report from 2011. We commissioned the Centre for International Economics to do a report on the taxes, fees and regulatory imposts associated with housing. And that report we've then updated in 2019 and recently did it in 2025. And that shows that 44% of a new house and land package in a greenfield estate is made up in taxes, fees and charges. In New South Wales, for instance, in a new greenfield in New South Wales, it's 49%. So for a $1.3 million home, $576,000 is made up in taxes, fees and charges before you put a shovel in the ground. And put that in context, that's the first 15 years of someone's mortgage is made up in those taxes, fees and regulatory imposts. That is both at federal, state and local government level. So it is, when we talk about housing affordability, this is the prime function of that additional cost. And a lot of that goes into development contributions, infrastructure levies and charges and the like.
What about I think I asked the master builders to provide on notice a summary of all the state foreign taxes. You might have that as well, so it would be good if we could get it from you on notice. I also wanted to ask you about the Federal Safety Commission and their duplicative accreditation scheme. Do you think that has a negative impact on productivity?
I'll probably, firstly, on your question on notice, our CIE report does break down those individual taxes and charges, so we're happy to provide that on notice, the first one, Senator. In terms of the OFSC, where you'll then have the jointly federally funded projects, particularly under the Housing Australia Future Fund arrangements, we have many members who have been unable to access projects under the rounds 1, 2 and 3 of the HAF, or the round 3 is yet to be announced, but which is many of those are highly experienced in building social community affordable homes at a state and territory level through their various builder programs or panel programs that exist. We think there is a number of reforms and improvements that could be made to the HAF and alongside those OFSC requirements. As master builders identified, there is already extensive work health and safety rules that you need to meet when running and operating a building project. Many of the OFSC requirements are more about the administration and the running of the business and the safety systems in place, which many of them are duplicated through your current work, meeting your work health and safety laws. But I would say that there is significant improvements that could be made to that one, particularly leaning into builders who are already experienced in building social community affordable homes with state and territory programs over many decades. We already are seeing that the HAF projects have been struggling, particularly in regional and remote areas of Australia, where there are builders there that are experienced in building those state programs.
Okay. What about macro-prudential settings? Do you think they're being well calibrated to support housing?
I'll just pull something up on that one, Senator. Again, this is a very important topic for HA. We often talk about regulation when we're talking about planning systems and NCC and the like, but the role of housing finance settings, particularly macro-prudential regulations, have received comparatively limited scrutiny. HA produced a report called Macro-Prudential Restrictions and Housing Supply in Australia. It's a great read, not if you're really struggling to sleep a little bit, but it is a really good read. It's really detailed, and the report examines the evolution of macro-prudential regulation in Australia and its interaction with housing finance, competition and housing outcomes. It doesn't argue that macro-prudential policy caused Australia's housing shortages, but it does argue in a market which is structurally constrained, the cumulative tightening of housing finance has reduced supply responsiveness, worsened equity and impaired efficiency. It does not call for loosening of credit, nor for the relaxation of capital standards, but it calls for a recalibration, periodic review, and a governance reform so that emergency or precautionary measures do not become permanent constraints divorced from the prevailing risk conditions. The report finds three important ways that this accumulation has occurred. The first is reduced competition in mortgage lending by compressing credit assessment. Secondly, that macroprudential restrictions have impaired efficiency by denying access to credit to borrowers who have the capacity to service a mortgage at market prices. But it has reduced housing turnover and labour mobility and further distorted the housing market. And thirdly, and most critically, the cumulative tightening of credit has significant equity limitations. Macroprudential restrictions allocate scarce housing credit by wealth rather than by repayment capacity, and households with existing assets, multiple income streams or housing equity are better able to satisfy prudential thresholds, while first home buyers and renters, despite stable incomes, are disproportionately excluded. So we've been calling for an eminent person to undertake a review of the past decade and the macroprudential regulations and restrictions that have come into place to be able to look at the system, a hands-off from the system to look at it and come up with a range of recommendations and reports that could be another one of these inquiries such as this.
Okay, thanks very much. Senator Nandaraja.
Again, I just want to ask you about the atomisation of the construction residential industry, which is heavily dominated by hundreds of thousands of small players. This, to me, seems inefficiency by design. And I was just wondering, is there, given the cost pressures on the industry, which we've heard, multiple stakeholders tell us about for months now, actually, and which don't seem to be abating, what kind of reorganisation is going on within the industry to kind of consolidate some of these players into, frankly, bigger entities?
Thanks, Senator. It's a good question. It did come up in the Productivity Commission's report, the Can We Fix It report, that did talk about the large scale of smaller players. The 98%, like Master Builders quoted before, is similar to our numbers around this one. I take a different view to others on this one. I see that the small builders and the makeup of the small businesses in our industry is one of its strengths because it's nimble, it's responsive, and we are a very large country. And we have, 1/3 of our population live outside of our cities. I was recently down in Jervis Bay in the south coast of New South Wales, and most of all the builders there are small builders building bespoke or custom homes or building specifically for clients and renovations and carports and extensions and these sort of things. So I don't see it the same way as others who see this as a weakness. I see it as a strength in terms of its ability to be able to move, the subcontractor nature of our projects. This is something that I think is a bit misunderstood in the industry, is that mobility, nimbleness that can exist already. Can they be better supported to scale up with innovation or to navigate the regulatory burdens and other things? Absolutely. But I don't see that a consolidation to have 4 big builders in the country would necessarily be a good outcome for Australia.
Okay, all right, point taken. I'm not sure I'm convinced, but nevertheless. Finally, is there any thinking going on, and I asked Master Builders about this, with regards to common purpose infrastructure or a pool of it, again, to better support all these hundreds of thousands of small players?
In a formal sense, no, in terms of that shared pooled resources, but there is work being done as some hubs and things like this, for particularly about innovation and things like this, and some case studies and examples both with government and with industry bodies working like that one to support those businesses, and also training hubs and regional hubs and the like. In terms of pooled resources, many businesses do that already, but in an informal sense. The excavator will work with the plumbing contractor, who will then work with the concreter, that will work with the builder. A house project has 21 different trades that go through it. That is pooled resources in many ways, that they have that same group of tradespeople that they work, or have a 3 sort of person team that operates in many of those sort of projects. There's also some shared resources in terms of larger plant and equipment, when you might be working across a plumbing contractor might share the excavator with the excavator company or the like. And hire companies in of themselves are shared and pooled resources. So probably not in a formal sense like you're thinking, Senator, but I think there's opportunity for hubs around this one, and also about shared learnings, which industry bodies and others already do some of that work. And there's probably the other bit that goes with that. There is a range of buyer groups that already exist as well that come to get better prices for those different builders in terms of sourcing their materials for their projects, rather than trying to go directly to one individual supplier, about going and having that buyer group capacity to be able to have that economies of scale.
Thank you, Chair. I'll hand over to Lisa.
Thank you. Just one quick one from me. One of your recommendations is that the Productivity Commission undertake a national review of the insurance cost increases over the last 5 years. Yep. I just wondered if you could talk a bit about, your perspective on the driver of these increases and how they've had an impact on productivity in housing construction.
Yes, thanks, Senator. And I do acknowledge that there's already a current Senate inquiry into small business insurance currently underway, and I think around a range of hearings, and we've got that one coming up in a couple of weeks too. But there's probably the insurance can cut across so many different areas. I know you had the Insurance Council earlier today appear from a builder's, just to be able to get their warranty insurance, which they have to obtain before they can start construction, the premium increases in that space has increased significantly over the past 5 years. In Victoria in particular, it's had excess increases on top of each other for the last 3 years. Ability to access insurance is the other one. So you have threshold levels about what insurance you can obtain before you can actually even do projects. And if you reach a limit, then it can stop you from being able to undertake more projects under that one as well. And then also risk ratings and how you do risk ratings have changed over the past period of time, particularly in New South Wales with their insurance scheme. The other side of insurance is the other piece that I'll mention is, and it's been talked about a fair bit in other inquiries, has been in relation to where you might be in a designated bushfire-prone area or a high-risk, a high-wind area or a flood area. We've seen significant underinsurance or no insurance because the premiums are so high. There has been the introduction of the reinsurance pool, which has provided a little bit of relief in that one. But a lot of the time we are finding, and I did a lot of work after the Black Summer bushfires, that many people either don't have insurance or have not enough insurance to cover what might be the building. So every time we increase our building codes and other rules in other areas, maybe well-intentioned, but that then increases what the cost to rebuild would be too. So we need to look at it without it being in a silo, looking at it as a collective. Yep.
Yeah, okay. Thank you.
Thanks very much to you, Mr. Croft. We will now suspend and return at 2 minutes to 3. him. And I'll just check that we have the witnesses. Are we looking for Modscape and Midsbots and Australian Housing Co?
Yeah, Modscape is here.
Okay, hello. Please state your name and capacity in which you appear.
Jan Gurn, founder, CEO of Modscape.
Right, thanks. Do you have an opening statement?
Yes, I do.
Before you do that, I'll just get the other person who just appeared and then disappeared to state their name and capacity in which they appear.
Tom Griffiths, Executive Director at the Australian Housing Co.
Okay, Mr. Gruen, get you to go first.
Cool. Chair and Senators, thank you for the opportunity to appear today. I am the co-founder and CEO of Modscape and Modbotics, an Australian industrialised construction business that has spent more than 20 years investing in advanced manufacturing to produce homes, schools, hospitals and social housing. Industrialised construction has the potential to transform Australia's productivity. It can deliver buildings faster, with higher quality, less waste and greater safety. And it lets us build more homes from the skilled workforce we already have at a time when industry is short tens of thousands of workers. The technology exists today. The barriers preventing scale are not technical, they are structural. There are 5. First, Australia lacks a coordinator to align stakeholders. Community housing providers, government agencies, developers, financiers, designers, manufacturers and builders work in isolation, and the manufacturer is brought in far too late, after procurement, funding and design locked in. Without coordination, delay simply moves from the construction site into the decision-making process. Second, procurement and building code remain designed for conventional construction. Government procurement rewards one-off projects rather than repeatable manufacturing, and modular is still approved building by building and recertified state by state. Late design changes, fragmented contracts and lengthy approvals undermine factory efficiency. We have world-class manufacturing capability, but we still buy as though every building were a one-off prototype. Third, finance has not kept pace with manufacturing. Construction finance recognises value as when work is completed on site, while manufacturers incur significant costs months earlier in the factory. Australia needs financing that treats manufacturing as an asset-producing process, not a construction exception. Fourth, the demand pipeline is fragmented. Manufacturers invest in automation, robotics and skilled workers when they have confidence in long-term demand. Stop-start government programs discourage the investment and prevent the industry reaching the scale that brings costs down. Finally, perception continues to hold the industry back. Modern manufactured buildings are permanent, high-quality assets that fully comply with Australian standards, yet some outdated perceptions within government still influence procurement, finance and policy decisions. Chair, Australia's housing challenge is fundamentally a productivity challenge. If government wants more homes built faster, at a lower cost, without needing a workforce we simply do not have, industrialised construction must be part of the national solution. That requires better coordination, procurement, and codes designed for manufacturing, financing that recognises factory production, a predictable long-term pipeline, and greater confidence in modern methods of construction. The industry is ready to deliver. What we need is a system that enables productivity rather than constraining it. Thank you. I look forward to your questions.
Thank you very much. Mr. Griffiths, do you have a brief statement? It disappeared again.
Sorry about that. Chair and Senators, thank you very much for having us today. We thoroughly appreciate the time and energy you're putting into this and willing to understand from an industry standpoint. Ourselves, much like Modscape, suffer 3 key critical challenges. The centralised body for modular construction that we do not have, that is separate to that of the HIA, the master builders and other traditional housing bodies, that is critical in ensuring that modular housing or manufactured housing becomes a critical supporting component to regular construction. A procurement and structural inefficiency within governments of their purchasing and how they purchase. An example of this is the fragmentation of the purchasing from state government to state government, the different rules and regulations that they all show when purchasing and putting to tender modular housing programs. And lastly, the financing, the indifference that the banks have for financing, and the fact that a modular house, which is no longer an old traditional donga as it was once known, is a permanent structure that is being manufactured in a facility and then anchored to the ground. At this stage in time, a traditional mortgage cannot pay for manufactured housing in Australia. Unfortunately, all of the funding must wait until the house lands from the factory onto the titled land, which is a fundamental challenge with manufactured housing. What it means is that the manufacturer must provide cash flow funding for 95% of the total build until the banks kick in with their mortgage funding. I reiterate the sentiment that the challenge that we have in manufactured housing supporting pre-existing construction methodologies is that of a productivity challenge born on the three critical aspects, which is the procurement, the financing, and not having a centralised body that empowers manufactured housing and treats it as a supporting infrastructure rather than a new addition to it.
Thank you. I might just pick you up on where you just finished. So just so I understand, so you're saying that there's a financing sequencing issue with the provision of the actual house?
Yeah, so if I'm speaking freely, if I'm a customer comes to us and they're using a traditional chattel mortgage, the financier will fund the in-ground works, but they won't fund any of the in-factory works until, well, CBA as an exclusion. I'll use them as an exclusion, who are far more advanced than the Big Four and any of the Tier 2 banks. But they won't fund any in-factory manufacturing until the house is physically landed and connected to the land title, because all the banks are still looking for security and the land title is being used as security.
As opposed to the building?
As opposed to the building, yeah. So the challenge in a traditional build, you pour a concrete base and then you build up from there, and therefore all of the materials are sitting on that land title. So a bank will secure of all of the materials sitting inside that land title, whereas in a manufacturing facility, I'm as an example at the moment, I'm manufacturing 28 different houses. A bank wants to have effectively a bonded facility within my manufacturing facility, so they can secure the goods and materials. So what it means is, if I'm Senator, if you're purchasing a house from me, I have to fund 95% of the construction cost until it lands out on site, of which the bank will then secure the mortgage against it and release the funds to me.
So how do you see modern, this is a question for both of you, so how do you see modern methods of construction fitting into the National Construction Code?
I'll kick off and say we build and Yarn and Modscape, who are have been at the forefront of this for the last 18 years. We build to the National Construction Code. We still have to build a compliant house, because it's in the factory, because as soon as it lands on that footings or on that site, it must be compliant. So we still build to NCC 23 as per traditional construction. We just happen to build it into a factory, stick it on a truck and transport it to site. We still have to comply to the engineering standards. And if anything, unfortunately, we have to over-comply with engineering standards, because we have to transport these, lift them up, put them on the back of a truck and then move them. So our over-investment in what we do, quite often, we spend 110% of the total cost of a build as opposed to a traditional construction, because of the compliance that we have to go through. There is currently no modular or manufactured certification or building code that we can build to. Yeah.
And Senator, I'll just add to Tom's comments there. I think it is important that any prefabricated or MMC type drilling still complies with the NCC. It's not a barrier to stop you from building off-site, but at the moment the NCC has different requirements in each state, and the certification process for something that you are building many, many times over, each project is treated individually rather than as a certified design. So it's got some optimisation. What the ABCB are doing at the moment is trying to optimise it and simplify that process.
So if we were going to have an NCC that was just focused on basic things like flood, fire and safety stuff, then how would that affect MMC?
It should be exactly the same as conventional construction. It shouldn't affect MMC.
No,
It should absolutely run parallel with.
Approach, right? It's a principles-based approach. You can use it for your old-fashioned, or you can use it for your new-fashioned.
Yeah. So a window in a building that's built off-site is identical to the window that's built on-site. They should fall under the same standard, and that should apply across the entire building.
An example, Senator, in the NCC 23 that changed, and now you have to build a 7-star. I build with a thermally broken, double glazed 5mm toughened glass window. A Metricon, who's I'm going to call it a stick builder, a traditional builder, are using exactly the same window. I don't unsubscribe from the NCC 23 because of I'm building it in a factory and they're building it on site. Same with as an example, a big change in the NCC 23 was zero fall threshold in the shower, in the bathrooms. So effectively building to the disability improved livability code. I don't get to unsubscribe from that because I'm building it in the factory. I must comply because as soon as I land that house on site, a building surveyor is going to hold me accountable to the same.
So that's fine. So if we had the current system is highly convoluted, it's like a bells and whistles approach, right? Everything's compulsory. If that was to change and you had more of a basic model, then you can build on top of that. It would still be competitively neutral from your perspective. I mean, it wouldn't make a difference. You comply with whatever it is. So that's fine. So that's not a barrier to go into this model. So then of course, if there was like a patent book, then you could just create a subscription style model around that. I mean, in your own business, right? So you could do that. And then there'd be competition around who can do it most cheaply, most efficiently, the best price, whatever. Okay, so all that makes sense. So now I guess my main question for you both is, having listened to your opening statements, is, I mean, it's a challenging thing for anyone at any tier of government to say, well, we're going to have a coordinator for this or a coordinator for that. I mean, it's not really, in our system, it's not easily done. So what I try and do is focus on, well, what are the things that the government should do? What are the things that industry should do as a collective? And then what are the things that businesses can do on their own? So I guess I ask you the same question about the former two. What are the things that you think government should do to promote MMC, and what are the things that the industry needs to do to ensure that we get more of this?
Senator, I think the key message, I guess, that in my opening statement I'm trying to get off, it's the scale and the continuous rollout of work that creates the efficiencies that would make MMC, cheaper, faster, safer, higher quality, more sustainable. And so I'll give two examples. In Queensland, we've just delivered 124 dwellings across 43 sites, 900 kilometres apart, over a 40-week period. We made a decision to design each one of those dwellings identical. So we've ended up with some projects getting a 9-star energy rating and some getting a 7. The compliance part of the picture, if we were able to certify that one design on that basis once, the speed at which we could start manufacturing would be faster. From a government point of view on the coordination side of the world, if I look at, say, New South Wales at the moment, they built 45,000 dwellings last year. They need 70,000 dwellings a year to hit the targets that they're trying to hit. So I've got a factory that's capable of delivering a dwelling every 2 hours. So I can make 4 dwellings a day, 2,000 dwellings a year. If there's a shortfall of 30,000 dwellings in New South Wales and I've got an ability to deliver 2,000 a year, why is my factory not booked by government for the next 10 years? And so that procurement process, I'm talking about 2,000 houses in a shortfall of 30,000 in a total of 75,000. The challenge is the government, and this is the case across Australia, the government actually delivers a very small percentage of housing per se themselves. So when we talk about the coordinator, it's the developer or the facilitator or the person that is actually bringing together the land, the builder, the design, the architects, consultants, and the end user on behalf of government is the piece that I believe is missing to facilitate that pipeline, to get the scale that gets you the efficient, like wild efficiencies that this sector can deliver for Australia. And it's a challenge.
And I think if I could follow on, the challenge with procurement from state government currently, and Jan and Modscape are very similar to us on the panel of Victoria. We're on the panel of New South Wales, going onto the panel on the panel of South Australia, going onto the panel of New South Wales. The challenge for us is consistency. So the wild. We've been on a panel now in one of those states for 18 months. We know there's 70 orders, and we get 30 at a time, and then we get nothing for 3 or 4 months, and then we get 30 at a time, and we get nothing for 3 or 4 months. And we've been trying to work with the state government in question on how do we we just need 10 a week. I can deliver. I can get 10 houses out a week. I can take 10 in a week. I can get 10 out a week, and I can replicate a facility every 300 kilometres throughout rural New South Wales, throughout rural South Australia, throughout rural Victoria, and then I can become a one-to-many. Any builder, to Jan's point, if we have consistency and collaboration, any builder could come up and pick up a house from me, take it away, and deliver it and go and land it on site, complete it and hand it over to a state government authority. That one-to-many that manufacturing has become in so many other industries, whether it be food, automotive, building products, anything else, our industry still suffers from, because we're still looking at it as a go to the builder. If you went to the manufacturer then filtered it out to the builders, and based off consistency, then the housing outcome would be significantly improved.
Thank you. Thank you very much, Kate. And Senator Nataraja.
Thank you, Chair. Just on the procurement side of things, which is what we've talked about just now, government is a massive procurer of goods and services, but in Australia we have this funny open system, right, where local players can get outbid by foreign nationals, multinationals, or other incumbents, shall we say. And I guess an argument we would get from government departments would be that we want to be fostering competition. So there's this tension between what you've talked about, delivering something that we vitally need at scale, cheaply and quickly, versus this issue of competition. And how would we resolve that?
Senator, we've just had this same discussion in the education space. So Victoria and New South Wales have, call it 400 kindergartens to deliver, and there's maybe 2 or 3 different designs. And so what we're saying is, if there's only 7 or 8 people in Australia that can deliver these, so why not tender 50 of the kindergartens to a provider and procure those 50 on a panel agreement or an agreed price for the works from the bottom of the module up, if you like, and then tender the site works on each site, which is invariably always different. And so if you take the same logic to housing, if that facilitator or coordinator or the government has the ability to go, well, I need all these houses or I need all these apartments, I've got social affordable guidelines and livability guidelines that they have to follow. Why can't they go and say, okay, provider, Tom, here's an order for 1,000 for the next year, 1,000 for the next year, and for the year after that it's 1,250. Then the government gets the consistency, the price benefit, and the faster delivery while separating it from the site. So to me, the discussion seems to come back. That procurement model, it's not about just pipeline. It's actually, you've got to procure the part that's manufactured under a manufacturing model. It's like you wouldn't rock up to Millet and say, I want one oven and I want you to customise it, or I want a Toyota Camry, but I want you to design it from scratch. Toyota Camry costs $25,000 because they're making thousands of them at once. And I guess that's kind of the shift, if you like, that we need to get government in procurement to get the efficiency, and they not only get the cost, they get the product output.
So this then comes to, I guess, procurement criteria and how this is set, who sets it. Sometimes I feel like the tail is wagging the dog, like government wants to do something, of course we want more housing, and we've made a big announcement, nearly 50 million for modular housing. But then we hear from you, stakeholders at the front line, that there are all kinds of procurement barriers. And then it makes me think, well, who's that coming from? Is that us, or is that the departments and the bureaucracy? And is it just institutional inertia? So I want to understand who do we need to bring forward? What do we need to do to actually unpack this issue of procurement criteria? And where is this thinking coming from?
Senator, just I guess one observation before Tom speaks. In the last 12 months, I've had 7 state ministers and 1 federal minister through our facility. At the senator level and the minister level, the thinking is spot on and the objective is spot on. As it comes down into your the policy makers or the people that are creating the policy to allow the delivery team, that's kind of where it's probably failing.
Institutional, right.
Yeah. And I mean that with all the love in the world, but yeah.
Well,
Jan is exactly right.
I don't understand this. So because we can call departments, in fact, we will be calling departments. So I need to know what questions I need to ask them.
Senator, if I may, I might just step in. We had one. We happened to be on the panel of a state government. They put 10 I'm going to call us prefabricators, modular builders, prefabricators. They put a tender out. We responded and said we can't comply with that tender because those designs don't work for modular housing. They're inefficient, and what they will do is they'll add about 55 to 60% to your build cost. So we would be non-compliant in the tender that we responded to. We didn't hear anything back. Out of the 10 on the panel, 1 person provided a submittal because there was no consultation prior to it going out, so I couldn't respond. Now, it sounds ridiculous. It was only 60 houses over 4 years. That's not enough, and please don't take this the wrong way, but 60 houses over 4 years is a rounding error on a page. When you talk to Jan, who can produce 2,000 a year, out of one facility, I can produce between 500 and 600, and I can have a facility every 400 kilometres. It doesn't matter. So when a state government comes out and says we're putting all of our energy into a trial, and says you up for grabs is 60 houses over 4 years, I can't tool up my manufacturing line for what potentially is 15 houses a year that are inefficient. And you wouldn't build, shouldn't build, because it's going to cost state government.
Okay, I'm going to ask a really dumb question now a whole series of dumb questions. How often have the bureaucrats, like the secretaries of these departments at federal and state level, come out to the building, to your factories, actually seen what you've done, gone to your pilot sites and seen what you've delivered? Because I feel that there's a huge disconnect between the intent of government and what is actually being delivered.
Senator, unless they're with the minister, they do not come.
They don't come ever. Are you serious?
Yes.
We have a housing emergency. We've put at least 50 million in the budget, or 54 million into modular housing, and you're telling me none of the senior bureaucrats have seen this in action?
No, Senator, I've invested 20s of millions of dollars into robotics and automation, and we have a state-of-the-art facility that can produce at scale, and they don't come down here separate to the ministers. They don't come down here when they're developing their policies. So the question that you should be asking...
Why, Jan? Why? Is there a rule somewhere in the public service that they're not allowed to do research?
No, I couldn't answer that, Senator. I don't know why, but that's just the reality of what's happening. So the question that you should be asking them is, what have you done to change the government's procurement policies that lend itself to obtaining MMC product at scale?
But then how can they change the government procurement policies when they've not engaged with the sector in a meaningful, hands-on way?
Yes.
Like see, touch, feel, right?
I mean, they engage with us. I've sat at more round tables in the last 3 years than ever before. But that's why, that's why I'm saying once it goes below minister or decision-making process into that policy level, it stops. Is that been your experience, Tom?
Absolutely. Yeah. It unfortunately, it gets, when it actually drops then into what, let's call it a tender preparation, there's no consultation at that level when that tender is being formalised. So I'll give an example. Many years ago, in a previous career, I was in the automotive industry. And what used to happen is state government used to go and sit down with the automotive manufacturers, whether it be Holden, Ford or Toyota, especially the local ones. And this is in 2000s up until automotive finished, and said, we need to procure, each state government would do it and say, we need to procure 20,000 cars a year or 10,000 or 5,000 or whatever else that may be. And the automotive manufacturer would then say, this is how, if you need to do that, this is how we should stage it. Stage it, give me 1,000 orders a month. I will deliver them through our dealer network. And we will ensure that you get that 50,000 cars a year delivered into your fleet. And that's how it would work. It was a multi-billion-dollar transactions going on every day. What we don't get, and if we treated our industry much like the automotive industry used to be, that would be the procurement teams coming to Yarn, myself, and the myriad of other wonderful housing manufacturers that there are around the country, and sitting down and saying, we need to deliver this. How many can you deliver? I can deliver 400. I can deliver 500. I can deliver 900. Where can you deliver them? I can deliver them to here, and here. Okay, great. Then they bring it back together and say, okay, we can now actually deliver an extra 13 or 14,000 complementary houses, not supplementary. So I think complementary and supplementary are two very, very key components to this. We can deliver that 12,000. If they sat down with Yarn and myself and a panel of 20 other modular home builders or manufactured home builders, we would all play happily in a cot together to ensure that we've got the consistency to be able to deliver to state government. Because for us, state government work is being funded traditionally not via a bank, which means that for us, we still get our normal stage payments, which means we can cycle it through. It's, from an economic standpoint, it's the most economically viable business for a modular housing company. But as soon as you get from a senator to a minister, and even at the operational level or at the CE, CO, executive director level, once it drops down into that procurement phase, it absolutely loses all of its traction, because they're the ones that don't come out and consult with industry, in my mind.
Okay, so I feel, Chair, that we need to look at how we actually get our senior public servants in the field looking at some of these innovations, because it's beyond belief to me that they're not engaging. We need to actually get them out of Canberra. The last question I have is around the National Reconstruction Fund. Have either of you engaged with the NRF on supporting your businesses or modular housing at all?
No, we haven't.
No, we haven't either. No, we much like Modscape, we're all 100% privately funded, and have really, speaking for myself, have really struggled to get any additional subsidies or grants to industrialise manufacturing in housing.
Senator, in the 20 years of operation, in year 2, we got a $50,000 R&D tax grant. Since then, we've not received any government funding support of whatsoever. And I guess we're not asking for any cash handouts either. We would prefer to see projects being delivered. And I just to give you one crazy here, we find if we're delivering a project that's got 1,000 plus modules, it's 10% cheaper at that scale than if we were to deliver 10 100 block projects. So that would give the government 100 free houses for the same order, just by ordering it in a pipeline over a rollout, rather than as these individual projects. And I know that was slightly off topic, but I think relevant.
No, I think on the topic of tender preparation, it's pretty clear that if the people writing those tender guidelines, our bureaucrats, have not engaged with the state sector, then it is reflected in poor quality tender guidelines. Correct? That by design locks out the very types of innovations that we need to crowd in.
But by design, it actually rules out most of the people who you want to be involved.
This is actually quite infuriating. Okay. Thank you very much. That's been very insightful. Thank you, Chair.
Thank you very much. You go with our very best wishes. And we will now go to our last witnesses of the day. That is the Australian Prudential Regulation Authority, the Australian Taxation Office, and our good friends at the Productivity Commission. We're all good friends, of course, because we are all working very assiduously for the taxpayer. So there are no opening statements from government agencies unless there's something you desperately want to tell us. So we've got the Productivity Commission, we've got the Tax Office online, and we've got, I think we have APRA in Canberra. Is that right?
Got APRA online here, Chair.
It's a tax office. There's two people in the tax office in the room. Thanks.
Okay. Well, look, I got a few questions, and then I'll hand over to my colleagues. So, in terms of APRA, I'm just going to fly through a few different things. So with APRA, where are you up to with your review of your macroprudential arrangements?
So the settings is what you're referring to?
Yeah, you should just say your name and branch when you start.
Sorry. Sorry, this is Marion Porter, General Manager for System Risk and Macroprudential Policies in my area. We have released in May another public update. We obviously do regularly review where the settings are appropriate. Really guided by you where you want me to go here.
Well, I mean, I guess I'm just wondering what you've got for where are you up to with the pre-sales issue?
So the pre-sales issue, that's I think not macroprudential, but maybe I'll hand over to my colleague.
Ian Becker, General Manager of Policy at APRA. This might be two things with the pre-sales centre. I think last year we confirmed, in fact, we had not provided guidance that 100% of the 100% pre-sales were required for prudent lending. What we're doing at the moment is we're consulting on 3 changes to our capital framework, which would have the effect of lowering and making risk weights, making them more risk sensitive. And one of the areas we're doing that is property development and construction. What we would be doing there is making it easier for borrowers to achieve 100% risk weight rather than 150% risk weight, because they'd only have to meet a 50% pre-sale requirement. So that's something we've proposed, and we're currently consulting on that, I think, until the end of August.
Okay. What about on the issues to do with the capital risk weights? A mortgage with LMI. The evidence we heard earlier today was that the LMI mortgage gets penalised relative to the home guarantee scheme. I imagine you're going to say that the 5% deposit scheme has a sovereign a sovereign backing, which is the reason why. Is that the reason why?
So I'm not. They're different products. I'm not sure that they get penalised. I mean, when the HGS scheme started, we agreed to give it a standardised risk weight that was equivalent to an 80% LVR loan. So that reflected the up to 15% of the value that was provided in credit enhancement under the scheme. LMI providers have argued they should get a different risk weight as a result of that, on the loans that they insure. And they've sort of said, they've written to us and said, you know, we should do this because we think it's uncompetitive to have a different arrangement, like it affects competition. Our response to them has basically been that we don't think it's a competition issue because they can't compete for free product. So what I think has basically happened is that a lot of first home buyers that are using the scheme, they're not using LMI anymore. The LMI providers have really, you know, gone into the market of upgraders and investors, and they're sort of competing with each other in that market. So we've said we'll have a look at how it evolves, but we don't think there's a competition issue now because they're basically just not competing with the scheme. You know, the scheme's a free product.
Well, I mean, the government is effectively crowding out the market.
Yeah, the government has taken that market. So in relation to that section of first home buyers, it's probably about 20% of the market. And so the LMIs are now focusing on upgraders and investors. And that's sort of, you know, it's probably they've probably lost about 20% of the addressable market, but they tell us they're still viable as a business.
But I guess the point is that if it's only covering, if they get a bigger discount for the government scheme relative to the LMI, but the LMI is covering the whole loan and the government scheme is only covering 15-20%, then it does seem like an unusual capital difference.
Yeah, I mean, it is a bit different in terms of it's a sovereign guarantee rather than not, but they're sort of different products.
Well, can you provide on notice the justification for the difference in capital treatment? That would be helpful. Now, the capital risk weights themselves, what sort of instrument is that under delegation?
It's the Prudential Standards, Senator. So that's the Prudential Standards are. Yeah. I think they're disallowable. I think banking is a disallowable instrument. So we make prudential standards under the Banking Act, and they're tabled in Parliament and subject to disallowance, presumably under the Legislative Instruments Act.
Yes, but I mean that's the whole prudential standard for capital adequacy, I imagine, or for capital management or whatever it is. It's not just, you don't just make them. You make these things in. A lot of things are covered under those instruments, aren't they?
Correct. This would be APS 112.
Yeah, which makes it challenging for Parliament if it does want to disallow something, because then it looks like you're against a whole lot of different things. You may not necessarily be. So, okay. Then we've got the issue of fraudulent loans. I'm wondering whether you have any interest in this as a prudential regulator?
Senator, yes, we are aware of those issues. We're working closely with the banks and with our peer regulators to understand that. From our interest in that is primarily from a operational risk and resilience type of lens. So we're interested in the adequacy of controls and so on at banks to make sure that they're not being the subject of fraud.
Okay, so, but I mean, in a day-to-day sense, it's not something that you're managing, is it?
We're not the lead regulator on it, no.
Well, I mean, it's fraud, right? So, yeah, I think the New South Wales Police is the lead regulator in actually investigating the cases, and we've also been working closely with AUSTRAC and ASIC on those issues. And I think our role is mainly about, given we found this, how banks can better manage this operational risk in future, and how we can work with them to strengthen their defences against this type of conduct.
So, competition's in your mandate. What are you doing to promote competition in banking, and particularly in mortgages?
So, Senator, competition is one of the balancing objectives in our mandate. Our primary mandate is around financial safety and stability. As we execute that safety and stability mandate, we endeavour to not unduly constrain competition. I'll ask Mr. Becker to talk about what we're doing in respect of the competition in the banking system.
So as you'll recall, Senator, there was a CFR review of competition in small and medium banks, and we took away a number of action items that we were going to address. Yep. I mean, I think the review basically found that the market for mortgages is pretty competitive at the moment. We took away some things we do. We said we would introduce a three-tier prudential framework for ADIs, and we've announced that. We said we would smooth the pathway for standardised banks to achieve IRB accreditation to enable them to do that more easily and to reap the benefits of it more quickly. We've announced that. We said that we'd introduce a new licensing framework that would make it easier for challenger banks to enter the market, and we're consulting on that at the moment, and that consultation finishes soon. So I think there's a number of steps we've taken, and we also proposed to government that with the appropriate safeguards, we could introduce a fourth tier of prudential regulation for the smallest banks with assets below 2 billion that would be characterised by much lower compliance costs, and that's one that's still being considered and worked on. So I think there's a number of things we've delivered already in that space, and I think if you talk to the banks, they're pretty happy with what we've done in a reasonably short period of time.
What impact do you do, or what impact analysis do you do on your various regulatory tools on housing commencements and then on the prospects of home ownership?
Senator, can I just check there? Are you talking about our macroprudential tools, or are you talking about our prudential standards?
All of it, everything you do.
I'm happy to take that. So really our focus, Senator, is really for housing credit, to constrain risk taking by banks, and also look at credit supply with our various tools. But as a financial safety regulator, our focus is really on financial risk to banks and systems. So we are really squarely focused on the risk that's building in the financial system, rather than tilting the scales in favour of one kind of borrower or another. That's not really in our mandate. Likewise, housing supply. You spoke about housing commencements. That is not something where we have tools over. That is really a matter for other people on the call maybe who can talk to that. But we're not really in that area as well as the financial safety regulator.
We will consult on every standard we make. We'll generally do quantitative impact studies where we'll seek data on the implications of the changes for lenders. But if you're looking at housing starts, they're influenced by a wide range of different factors supply and demand factors out there, and I'd suggest that the prudential settings are very small factor affecting that.
Yeah. Okay. I just want to come to the tax office to ask you a couple of questions. So, what do you think about this idea of providing some access which would involve waiving some of the secrecy rules so that we could get verification of people's information in order to facilitate competition under CDR?
Thank you, Senator Whitewood, Deputy Commissioner of International Support and Programs. We're supportive of using the data that we have to assist in appropriate cases. And we have been working together with or talking to the banks about how that might be facilitated under the CBR. My colleague Paul Baum in the room there actually has been more closely aligned to that work, so I'll pass to him to provide more detail around the work that we've been doing.
Thank you, Paul Baum, Assistant Commissioner of Policy Analysis and Legislation at the ATO. Hua's right. We have published in a submission to the PC report on data and digital technology, a submission where we outline the benefits we see of using the ATO data in the ways that has been discussed earlier today and broadly with the banks. In that same submission, we also point out, though, that we are currently constrained by our secrecy provisions, which don't allow us to do this even if we had consent of the member to do so.
So it's a decision of the Parliament, ultimately, or the government, then Parliament.
That's correct, Senator. I will also point out there was a budget measure, which I believe was mentioned earlier today, to explore this very issue. So we've been talking to Treasury about all of the constraints and possibilities around this idea as a part of that budget measure.
So how many people are working on this at ATO?
It's still being stood up, essentially, Senator, but a handful, I would say, will be, at least for this initial exploratory phase of determining if we can do this, how we can do this is probably a better way of putting it, and what the constraints we need to overcome are.
Yeah, so you'd have to advise on a system to do it, identify the costs required, and then you'd have to identify the risks and controls, all that other sort of stuff, and then you'd have to identify the legislative amendments needed if you were going to offer this advice up. So those are all the things you're doing now as part of the group, I imagine.
These are the discussions, yes, we're having with Treasury. The one other obvious part we would try to quantify as a part of that advice is the sort of broader productivity benefits of deploying ATO data into the scheme.
And what do you think about that? Do you have any views on this?
Beyond sort of reiterating that we've publicly said we think there is value in the idea, it's probably too early in the process to definitively say one way or another whether we think it's valuable or not. But internationally we've seen it work, so I'd be pretty confident that we will see some value here.
So which countries have made this work well, would you say?
I might have to take that on notice, Senator. I do believe one of the Nordic countries do a similar thing with their sort of consumer data or their government data and deploying it into these sort of services.
Okay. Nordic countries.
Yeah, I believe it could be Norway that does it. Again, sorry, I'll have to take it on notice, Senator. I'm not sure exactly.
Okay. Okay, I just want to ask you about sort of just other tax issues while I've got you. So who's working on base erosion and profit shifting there?
Sorry, Senator, it depends. We don't actually work in that area, but we can take some questions on notice if you have a particular question that we can
Okay, you don't have people there today who can answer those questions?
No.
Okay. Okay, I'll just ask a couple to the PC then. You've done a lot of work on the productivity in the building and construction sector. So what are the 2 or 3 actions for the federal parliament that could move the needle here on productivity?
Thanks, Senator. Alex Robson, Deputy Chair of the Productivity Commission. So we've done 3 recent pieces of work. One is around Pillar 1 on regulation more generally, where we had regulation of housing construction as a kind of case study and empirical analysis. The piece of work that was done before that was around productivity in housing construction specifically. And then the third piece of work that's going on at the moment is our inquiry into regulation of housing construction. So, in terms of your question, I mean that inquiry is underway, and there'll be an interim report coming out soon with some draft recommendations very soon. I can't give you an exact, but it's very soon. I mean, in terms of the housing construction work we identified 4 broad areas that deserve further attention, and so that's where the inquiry work followed on from, and also the Pillar 1 work. So one was around scale of businesses, so number of employees per business, that seems to be very low in Australia. Another one is around innovation in the housing construction sector. The other one is around workforce and skills issues and occupational licensing and so on, which the PC has done a lot of work on. And then the final one is regulation, which is where the inquiry is focusing on. So, I mean, those are the areas where we said, reform directions rather than giving specific conclusions on what reforms should be done. Those are the areas where we looked, and the government has taken that up by giving us this further inquiry. In terms of the costs of regulation in that Pillar 1 work, the main places to look in terms of housing. So we estimated that the regulatory cost, and it's in new. This is in new construction, new housing regulatory cost of between $135,000 and $320,000, and for a new unit between $40,000 and $175,000. So those are costs of relating to approvals and delays and zoning and all sorts of things. In houses, the main bit of that cost is around the zoning and land release, and in units it's both a bit of zoning, but then also in development approval and delays and those kinds of issues. So that might give you a bit of an idea of where to look, and also the complexity of this is that there's different tiers of government involved in each state and local and federal. So that is where the inquiry is looking a bit further at those kinds of issues.
And we'll look in detail at the National Construction Code and what can be done to fix that?
Not for the inquiry. So we're not looking at the National Construction Code, and we're not looking at tax issues either in that one.
Okay. Just before I hand over the call, so just with APRA, I just wanted to make sure I understood your evidence correctly. So do you think that prudential policy at large has any impact on the flow of finance and the affordability of housing?
So it has obviously an impact on flow of finance by its very definition. The way I would like to phrase it in terms of affordability is credit affordability that we are really primarily concerned about. Housing affordability is really ultimately a matter of house prices, and that's a matter of demand and supply in the housing market. But there is no doubt that there's some influence between the two and some relation between the two. And as Mr. Beckett highlighted, we do when we look at our finance system and our regulation around the finance system, we do look as to whether it has unintended consequences in those areas of provision of finance, housing or otherwise. There are many other areas as well where finance is obviously absolutely key to the functioning of the economy.
Thank you. Senator Nataraja.
Chair, please go to Senator Darmanin.
Sorry, Senator Darmanin. Sorry, yeah.
Oh, thanks, Michelle. Okay, where to start? Maybe just the ATO, can I just clarify the line of questioning earlier from Senator Bragg around the CDR work that you're doing? Does that also, did your answers also encompass the work, did that work also encompass access to payroll data, etc., with regards to you may not have tuned in this morning. There was quite a conversation about home loan processing and improvements to that by access to payroll data, etc. Your answers earlier to Senator Bragg, did that relate to that issue as well, or is that a separate piece of work?
Thank you, Senator. The budget measure, as announced, primarily looks at the credit lending process that the banks have discussed.
Yeah. Okay. Yeah. Okay. So, is there anything? Did anyone tune into the discussions this morning by any chance, and hear some of that commentary around, having the ability for the institutions to access that information?
So I personally didn't see it, Senator. I would say, however, I think our intent here would be to start with the credit lending use case and then potentially look at other use cases where we think there's benefit of providing government held data, obviously against sort of the risks and constraints of doing so.
Okay. Yeah. Okay. Thank you. That's helpful. Now, just going to the Productivity Commission, Mr. Robson, you talked just a minute ago about some work that you're doing in terms of the housing and construction sector and some of the areas that you're looking at. Earlier today, we heard from the Master Builders Association, and their submission talked about the Productivity Commission doing some more work because they say that actually you can't really measure productivity precisely or consistently. So do you, again, I'm not sure if you tuned into that discussion or not, but if so, I mean, what do you think about that proposition, in light of the work that you're doing? And what are the key drivers to the, lack of productivity if we accept that proposition?
Look, I didn't see what they said. So that work I referred to earlier, the housing construction productivity, can we fix it? Work that we've done in I think it was released in February last year. So in the national accounts, construction, is aggregated, and so what we did in that piece of work was provide some estimates of housing construction specifically. So there's different ways you could measure it. So, for example, you could measure it in terms of dwellings completed per number of hours worked, which doesn't make adjustments for size and other things, and that's declined by 53% over the last 30 years in Australia. Another one you could do is the gross value added per hour worked, and that's declined by 12%. I should add that sort of decline using similar estimates is not unique to Australia. That's happening in other economies as well. So, you could develop other measures, but the picture, I think, would be pretty similar. So, for example, we did some work on, the number of months it takes to build homes now in Australia. So a detached house over the last, say, decade, used to take 6.5 months. It now takes 10.5 months. A new townhouse used to take around 9.5 months. It's now up to 13 months. New apartments is up from 18.5 to nearly 28 months. So there's something happening in that sector, and it's not recent. It's been going on for a while, where just this time taken or number of houses completed per hour worked, or however you want to measure it, seems to be going in the wrong direction. And so that's why we pointed to issues around scale in the building industry, as I said before, innovation, workforce and skills, and regulation as the broad areas where government should look, and we're doing more of that work, as I said in the recent inquiry into housing construction regulation.
Yeah. So in terms of those 4 areas that you mentioned, so scale, lack of innovation, workforce skills, and regulation as the areas for policy fix. Like, how do you know that they are they sound reasonable, but how do you know they are the right policy areas if we don't know what the drivers are? Because I asked this of the MBA earlier. What are the drivers of these things? Like, they might not fit together in terms of how you improve innovation doesn't address a driver if it's exponential increase in supply. Like, what analysis do you have on the drivers of those statistics that you just talked about?
It's a very good question, and the evidence and that previous work, the Can We Fix It report, wasn't a full inquiry, so that was self-initiated research, and so it was an initial look, and it was based on some consultation with industry, but not our usual full consultation with public hearings and full submissions and so on. But across any industry, when you're looking at productivity changes, those are the kinds of natural places to look around innovation, scale, regulation, and workforce and skills issues. And so that's why we focused on those, in addition to the amount of consultation that we did do and the team did analysing this particular industry. But we didn't attribute the decline or the patterns of productivity changes to any one of those things and try to say, well, it's 10% this and 20% that. That wasn't possible. So I think the initial the contribution of the work was to say come up with some estimates of productivity in housing construction specifically, because that had not been done before, and then point to directions for reform for government without saying exactly what those might look like. It's more areas where to focus your attention.
Mm-hmm. And so just thinking about measuring productivity, there's all different ways that it can be measured. Maybe turning to impact of natural disaster and climate change on housing in particular, because that's the sort of topic for today. We heard earlier from the Insurance Council about some of those impacts. And so thinking about, fossil fuels have historically appeared highly productive because they provide cheap, dense energy. Many of the costs aren't reflected in the productivity statistics. And, we are now seeing that the costs of rebuilding that are quite broad and challenging are contributing to our challenges. Do we have a problem with how we are measuring productivity in this area? And do we, should we change the way we talk about, the value of fossil fuels that contribute to construction of housing, for example, and think about the value of transitioning to cleaner energy sources?
Look, I think and I can see now the purpose of your previous question, and now I understand where you're going. I think, it is a very good point in relation to construction more generally. If it's poorly done and then you have to go back and fix it, or if it's not resilient and needs, if there are natural disasters and so on, and it's not, if it's susceptible to that, then if you're measuring it properly, well, first of all, those sorts of things in terms of quality, ideally they would be reflected in the price of homes, and people would choose the quality of home, and then and that would go into your gross value added measure per hour worked. And so the issue we have with these measures of housing construction productivity is they don't, to the full extent that they could, make those quality adjustments very well. And this is, it's not a problem that's unique to housing, making quality adjustments for all sorts of things, so computers and cars and mobile phones and those sorts of things. The ABS has to make those adjustments all the time. And so things like, resilience to natural disasters, adaptation, where you build, all of those things, ideally you would try to find in the productivity statistics. But as I said, if you take a look at dwellings per hour work, that's not going to necessarily give you an idea. So I think you make a good point in relation to those broader productivity measures. But this is a challenge not only for Australia, it's around the world. That these are statistical judgments that are made by national statistical agencies. Ideally, they're consistent across countries, and so it is a challenge not only for Australia but elsewhere in the world.
So are we seeing this conversation being had elsewhere around the world in terms of a different way of thinking about this measurement, if it is a challenge recognised more broadly?
Look, I couldn't speak to that exactly, Senator. In places like the OECD, this is, they talk about this regularly. I don't have the specific publications that they have on this issue, but that they're thinking about these issues all the time. In our report, in Pillar 5 of the work we put out last year, we did point to a number of changes that could be made in relation to provision of information to people buying homes around resilience and climate issues, and also the broader challenge around adaptation. So it doesn't go directly to that sort of measurement of productivity, but it does address some of the policy issues that you're getting to.
Okay, I might leave it there for now, Chair, and if I have more, I'll let you know. Thanks.
I might take over here. Mr. Robson, just to follow on from Senator Darmanin on the measurement of productivity in the non-market sector. The non-market sector, just from reading your submission, seems to be dominated by healthcare and then social assistance. But the two are getting lumped when they're actually quite different. I mean, healthcare actually, from the PC's own research, has a relatively high productivity. When you look at multi-factor productivity, it's in the order of 3%, maybe more. Social assistance, on the other hand, could be things like the NDIS, aged care, which traditionally have not been particularly innovative sectors, right? I guess my question is, what kind of thinking is going on to sort of disaggregate this a bit? Because, so much hinges on this number, and it's pretty clear that we're getting an inaccurate picture here for lots of reasons.
Yeah, again, a very good point. So the non-market sector, just to step back a bit, so it's industries where goods and services aren't exchanged for a market price. So it goes to an education, partly is another one, but social assistance and healthcare are the ones that are most prominent as well. And so, the issue, again, it's not unique to Australia in terms of the measurement issue, is historically those things have been measured at factor cost. And by that, I mean, you sort of measure the inputs and you're not really measuring the things that people value as outputs. So what we did in that healthcare research, and it was, the reason we focused on that was, well, it was, it's interesting, but also because there's good data there where you can measure the things that people actually value. So you might start by thinking, well, what does the output of, say, a hospital look like? It might be, number of beds and separations and things like that, but that's not really what people value. I mean, it's part of it, but not the most important part. And it turns out that there's pretty good data for the value that people place on getting various treatments, so in relation to cancers and heart conditions and other things. And so you can look at the number of years that they live adjusted by quality after a particular treatment. And that's getting to that what the value, and then you can place a value on a statistical life year, and then you can work out, well, what was the value of each of those interventions, and then measure that against the inputs that were used to help that person and engage in the treatment. And so you're right that if you do that on aggregate, and it's just for a particular set of diseases, I think it's around 30%, and there's much more you could do. If you do that, it turns out that productivity in the healthcare sector has been increasing by 3% on average per year, which is that's pretty good, very good actually. And so it gets to this question of really, would you prefer to be in a hospital in Australia? Well, you wouldn't prefer to be in hospital at all, but if you had to go to hospital, would you prefer to be there today compared to, say, 30 years ago? And the answer would probably be today if you had to go. And so that was the work that we did. We'd love to be able to do that similar kind of work for things like disability care and aged care and support for veterans and these kinds of things. It's just a function of what data is there that you can use to measure things that people actually value. So in the market sector, that's more straightforward, because if you purchase something at a shop, the price is revealed. That's how much people value that last unit of that good. Whereas if you're getting disability support, what is the value of that? It's more difficult to measure because there's no good data on the value of that intervention in terms of those other things that I talked about. So that's the challenge, and it's not unique to Australia. It's a challenge around the world. But to the extent that those services are becoming more important and government is spending more money on them, it's a critical question as to how to...
Yeah, I mean, this is, I guess, the heart of it, right? That we have an aging society like other advanced economies, and we're all moving towards services industries, and yet there just seems to be this blind spot when it comes to actually fixing how we measure productivity. On the topic of access to data, I mean, there's plenty of data sets in healthcare, heaps, right? They're Commonwealth level and also state level, and they measure all those kinds of outputs that you described earlier. So is the OECD, I suppose I'm looking at them, doing any work in sort of advancing the research and the science around measurement of productivity in the non-market economy, particularly disaggregating healthcare from all the other social assistance stuff?
We drew on work that was done in the US and Canada. I'm not sure what the OECD has done. We did look at some other measures in that healthcare work around sort of broader notions of productivity. If you look at things like, change in life expectancy per dollar spent on healthcare, and it turns out that Australia ranks very highly on that measure as well, and that's more internationally comparable because that data is available across that the OECD group of countries. But to answer your question directly, I'm not sure what the OECD is doing on disability support and other things at the moment. I haven't kept up with what they're doing.
Maybe on notice, if you could just supply us with, I don't know, a report on what the, don't make this extensive, please keep it high level, on what the OECD is doing with respect to better understanding non-market productivity, particularly as these, advanced G7 countries are all moving in the same direction. All of us are, right? Yeah. I don't understand why more work is not going into this, seeing as it's such an important metric and so much policy hinges off this.
Yeah, I'm happy to provide that on notice.
Okay, thank you, Chair.
Thank you. Can I just add on that? Sorry, just following on from that, and I guess to extend that out to impact of climate on housing and construction. I mean, I think the same sort of conundrum applies. I think you said there's no good data in the value on the interventions in the health space. The flip side is I think there is data in terms of what the cost of rebuild, and we had a very good piece of evidence. I can't remember who it was from, but, you know, a house is being rebuilt 3 times in a flood zone. You know, there is a cost to that. And there is also a cost to, you know, the displacement of people, in addition to the loss of deployment of those skills and resources into other parts of the economy to build and construct if they are having to rebuild to climate disaster. So I just, again, like I really question measurement around the measurement models that we use on some of these things. I don't know if you want to say anything more or it's just a comment, but like if we recognise it's a challenge and we are trying to inquire into how we address that challenge, rather than just put it there as a problem without sort of trying to identify how we fix it, we're going to just keep repeating the same mistakes, aren't we?
I mean, we have...
maybe you agree.
We have pointed this out in previous reports, that if you can adjust aggregate measures using some sort of implicit carbon price, and that gets you to, you know, the value. Part of the thing I think you're talking about, Senator, is, you know, the value of an emission, you know, a tonne of emissions reduction or increase, and then that would, if you did that consistently, you know, then, you know, you could get it, you know, a different way of measuring productivity that would take some of that into account. So, and we have pointed to this in a recent bulletin around the electricity sector, where you can make those kinds of adjustments, but you can do it also more generally. And so the question there is what price do you use and the methodology and so on. And so we have done a bit of work pointing that out. I think, you know, you raise a very good point around measurement of productivity changes when, and it goes to the, you know, non-market sector, when you know, you may not be measuring the value of these outputs as accurately as you could. I think that, and that's a, you know, very good point.
Thank you. Thanks, Chair.
Okay, I think we've exhausted our questions. For you, just conferring with my colleagues, we've exhausted them all. I think we have. Thank you very much.
Sorry, Chair, did we ask the ATO about the consumer data rights?
We did.
Was that you, Lisa? Yeah, we did. Okay,
Both
great,
did.
thank you. Fantastic, yes. We're all very interested in that.
Can I just add to the evidence that Mr. Bowen's given? Some of the data sets that we have will only give you a partial view of what income a taxpayer might have. The STP data, I think Senator had mentioned previously, that is only in relation to employees at a particular time. So we do have to do a bit of work around what would be useful data sets that we could share that would help, you know, address some of those issues. So I just wanted to highlight that there's not one data set that we have that will provide all of the information that they're looking for.
Could we get a list of some of that information or detail on notice?
We can see what we can give you on notice.
Yeah, the data sets and what is in them. I think that's interesting. Thank you.
I just have two follow-ups, then we'll finish. So just with APRA again, so in terms of your universe these days is life insurance, general insurance, superannuation and banking. Is that it?
Health insurance as well, Chair.
And you do health insurance now, okay? And that's it. And so, and you do the governance and the transparency and all the other prudential things for those industries.
Correct.
Okay. So the Parliament must have given you health insurance sometime in the last 10 years, did it?
It did, yes. I think 2014 or 2015, we took over responsibility for health insurance.
Yeah, okay. And then finally, for you, when you make when you do, let's say, the serviceability buffer, you make that under a prudential standard, don't you?
It's 220. Yeah. Yes, it is. APS 220 is where or the documentation.
Isn't it? Yeah. So consolidated prudential standard, did you say?
I think it's APS 220. Yeah.
Oh, it's ADI. It's for banking. So it's a banking one, right?
Yeah. Okay. And it's got all basically all the credit lending, all the credit standards in there.
Okay. So the buffer, and what about the capital risk weights? Is that in there as well?
It's not for you.
So that's in APS 112, 113.
So it's a separate standard.
Various other ones. Yeah, there's a number of various banking standards.
Okay. And every time you deploy one of these things, do you do an analysis of the impact?
Yeah, we do. We're required to consult. We comply with the government's policy impact analysis requirements.
Sure.
I mean, it would depend on the size of the change. You know, some changes aren't very big, but if we're doing a large change, then yes.
But as you'd expect, Chair, when we exercise these powers that are delegated to us by Parliament, we take that seriously. And so there's a very rigorous internal process that we go through that's informed by, as Mr. Beckett said, informed by feedback from consultation, all of those things. And all of that's undertaken in a very public process that culminates in us making the instruments and those being tabled in Parliament.
Okay, fabulous. Look, thanks very much for being there. Thanks to my Senate colleagues, and thanks to broadcasting and everyone else who's made this day possible. The committee is adjourned. Thank you very much.